A brand new week. We are back with Power Breakfast right here on CNBC TV 18 in the Mumbai News Centre. I'm Hormuz Fatakia. With me, as always, Rashna Dhanurjani. Rashna, good morning to you.
Good morning to you as well. Let's start the day with some headlines. US President Donald Trump says Washington is only semi-negotiating with Tehran and will wait for economic pressure on Iran to mount. This comes after Iran's foreign minister denies any direct talks with the US.
Wall Street ends higher on Friday on unexpected contraction in the July jobs report. The S&P 500 rises to a record close while the Nasdaq climbs over 1%. The futures, however, are subdued as investors await a deal between Iran and Oman.
Asian markets open higher following a positive handover from Wall Street. Meanwhile, the gift Nifty hints at mild positive start to trade.
Oil prices are up for the third consecutive session as uncertainty over the reopening of the Strait of Hormuz continues. Investors await for an agreement teased by the Trump administration. Earlier, gold hit a 7-week high on unexpected contraction in the July jobs report.
The government clarifies that consumers will not have to pay any charges for making payments through the platform amid growing speculations. MDR may apply to some merchant transactions above a threshold.
Well, Asia has opened largely higher considering the handover that you saw from Wall Street, although the S&P 500 and the Nasdaq both ended on a positive note last Friday, and that has had a bit of a spillover on the Asian indices as well, be it the Taiwanese index, which is up close to 2%. The Hang Seng is up almost 0.8% as well. The Kospi, where the volatility has finally taken a bit of a break, or maybe I might be speaking a little too soon, because at the start of the day, the Kospi was up well over 2%. It's now trimmed its gains down to just a third. So volatility continues on the Kospi. The Nikkei, though, is trading with gains of close to 2%. So a largely positive screen on the Asia Pacific, at least as of now. Pull up the gift Nifty. It's an important week for our own markets as well, especially considering the fact that this is the final week of this quarter's earnings season. Most of the companies will be out with their results by Thursday. Now, the implied open is suggesting around about a 24-point uptick as of now. So we open relatively around about the same levels as we've been consolidating last week, around about that 24,600 mark. So it promises to be an interesting session today, Rashna.
All right, a mild positive start it appears to be, and that's what we'd be bracing for. But let's get you updates from West Asia then. US President Donald Trump says Washington is only semi-negotiating with Tehran and will wait for economic pressure on Iran to mount. His comments came after Iran's foreign minister Abbas Araghchi said there are no direct talks with the US, but that intermediaries are still trying to create the grounds for negotiation. Araghchi says Iran-Oman talks on the Strait of Hormuz are in the final stages, but the waterway will not open until the US meets Iran's demands, including lifting a naval blockade. Meanwhile, in an interview to Fox News, the US Vice President J.D. Vance said that the US had destroyed Iran's nuclear program and dismantled its conventional military capabilities. Listen in.
We've destroyed their nuclear program. We've destroyed their conventional military. We've radically reduced their, what you might call their asymmetric military abilities. And right now we're trying to see if they're willing to make the kind of long-term changes that would be necessary to have a better relationship with the United States. And if not, that's fine too. We're just going to keep on applying the pressure that we can apply and getting as much oil and gas out of the Middle East so that Americans can enjoy lower gas and energy.
That's US Vice President J.D. Vance. Meanwhile, Israel's Prime Minister Benjamin Netanyahu has formally rejected a US-brokered peace plan for Gaza, saying an Israeli pullout will not happen until Hamas is fully disarmed.
Let's set you up for today's trading session. Our research team is here with how the trade setup looks like, the stocks that are likely to be in the news as well. First up, Vivek joins in to get all the market cues that we need to watch out for today. Vivek, good morning.
Well, good morning. Like you alluded at the start of the show, what's essentially transpired is that we've seen a bit of a risk-on rally as far as Friday's trading session was concerned all across the globe. And a weak U.S. jobs data is something that's ensured that there may not be a rate hike as far as USA is concerned, when the US Fed meets next time around. Now, along with that, oil prices too have inched upwards. There's no clarity as far as the deal is concerned, and that is something that made Brent go above the $84.5 a barrel mark. Asian markets, GIFT Nifty, all indicating a mild gap up start for our own markets today. In terms of what transpired last week, remember, last week was the first implementation of the CAS, post which you actually saw the Nifty as well as most of the benchmark indices move 1% higher in the week gone by. PSU banks were the clear top gainers, led by extremely strong results that SBI came up with and going ahead and giving a guidance upgrade as far as credit growth was concerned. In terms of what exactly we will be watching out for in today's trading session, first up, it is week 2 of CAS implementation, more of ironing out of all of the glitches that we saw in the week gone by, something that is expected. Earnings reaction, some of the key ones that we will be seeing in today's trading session: Titan, Keynes Technologies, PFC, Hitachi Energy. And along with that, remember, today post-market hours, you will see the outcome of this NSE sub-index committee review meeting. So you could see some changes come a lot of the NSE indices in the coming days. Key results today: Bosch, Bharat Forge, Info Edge, some of the names that will come out with results today. And primary market action also is quite robust. 2 IPOs open today: Doot Transmission as well as Mobilio Diagnostics. So it's an action-packed day and an action-packed week ahead as well.
All right, it is an action-packed week. Those were the 2 IPOs, but there are 5 IPOs slotted for this week. We'll get you more updates on that. But now let's go over to Ria, who will list out the stocks to watch for in today's trade.
Well, good morning. A lot of stocks today will be in focus on the back of their Q1 results. Let's start off with Titan first. The net profit has seen a jump of nearly 65% compared to the previous year at nearly 1,700 crores. And the revenue has also seen an increase of nearly 24% for the year. For Power FinCorp, we have seen a weak operating quarter this time around due to muted disbursements, soft loan growth, as well as pressure on the NIM side. Disbursements this time around have seen a drop of nearly 44% compared to the previous year to 20,200 crores. For Hitachi Energy, however, it has been an all-round beat this time around with strong revenue growth of 68% with a 400 basis point expansion in margins to 14.5% for the first quarter of FY27. For delivery, we have seen the revenue going up by 28%. However, margins have been soft in this quarter at 4.9% versus 6.5% that we saw in Q1 of last year. For Ramco Cement, the volume growth has picked up to nearly 12% for the year on a year-on-year basis, and the EBITDA per ton, however, is under pressure on a year-on-year basis at 693 rupees per ton. For Apollo Micro, the net profit has seen an increase of 42% compared to the previous year. Revenue also going up by 88%. So strong quarter all around for Apollo Micro as well. For Ola Electric, the net loss this time around has come in at 336 crores versus a loss of 426 crores in Q1 of last year. Revenue, on the other hand, has gone down by 45% compared to the previous year. Lastly, Keynes Technology will also be in focus. Good quarter this time around with the revenue beating estimates. This time around, revenue has gone up by 40% versus the estimates of 29% growth. We have seen strong revenue growth across all segments for the company. Margins also in line with the poll at 15.6% in this quarter.
Yeah, thank you for those updates there. And not just these, there are plenty of other names as well that you will have to keep an eye out for. Result reactions coming out with results today as well. There's a lot to track in this final week of the earnings season. Over to commodities now. Manisha Gupta is back with all the updates from the commodity space. Manisha, good morning. What are you tracking today?
Thank you for that. Well, I'll start with copper because we did see all-time highs in the previous week, and that's exactly where the copper prices seem to be trading even right now. Well, when you look at overall fundamentals, we are looking at support coming in from all factors. On one side, you have the U.S., which seems to be holding 69% of all exchange-monitored global copper stocks, and that is leaving the rest of the world with a 7-month low in sense of inventories. That has been supportive. The Strait of Hormuz closure has knocked off nearly 50% of seaborne sulfur shipment. There is Congo, which has banned exports of copper concentrates. There are mine disruptions happening in Chile. So whether it's about inventories, mining, there is support coming in from everywhere. The support also continues in case of the crude oil prices, which fell nearly 8% in the previous week, but have been trading firm for 3 sessions now. Iran has rejected direct negotiation with the U.S., and it says that the U.S. must include compensation and sanctions, military threats to move on in the same direction. In the meanwhile, you also have Iran-backed Houthi militants which have claimed attack on Saudi Arabia's Jazan refinery. So there are still concerns coming in, and that is where you're looking at support coming in for the crude oil prices as well. And finally, gold has gained 7% in the previous week. Silver has gained 10% in the previous week, and we are looking at some more follow-through buying Monday morning. So mostly all metals trading in the positive.
Manisha, thank you for those updates there. Take a short break. On the other side, get you all the action from Wall Street.
Welcome back. You're watching Power Breakfast on CNBC TV 18. In the US market, Wall Street rallied on Friday despite a weak jobs report as investors bet that Fed won't need to raise rates soon. Meanwhile, President Donald Trump has renewed his push to fire Fed Governor Lisa Cook. CNBC's Julia Burstein gets us a wrap of all the action from Wall Street.
U.S. markets were up across the major indexes in Friday trading despite a weaker than expected monthly jobs report. The Dow gained 152 points, the S&P 500 was up 48, and the tech-heavy Nasdaq added 342 points. The July jobs report Friday showed a drop of 23,000 jobs, but economists had expected a gain of 83,000. The unemployment rate also fell to 4.1% as the labor participation rate fell to its lowest level in more than 5 years. Wall Street seemed to interpret that as a sign the Fed won't need to raise interest rates soon, which helped power the markets higher. And President Trump renewed his efforts to fire Federal Reserve Governor Lisa Cook. In a letter from the White House obtained by CNBC Friday, the administration told Cook the president was, quote, considering removing her from her role, demanding she respond within 3 weeks to unproven allegations she committed mortgage fraud. Her attorney calls the allegations baseless. In June, the Supreme Court refused to allow Trump to fire Cook at the time, with Chief Justice John Roberts ruling the president failed to give Cook the procedural protections she was entitled to by statute.
Julia Burstein, thank you for that update there. Here's some more opinion from former Dallas Fed President Richard Fisher on the state of the economy and concerns surrounding inflation. Listen in.
The very damp increase in wages that is taking place. That's one thing CEOs and the C-suites can control. Inflationary pressure is coming not just from energy, it's also coming from the build out and demand for all the new data centers and all the components that go into it. So I think we have a very narrow perspective if we're focusing only on the war, and God only knows how that's likely to come out. Instead, we still are seeing inflationary pressures in the economy that aren't war related or if they're war-related, they have nothing to do with energy per se. So I think we just have to wait and see what kind of inflation data comes out. The unemployment rate is still pretty low. We'll see if we get more employment data before the September meeting, but I'm looking at the inflation data. And so far, it really is not encouraging.
Now, the U.S. labor market unexpectedly lost 23,000 non-farm payroll jobs in July 2026, while the unemployment rate ticked down to 4.1%. Rick Santilli has the details here.
I think that, the reason yields moved down is because it's the second lousy jobs report. Everybody seems to be dancing around this. The labor market is a key component. I know inflation is something many worry about, but supply shock is murky, and the jobs picture is kind of easy to zoom in on. And if you look at a 5-year chart of what's going on with average hourly earnings year over year, you can see downward slope. It's a ski slope since COVID days. And if you look at a 6-year chart of labor force participation, boom, it's gone from 62.5 plus down to 61.4. That's a 6-year chart. This is important. The demographic time bomb used to be ticking. It's already starting to explode. The number of workers to support everybody retired. These are serious numbers that point to serious issues down the road for entitlement, Social Security, when we're covered with debt. Now, let's look at a week to date. Here's TENS, here's oil. Any questions there? The oil market is the tug of war pushing it up, and the jobs report pushed it down. And if we look at the 2-year, that's a 3-week chart. On the left there, that high water mark, that's a yield of 435 from the 23rd of July. High yield close. And since then, we've moved lower. So we could, once again, we could blame Marsh and the Fed, and we could talk about one part of this number, one part of that number. But I think the probability is moving down so aggressively from the 60s to the 40s. Well, that pretty much says it all.
Rick Santilli there on the big U.S. jobs report reported last Friday. Now, hear out JP Morgan's David Kelly on why a shrinking labor force does not mean a strong jobs market.
This is a very consistent story. I mean, American business can't find workers, and American workers can't find a raise. We've seen this, we've seen the labor force fall by 1.3 million people over the last year. We're short of workers. And so the labor market's not strong, it's just tight.
All right, let's slip into a break. Up next, we get you all the details on what the SBI management said post the Q1 earnings.
Welcome back. It was a strong quarter from India's largest lender, State Bank of India, beating estimates on all fronts. The profits rose over 10%. Core income also grew 15%. Here's what SBI Chairman C.S. Setty had to say on the outlook going ahead.
Numbers, what you see now, are a conscious effort in that direction. And whatever numbers you mentioned in terms of outliers, I think they're not outliers at all. The overheads uptick sequentially will always be there. And on the year on year, I think the overheads are contained. And what are the standing out numbers are in terms of our a proactive adjustment in our cost of resources. I think we focused on containing the costs. It's almost 7 basis point reduction. That really helped us in terms of ensuring that in a very difficult market conditions, margins are protected. And we also have a fair idea in terms of what is going to be our FCNRB trajectory in the Q2. So we have proactively reduced our bulk deposit.
All right, that's SBI Chair C.S. Setty. But on to some national news updates now. The pilot who flew the turbulence-hit Air India aircraft from Phuket to Delhi last week has likely failed a dope test. This, however, is not a final confirmation on the matter, with another result still pending. Both the pilots have been taken off the flight roster pending the completion of the inquiry. The aircraft experienced a sudden loss of altitude of 300 feet during cruise, which left 3 passengers and 4 crew members injured.
And before we call time on the show, let's also take a look at how Asia is faring right now. When we started off the show, the Kospi had given up most of its gains and was down only 0.3%, and was up only 0.3%, still around about the same levels, around about 0.5% higher on the Kospi. But most of the other indices are still holding on to gains. The Nikkei is still up 2% as it was at the start of the show. The Taiwanese index has marginally extended its gains, is now up over 2%, and the Hang Seng too has extended its gains, now up 0.8%. Pull up the GIF Nifty, you'll see if there is any changes to the implied open. As of now, we started off with a 24-point uptick. Well, not really. Now around a 13-point uptick. So it promises to be a bit of a subdued start for our own markets. Of course, there are plenty of result reactions that you need to watch out for today. There's a brokerage commentary coming in from SBI, of course, and then brokerages from Titan, from Hitachi Energy, from Keynes Tech. Most importantly, that could be the stock to watch out for, and of course Ola Electric as well. Take a leave on this edition of Power Breakfast. The implied open is promising a subdued start. From Rashna and me, thank you for watching. Bazaar Morning Call on the other side.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. Monday morning, and I think the cues would have been positive. US markets closed up higher. Good numbers from the likes of Hitachi, Titan. The FIs bought a little bit in the cash market on Friday. I think the only fly in the ointment is crude prices because that's gone up.
Well, that's right. And it's the end of the earnings season. By the end of this week, we'll be done and dusted. And as we've been saying, the earnings season has been quite good, a little better than what most estimated. So that's pretty good as well.
Well, absolutely. And I think we are now in the last leg in terms of the earnings season. I mean, last, a few days, a week or so. And that the end before we look ahead. So let's just take it from the top with regards to where we are at. And where we're at, of course, is just to take a quick look at oil prices this morning. So near $85 a barrel. And the reasons are that, the Yemen-based rebel group, the Houthis, have struck a government-held port. The sort of, officially recognized Yemenese government, their port. So the rebels have struck that port. They also claim that they've struck a Aramco or Saudi oil facility. So there were reports of a fire, etc. We don't know how much damage it's done. But oil prices have perked up a little bit, not by much, but about $85 or so. Iran and Oman continue talks to establish a shipping sort of route through the Strait of Hormuz. So there's not very much new. We started last week with the same headline. The problem is not Iran and Oman. They can work things out. The problem is, of course, the other side, which is Iran and the US, where things are not going all that well. So, by the way, Iran also came out and said that they're not talking directly with the US. And, the National Security Council representative of Iran essentially over the weekend said that their conditions of opening the Strait of Hormuz, no more US threats, lift the naval blockade, withdraw US forces from the region, war compensation, lift sanctions, unfreeze assets, etc., etc. So, it's not new, but it kind of tells you that, does it look like this is close to the finish line in that sense to try and get a deal? Well, it's doubtful in that sense. On the other side, President Trump's proposal for Gaza also has got a bit of a setback. So Israel has rejected the deal announced by Trump for Gaza, essentially withdrawal of Israeli forces. Israel is now saying that we need complete disarmament of Hamas, and only then we will sort of move out in that sense. So a bit of a setback, especially with regards to, we've not heard, by the way, a response from President Trump at the White House to any of these headlines that I'm sort of reading out, and maybe we will get one later in the day. So now for the US markets, a pretty good session for equities. NASDAQ was up 1%, 1.3. The Philadelphia SOX index, which is the index of the top semiconductor companies in the world, that was up about 3%. And yields fell. So the bond markets, the 10-year was down 4 basis points. The 2-year actually at one point was down 8 basis points. It finally settled about 5 lower. And the reason was that the US jobs data saw a bit of a surprise fall. So the consensus expectation was an addition of about 80,000 jobs. The number, of course, fell far short of it. And the odds of a September hike by the Fed have also come off very, very sharply. In terms of single stock action, Airbnb was up 17%. So second quarter results were much better than expectations. And now to come to India. There's lots of earnings to tackle. SBI, of course, reported last hour. But I think there is going to be a remnants of reaction in a positive way on SBI, and so much else which has come through, and we'll talk about those. But just one thing I want to highlight. So we got a statement from the government essentially on the MDR issue. And it looks like, after the enabling changes which were made in the bill and taken through the parliament, it looks like MDR for merchants perhaps is going to be a reality. It's going to be, of course, done for certain high-value transactions. The bulk of, volume-wise, the bulk of UPI transactions will not fall under this. But value-wise, I mean, I think it's a different story. So MDR looks more and more certain in that sense. And of course, stocks we will tackle. There's Paytm, there is Pine Labs, there is MobiKwik and others as well. So more on this one as we go through the day. I'll just tie in the levels here. The Nifty support comes in at 24,500. The second one is 24,400, and basically around 24,500, 24,475. Resistance 24,775. Beyond which the target is 24,980. So those are levels as we begin this new session. GIFT Nifty will come up on your screen, gives you a quick sense of how we are starting. So it's a tepid 6.5 odd point change higher on the GIFT Nifty. Nigel has walked across to the wall with the F&O cues, the positioning and more. Nigel, take it away.
Well, before we get to the equity market action, let's take a look at the global indicators that we look at, and that's the troika. Brent crude prices have spiked because of those attacks in Middle East that you mentioned, though there is some hope that maybe as the course of the week progresses, we could get closer to around a deal. That's the hope, that a deal finally gets stitched. The Fed futures, though, they are pricing in a low probability now of a rate hike in September. And that's what's kept the dollar index more or less softish. While gold has hit the highest levels that we've seen in the last 7 weeks or so. That's post the jobs data and as the dollar index continues to remain rather soft. So all those three, in fact, just want to take note of that. Coming back to our markets, the cash market flows, they were positive. The DIs and the FIs, both of them put in money. Between them, they put in close to around 700 crores or thereabouts. But the FIs have been a little bit cautious, in the F&O market. And I say that because they added more short positions on index futures, close to 3,400 contracts odd. The short positioning in percentage terms is at around 87%. Even on stock futures, they added close to 3,700 short contracts, while there was some unwinding of long positions. And going to the options data, they wrote calls aggressively in comparison to the number of puts. So put that together, a little bit defensive is what the FIs have turned out to be in the F&O market. Maybe they're factoring in a bit of a range as of now, but shorts in the system, as I always say, is not such a bad thing. Well, and because of this call writing that we've seen, the PCR has cooled off. Remember, the PCR had moved all the way to around 1.4 a few trading sessions ago. Then it cooled off to around 0.8, it bounced back to around 1. But now it's back at around 0.89 because the kind of call writing that we have seen. And a couple of those strikes should come up for you on the call side. 24,600 call, 24,550 call. Between them, the total open interest was up by close to around 90 lakh contracts or thereabouts. And the premium in that vicinity of around 110 to around 140 rupees. So you look at the options data, you punch in those rates, and in fact, you look at the technical levels as well. So the 200 DMA, that becomes the line in the sand. The bears are coming into fight at that level. The recent high as well is in that vicinity. So the 200 DMA becomes the resistance mark. On the downside, though, the recent low at around the 24,300 mark, that becomes the first level of support. And then you're looking at the 20 DMA. But even the options data suggests 24,300 is an important mark. Stocks that we're going to be looking at, LIC, gradually that one could be, moving out of the F&O band. So we'll have to keep an eye out on that one. It'll continue to remain in focus in today. Even Bandhan Bank, after the kind of correction that we've seen, it's showing some signs of stability, but that's in the F&O band as well. And finally, Keynes, that one will be reacting to its numbers, and it's come into the F&O band as well. The commentary as well was a little bit positive, though a lot of grey areas. We'll be speaking to management later, but that's the new one in the F&O band, so I'll keep an eye out on this as well.
Thank you very much for that. Asian markets are edging higher this morning. So you've got a 2% gain coming through on the Taiwanese market and the Japanese markets. And the big trigger, it was the surprising drop in the US jobs data. So July non-farm payrolls declined by 23,000. And we saw a significant drop or cuts in local US government education and tourism. So maybe something to do with the aftermath of FIFA. And so now the odds of a September rate hike have come off. William Lee, Chief Economist, Managing Director at Global Economic Advisors, is now joining in. William, morning. Thank you very much for joining in as always. So what's top of mind for you now as we start this week?
I think one of the things that we haven't talked about enough, especially as the coverage has been on Hormuz and the AI trade, has been the enormous amount of debt that corporates have incorporated. I don't know if your viewers know, but less than half of non-financial debt that's out there that's borrowed by corporations comes from banks. 80%, in fact, of all the corporate non-financial debt out there has come from non-banks, non-regulated entities. And one of the things I think that people have really been more and more concerned about is the amount of debt that the corporate sector has taken on, and the fact that they've been taken on from places that are non-regulated. And I think that's one of the things that I think we're going to have to watch out for going forward as more and more private equity, private credit starts to be more important factors in the lending process. we don't know if there are some systemic time bombs out there. We didn't know that there was a mortgage crisis until it was way upon us. Right now, it's not clear how much of that corporate debt that's out there will be another time bomb. What's scary is that many of the AI companies are borrowing a lot of debt. Now, certainly they have a lot of profits, they have a lot of cash flow, and they can probably handle the debt. And since they're using it for the construction of AI centers, that seems like a reasonable thing to use debt for. But one of the things that I would like to caution everyone is to keep an eye on the enormous amount of debt that's in the corporate sector and how much of it is coming from non-banks and non-regulated entities.
What are the numbers that we're looking at? How large is it? And how much of it is to do with AI right now? Because at least, and yes, increasingly, AI, these tech companies are using the debt route to fund their capex rather than the free cash flow. They're still sitting on a very strong earnings growth. So in that sense that, yes, they are using the debt, but it's not that it is a asset quality issue when it comes to the tech companies. So do we have a breakdown of where that, who's raising and how much?
Right now, it's not a quality issue because, as you say, many of the borrowers out there are very strong. It's what's concerning are the non-strong, the less strong corporate borrowers out there who are relying upon debt because they don't have sufficient cash flow. A lot of the profits that have been reported have been very strong in the AI sectors, but there have been a large number of sectors that have not reported similarly strong profits, and they have relied much more now on debt. And not so much debt from banks that have good risk controls, but from non-banks, private credit firms. And what's concerning for me is that those are the sources of time bombs that turned out to be explosive in the past. We had LTCM in the past. We've had the mortgage debt crisis in the past. And I just thought that as a word of warning that people don't talk about enough is the enormous amount of debt that's been issued by private credit. And how little visibility we have in the whole process. So you ask me, where is this borrowing going and who's doing the borrowing? I honestly don't know. But what I do know is that the loans that are being made now have fewer covenants than the loans that were made in the past. Banks are very careful in how they set up and structure their debt and having a lot of covenants to cover a lot of contingencies, not allowing companies to have insufficient cash flow relative to debt. But right now, these covenant-light loans are really being made in a way that is, to me, alarming because of the lack of transparency in the process. So that when you ask me what's top of mind right now, that has become top of mind because many of the clients I've talked to have raised the issue of who's doing the borrowing and how much borrowing is there. And unfortunately, my answer is I don't know. And I don't know any regulator out there who knows the answer.
William, the other one was the jobs number, which was below expectations. What did you make of it? And how does that feed into the odds for a September hike have fallen. I think this week we get the CPI on Wednesday out of the US. Your thoughts?
I have come on your show a number of times talking about the K-shaped economy in the United States and how I've been saying that people have been way too sanguine about the state of the U.S. labor market. I think these numbers are showing that the job creation process in the United States really isn't that strong. Now, I think the concern from the Federal Reserve is that, well, unemployment rate is only 4.1%, and that shows that we're at full employment. And I think that's why they are very complacent about these numbers, and they really want to attack the inflation issue first. But for me, the lack of job creation also means the lack of income creation. And even though we have hopes that productivity will be raising real wages of workers, it's the workers that don't have jobs that I worry about. And that's a growing number of less skilled workers, growing number of people at the lower end of the income distribution, and growing number of young workers. And I think that the fact that it's harder and harder to find jobs is a social issue that will come home to roost in the election. And I think that's something that the Fed really is way too complacent about because it's so obsessed with supply side inflation, which it shouldn't be because it can't do anything about supply side inflation.
All right. Hi, William. Good morning. Good to see you in. William, I recall you were talking about gold being in a little bit of a bubble territory a couple of months or so ago, and gold has gone nowhere. In fact, gold has seen a bit of a dip. Now we're seeing a bit of a spike up in gold. It's recovered from that sub $4,000 odd to around $4,300. What's your view on gold right now? I was looking at a UBS note. They're talking about it going back to around $5,000 levels. Your view on gold?
I hate to sound like a broken record because every time you ask me this question, I keep telling you I'd rather buy shares in India rather than gold. And so for those of you who actually bought gold against my advice, I would advise you start selling and buy some good Indian shares because I think that's a hell of a better alternative than gold is right now in the longer term. Now, of course, I will stay with my original answer, which is I'd rather buy AI shares in the United States. But if you really insist on having emerging market exposure and you don't want and you want to take advantage of your gold profits, I start buying some good Indian shares and good software companies that have some legs into the AI trade.
All right, we'll leave the conversation here. William, always a pleasure. Thank you very much for joining in and highlighting that one needs to also start tracking the corporate debt, except from the non-financial space in the US. That is an important watch point going ahead. Let me tell you the interactions lined up on the show today then. So first up, 8:35, the management of Keynes Tech will talk about Q1, 9 a.m. Jayant Kharote of Axis Capital will talk about RBI's proposal on revolving credit, MDR on UPI, SBI numbers and more. 9:20, Sandeep Bhatia of Macquarie Capital will be a market master for the day. 9:30, the management of Hitachi Energy will chat with us. Following that, Titan will speak to us at 9:40 and then another earnings conversation at 9:50 with the management of Oil India. Following that, BEML will chat with us about the Q1 numbers, and towards the end of the show, Crystal's Krishnan, Sitaraman and Vineet Jain of Care Edge on the NBFC sector as RBI bans revolving credit. So, action-packed day, lots of earnings conversations.
Well, that's right. We'll slip into a short break. On the other side, we go full tilt on stocks that will be reacting to various news flows. For the time being, I give you a sneak peek into the list. Titan, Hitachi, Oil India, Ramco Cements, Keynes Technology, Apollo Microsystems, as well as Ekums Drugs. All of them will be reacting to positive news flow, while you have PFC, Delivery, and Ola that will be reacting to negative news flow.
Welcome back. The Q1 earnings season has entered its final leg, and this morning, as we start off this week, there's so many earnings to track from the weekend. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, guys. Busy weekend. Manglam, why don't you go first? Good numbers from Titan?
Sparkling set coming in from Titan this time around, and this is notwithstanding three important things. One, we already knew the top line. Secondly, there has been an element of exceptional in the EBITDA, and thirdly, the stock is very near its all-time high. Adjust for all of that, and despite that, it is a sparkling set. Revenues at around 18,100 crores. The poll doesn't matter as much here because there is also the element of gold ingot sale that the company does. But if you look at the EBITDA, 2,564 crores, this compares the poll of about 2,000 crores. And you have the net profit, which has come in at 1,700 crores. Our poll was close to around 1,250 crores as well. Now, the company is recognized about 386 crore as realization due to the customs duty increase. So even if you adjust for that, the EBITDA is 2,157 crores, which is still higher than our poll of closer to 1,980 crores. Same-store sales in the retail business has grown at around 33%. Average ticket size has increased by 31%. Buyer growth at 5%. All these things are extremely strong with a slightly increased jewelry market share as well. Add to all of this, you have the management, which has committed to double-digit growth in the jewelry, and a large part of it coming in from buyer acquisition and market share gains. They continue to maintain 11% jewelry EBIT margins with potential improvement in the second half of this year. And at the same time, they say that competitive intensity, while it remains elevated, it hasn't materially worsened. All these things point just towards one thing, that's green.
Got it. All right. Thanks a lot for that, Manglam. Well, let's hop across to Ananya. She's tracking PFC. Morning, Ananya.
Good morning. So yes, they reported a mixed quarter. Why I'm saying this? Because if you look at the headline profitability, it is holding up, but the underlying operating trends remain soft here. PAT grew 5.4% year on year, even as NII declined 4%, reflecting pressure on lending yields and margins here. Now, the biggest weakness was growth, also because of the rundown of its RBPF book. Disbursements fell 44% year on year, while the loan book grew only 4% year on year and declined nearly 2% sequentially, impacted by elevated prepayments and seasonally weak first quarter disbursements here. Now, management expects this disbursement momentum and consequently loan growth to improve in the second half of the year. Now, margins also weakened with NIM down 28 basis point quarter on quarter and 38 basis point year on year. Now, the key positive was asset quality here. The asset quality is holding up with gross stage 3 improving sharply year on year, net stage 3 remaining very low, and PCR staying strong at over 86%. But a lot of things to watch out going forward for PFC here.
All right. Well, thanks very much, Ananya, for that. Vinny is here with the numbers from Hitachi Energy. Vinny, take it away.
Hi, so strong set of numbers that's coming from Hitachi Energy. Again, beat on all the fronts, whether you look at profits, margins, or the revenue of the company. Revenue growth of 69%. Margins have seen a 400 basis point expansion this time. Also, in terms of order book, also they managed to see a good growth of 26%. Last time, the base order, obviously, they had a big HVDC order. So excluding that, they've seen this 26% growth in terms of the order inflows. 5,000 crores approximately is what the order inflow stands at. They've secured that first BESS order as well this time. Highest ever order backlog that the company has seen of around 30,000 crores, which is up 10.6% versus last year. Now, apart from that, they had given the commentary was quite positive in terms of the con call as well. And post that, we've seen brokerage upgrades coming in. Axis Capital has upgraded the stock to an add from a previous reduced rating. Target prices revised upwards as well to 35,159 rupees versus 32,470. Jefferies too is retaining the buy, raised the target price to 45,790 rupees per share. PL has upgraded the stock to a hold rating from previous reduced rating. Target price upgrade coming in here as well. ICICI Securities too has upgraded the stock to a buy, revised the target price upwards to 40,000 as well. So positive for Hitachi Energy, and despite the run up in the stock, maybe we'll still expect to see some bit of a green on the screen. Given
Today's target price, Vinny, is even higher at 46,700 on Hitachi Energy. The only thing to bear in mind is the valuations. The stock is currently trading at more than 50 times FY28 PE, and according to Goldman Sachs, 36 times FY30 PE. So they've got a neutral call because they believe these valuations capture the upside. But thank you very much for that. Sonal now joins in for more on Oil India. Sonal.
Well, good set of numbers. ONGC did that, and Oil India as well, because of higher crude prices Revenue up 33% on a sequential basis. EBITDA more than doubled to come in at 4,084 crore rupees. Margins did well as well at 51.3%, and profits were up 60% for the company. Crude oil realizations were up 49% on a YY basis, 27% on a sequential basis. If we talk about the consolidated numbers, their Numaligarh refinery did very well because GRMs came in at $35.95 per barrel. And oil and gas production this time around was up 2% on a sequential basis and 4% on a YOY basis. Company says in the quarter gone by, on one of the days, they achieved highest ever daily crude oil production at 10,921 MT. That is around 84,100 barrels. So going with Green or Oil India, and we'll also be speaking to the management today. So we'll get some more clarity on the guidance as well.
Got it. All right. Thanks a lot for that, Sonal. Going across to Manglam. Manglam, tell us about delivery.
Well, for delivery, it was a mixed set, and I'm going with red for the simple reason that operationally it was a challenging quarter. If you look at the overall performance, the revenue growth was fairly strong, 28% growth on a year-on-year basis, but the EBITDA actually declined by about 4.5%, margins compressed as well, and the net profit from 91 crores, obviously on account of higher depreciation and lower other income as well, saw a bigger collapse from 91 crores down to about 32 crores. But the express parcel shipments were up 55%. Part truckload freight tonnage was up 18% as well, and the company is guided for 20 to 30% volume growth in their express business, and they target about 18 to 22% volume growth in the part truckload business. So while I'm going with an opening in red, there may be an element of recovery later because the management guides for improvement in the margins coming by, particularly in the second half as well. So let's see how the street takes a good top line with near-term problems in the margin.
All right, Manglam, thanks for that. Well, Ramco Cements, going with the green on this one. The numbers were as weak as what the street was working with. So the revenue numbers more or less in line. The EBITDA number as well, bang in line with what our poll drew up. The EBITDA number, well, on a year-on-year basis, it was down. Though on a sequential basis, it was more or less flattish. But there are some good news out here. One is that the volume growth came in at around 12%. Remember, the last couple of years, they've been growing at just around 2%. So that's good to see. Utilization levels as well improved mildly. On a sequential basis, I think it went up to around 70% or thereabouts on a year-on-year basis, from around 68% to around 70%. And the smaller part of their business, which is the construction chemicals business, which the management has been very, very positive on, over there, the volume growth was close to around 13%. Net debt number remains more or less stable at around 3,900 crores, and they have indicated that all the non-core assets is what they're looking to sell. In addition to this, there is a report that suggests that maybe there could be an amendment on the MMDR bill. Currently, they are paying royalty on the limestone that they use in Tamil Nadu. If there is some relief on that front, well, it could be substantial for Ramco as well as the other players who have limestone who use limestone from Tamil Nadu. For the time being, going with a bit of green on Ramco Cements for today. But hopping across to Hormuz, Ola Electric, how are the numbers? And I think there are a couple of not too good news for shareholders, I believe.
Well, numbers on the first site look that they have improved on a year-on-year basis, but then there have been concerns that have been flagged by the auditors of the company. The losses have narrowed from last year. EBITDA loss too has narrowed from last year, but the revenues are down 45%. Almost the top line is almost halved from last year. But the bigger concern is the fact that the auditors have flagged an issue here. They're saying that the company had reversed a 57 crore penalty provision for missing a battery scheme deadline, and they had sought an extension in the deadline to meet that, but the formal waiver from the Ministry of Heavy Industries was not received yet by the company, and yet they went ahead and reversed that provision, and no new provisions have been made for the June quarter as well. And therefore, the auditors have said that they have not been able to verify whether the provision reversal was justified or not. So therefore, going with red on Ola Electric, also because of the fact that from its record lows of 20 rupees, the stock has almost doubled in value.
Thank you very much for that. And for more stocks and news, Vinny joins in.
Hi, so first up we'll have Kaynes Technology. A good quarter, revenue is a beat that's come in here, but we're seeing the gross margins of the company that has declined, and that's contracted to 34.4% versus 41%. Now in the con call, the management is also saying that the gross margin compression is likely to continue in FY27. Could be a tough year, but versus peers, they expect to still do better than that. Now EBITDA margins also 15.6% versus 16.7%, so contraction coming in there. Profits of the company are down by 24% and mainly dragged by higher taxes, lower other income as well as higher depreciation. These are the factors that is impacting the profits of the company. Order book, that's standing at 8,900 crores, which is up 20% on a year-on-year basis. Average cash conversion cycle, that's coming at around 163 days versus 122 days. So that's a bit of a negative that we should watch out for. But we could see some bit of a green. Do not forget the stock has run up in the last 1 month itself. Because of the cash conversion cycle and some bit of a commentary coming in the con call, we could then see it later on move to the red as well. We have Apollo Microsystems, that's also in focus. Good numbers coming in from the company, but margins are something that are under pressure. The company has given a guidance of FY27 revenue growth coming in at 40 to 45%. Margins are down by around 900 basis points. Why? Because of higher material costs as well as other expenses, and higher base of margins is the factor that is impacting them overall. Material cost was up by 60% on a year-on-year basis. So that's the reason that we're seeing a decline in terms of margins. Lastly, Akums Drugs, that's the one you should watch out for as well. Green expected here, 14% in terms of revenue growth. Margins are coming in at 15% as well. This is the best margins, EBITDA margins, that I'm seeing in the last couple of years for the company. Profits of the company have seen a growth of around 57% as well. So let's watch out for this one. As of now, we're expecting green for most of them. Gains maybe could see a bit of a red later on through the day.
All right. Well, thanks very much for that, Vinny. Well, as she said, we'll check out the reactions as markets start to trade. But Manisha is for now joining us with everything in terms of action from the commodities space. Manisha, take it away.
Thank you for that, Prashant. I'll start with the precious metal prices, where we've seen the gold prices gain up by 7% in the previous week, and silver has gained up by 10%. And in the Asian markets right now, we are looking at follow-through buying, and that is because of the unexpected contraction that we have seen in the U.S. labor market by 23,000 jobs therein. Also, the markets are pricing in a less than 50% chance now of 25 basis point rate hike in September. This is much lower than 70% in the week ago. The gains have continued for the base metal prices also. So whether it's about aluminum, zinc, and copper, all of these metals are trading on the higher side. Copper, remember, hit an all-time highs in the previous week, and the markets are trading very close to those levels right now. There are inventory and mining concerns, and that in turn has been supportive for copper. And finally, for the crude oil price as well, it's a third straight day today that we are looking at gains continuing here as well. Previous week was an 8% decline, but the support comes back because of the uncertainty over efforts to reopen the Strait of Hormuz. There also are concerns about Saudi Arabia's Jazan refinery, and most of the broking houses, including Citi, Goldman Sachs, are now talking about higher prices in the third quarter for the Brent. So 80 to 85 is what we could be looking at in sense of prices as an average in this quarter.
All right, Manisha, thank you very much for that. So that is oil in focus and top of mind as far as commodities go. We'll take a break. We are back in just a bit from now. We'll have the management of Keynes, Ramesh Kunikanan of Keynes joining us to talk about the numbers which Keynes has reported and the outlook going forward. Stay tuned, coming up.
Welcome back. As promised, let's get straight to the management of Kaynes Technology. That's the first management on the show. To discuss the outlook from year on, we're now joined by Mr. Ramesh Kunikanan, the Executive Vice Chairman at Kaynes Technologies. Hi, sir. Good morning. Good to see you in. Thanks a lot for joining in. Well, you're focusing more on your core EMS business, though your OCF, that's your operating cash flow, still remain negative, though it's reduced. A couple of questions now with regard to the guidance outlook for FY27. Do you stick to the 30% revenue growth guidance, margins at around 17%, and will operating cash flows turn positive for sure by the end of FY27? 3 points: revenue growth, margins, and cash flows. Please go ahead.
As far as revenue growth is concerned, we are seeing good headwinds, and there are many products which is in the development stage. So we are very confident more than the market we will grow.
Would that mean 30%?
Yeah, around that number. 30%. This time done around 40%. We should grow 30+%.
30%. And margins will be around 17%.
Margins, we always have told it will be around last year's margins. And we are very confident of reaching there. This first quarter, there are too many turmoils, material availability as well as dollar fluctuation, which all amounted to a small drop. But I am overall in the year, we see that margins will be around the same number.
16%, 17% or thereabouts. And the third part was the operating cash flows. You turned positive?
Operating cash flow, we have improved a lot. And I'm sure in certain next quarter also, you will see a lot of improvements. And further, by the third quarter, we should be positive.
Okay. And working capital, sir? Working capital days at 163. As operating cash flow turns positive by the end of FY27, what would this number stand at?
This we are planning around 100.
100 by Q4 FY27.
Yes.
So on the good morning on the OSAT and PCB timelines, I think that has been pushed out again, right? You mentioned some upheaval and all the. I think that has led to this being pushed out. So end of this year?
No, it has not been pushed out. Our trials are taking a little more time, so it is getting pushed by 1 quarter. But otherwise, it is going as per schedule. We have enough challenges, but we are overcoming one by one, and then we are very confident next quarter we will be there.
You mean you mean October to December?
Yeah, October to December.
You'll start operationalize.
Yes, yes. We will be doing commercial building, and we'll.
And overall, from these two businesses, lines of businesses, revenues, what should we expect?
We have committed around 250 crores from each business.
So about 500 in total.
Yes. And we are very confident of achieving that because customer pipelines are there, trials are going on. So with this, we will be very confident of achieving that.
So on smart metering, you're consciously bringing down your revenues from smart metering was down 12% year on year. So it's broadly around 200 crore on a quarterly basis. And you plan to de-risk your business. What are we expecting? What should we expect from smart metering as the year progresses? And what is de-risking going to look like?
We are going to be a meter manufacturing company, and we are planning to do the rest of the part, installation, commissioning, and long-term billing to another company. With that, we are very confident our working capital cycle, everything will come down. The work is in progress, and that also I am expecting by end of third quarter to have a definite shape.
And revenue, sir, from smart metering, will they continue to decline as this business gets realigned?
Naturally, because we will be only making metering as a business. So naturally, it will come down.
So what's the quarterly run rate?
We are very confident that our EMS business is growing at a very high speed. And going forward, we will have next 2 to 3 years, we are seeing very good upward towards EMS business. So
what will be the quarterly run rate now of the smart metering business?
Around 200 crores is what we are planning.
Okay, so it should stay at this level.
You know, sir, when I look at your smart metering business, as you mentioned, I think 60-65% comes in from the EMS part of the business, right? And the remaining is installation and servicing. Is that correct?
Yes.
Now, when you're reviewing the business, you could be looking at selling out the entire smart metering business, or will you all be looking at selling the 30-35% of the business, which is into installation, servicing of the smart meter business? Because that's part of your rejig plans. Is that correct?
It is too early for me to comment on it, but our plans are working out to be a meter manufacturing company and shell out only the 40% part of that.
Correct. So you'll be looking to divest the remaining portion of it, right? Sticking to the...
Yes.
By when can we expect this decision, sir?
By third quarter, this also should be online.
Okay, so we'll be waiting for part of the smart metering business, which is into installation and servicing. That proportion could probably be divested, and we'll know in the next couple of quarters. Yes. Just one point, sir, if I look at your line items, wouldn't want to nitpick, but I look at your depreciation as a line item, that's come down to around 36 crores from around 55 crores on a sequential basis. Any particular reason for this? Because it's a very sharp dip, and some part of the sell side as well was wondering, how did this happen?
No, quarter on quarter, we have only 36. But here, what happened, the entire year, we have taken the one portion of the depreciation. But hereafter, it will be quarter on quarter we'll be taking.
So what will it be on a quarterly basis, sir? Because if I look at quarter 4, it was 54 crores. That number has come down to around 37 crores.
Correct. But this year, overall, our depreciation will be around 160, 170 crores.
Okay. All right.
Okay. Mr. Ramesh, thank you very much for joining us. Good speaking with you, sir. We wish you all the best of luck.
Thank you. Nice talking to you too.
Thank you. Thank you very much. We'll take a break. We're back with some action from Friday. What happened? So Hormuz will help us with that. Devin also will be with us on markets and some of these stocks. Coming back in just a bit. Okay, welcome back. There's 15 minutes to go for the pre-open session. Let's focus on some of the stock action from Friday. Hormuz is here with that. Hormuz, take it away. Morning.
Morning, Prashant. And the striking point of Friday was the fact that the turnover from the cash session was possibly the lowest among all the 5 sessions of the week, around about 1100 crores. What was the turnover on Friday? And none of the stocks again made it to that 100 crore mark. You look at HDFC Bank yesterday, that the highest among those was only 70 crore is what, and most of them also ended round about their reference price itself. And if you look at the only highlight that came in was Hindalco, which made an entry into the top 5. Closed above its reference price, and a turnover was close to 40 crore as well. You look at some of the movers on Friday beyond the cash session. Siemens Energy, of course, was one of them. The stock ended over 12% higher, ended at record levels. The 80 lakh shares were traded on Friday. The 20-day average is only 4 lakh shares. And on the delivery front, 14% of those shares were marked for delivery. So around about 11 lakh shares for delivery. The 20-day average is less than 2 lakh shares. Now, Samvardhana Motherson was another name that ended at record highs on Friday. The stock was up 9%. 11.5 crore shares were traded, and the 20-day average is just under 2 crore shares. And a quarter of those were marked for delivery. So 3 crore shares on the delivery front. The 20-day average is just over 80 lakh shares. And an underperformer on Friday was Bajaj Finance. The top losing stock on the Nifty was down around 6%, or well over 1.5 crore shares were traded just above its 20-day average. And on the delivery front as well, close to 60% of those shares were marked for delivery. So close to 90 lakh shares marked for delivery. The 20-day average is around about 55 lakh shares. So significant delivery buying seen in Samvardhana Motherson and Siemens. Bajaj Finance being an underperformer on Friday.
Okay, all right, Hormuz, thanks very much for that. Bajaj Finance, let's just put the stock up. It was a 6% cut coming through. And the RBI draft circular is pretty meaningful. It's a draft one, but flexi loans under scrutiny, and just another segment of loans which Bajaj Finance, of course, is pretty big in, is loans against shares. Is that also come on? There's some fears that perhaps this covers that as well. So that's another large chunk. More downside here. Stock's done well coming into the results, which were good, and out of the results as well. But this, of course, is a bit of a setback. But as I said, this is all draft. We'll have to wait for the final regulations on this one. Devin Choksi is with us, MD and DR Choksi, FinServ. Devin, good to have you with us here. Thanks very much for joining us. What's your sense? Till the time this circular, sometimes what happens is when you announce something and between the announcement and the finalization, it's kind of a bit of an overhang, right? And stock continues to underperform. And then once it's out, you know one way or the other. Bajaj Finance, what's the view?
Yeah, Prashant, good morning. Well, I think on the face of it, the impact I think might be seen. But however, we'll have to see how exactly operationally the companies would probably start putting their activities in order. Or maybe I think some amount of the product differentiation will have to be created in order to, I think, meet this particular requirement of RBI. Not completely sure as to how exactly these companies would probably plan it out. But as we understand, some of the larger NBFCs like Bajaj Finance will have a better handle to approach the subject and probably clear. At this point of time, I think we go with the circular. I think we don't have any particular view on and also the impact analysis done on any of the companies working. So we just, I think, want to field one at a time at this point of time.
Okay. So, no, fair enough. But, it's, as I said, is meaningful, and we'll get you more opinion from analysts, etc. I think we've got a banking analyst joining us a little later. Devin, the MDR bit, right? We heard from the government saying, well, nothing on customers for certain merchant transactions. I'm assuming for higher ticket size UPI transactions, there could be an MDR charge. So your thoughts on the names there? There's, of course, Paytm. I think there's a big upgrade from Bernstein on Paytm this morning. There's Pine Labs, there's MobiKwik. Anything you like here?
So the B2C segment is having a good amount of clarity. No charge is levied onto them, and as a result of which customer is spared from paying that particular cost. However, in the case of B2Bs in particular, I think you might be seeing some amount of cost being paid. by these merchants. And that's where probably I think we'll have to be a little bit watchful about, I think, how exactly the impact comes. But to me, I think it is not disrupting the entire way of working as far as the UPI is concerned by many of these companies. And that's where we don't see negative outcome coming out from this MDR business. We continue to believe that I think most of these companies are likely to grow better than before, largely because the volume of transactions are increasing in UPI, and I think continue to have better profit performance in the books. So can't say much about the valuations at this point of time. We do believe that I think everything is in price for most of these companies, at least at this point of time.
Got it. Hi, Devin. Good to see you in. Devin, we just had a discussion with Keynes Technology. The management sounding confident, one would say, yet again, with regard to the growth, margins, as well as operating cash flow turning positive. What's your view on the company? They're trying to reinvent themselves. Earlier, they were focusing on EMS. Then they diverted a little bit. They went into smart metering, which dragged them with regard to receivables as well as growth over there. But now they're looking at reinventing themselves. At current valuations, what's your view? So the stock has run up 15-20% just in the last 45 days.
I guess I think, good morning, Nigel. I guess I think they have clarified which is more important. And if they run the course, probably, then one can remain relatively more hopeful that I think they will not derail the business model to an extent. I think we want them to continue with. As far as I think the valuations are concerned, you are right. Actually, I think most of it is in the price. So not too sure whether I think one would like to buy immediately. But yes, I think this kind of businesses, they do offer opportunity during the corrective times. And that's where one would like to buy them into the portfolio.
Any other earnings which stood out to you, Devin? I mean, it's a steady flow, right, which has come through. On Friday, we were talking about this small company, electronics Mart of India, EMI, which reported numbers. Stock went up sharply, some 20 to 25 bucks. There was a call later, and I think there's a guidance raise, and I mean generally stronger upbeat commentary. I mean anyway, next 2 quarters are better for electronics retailers. I mean festive season and all of that. I don't know. I mean it's that's one. But anything else you have a view on, Devin?
Yes, I think some of the larger ones like Britannia Industries, I believe that I think have given a very positive direction. They are talking about increasing the price in this particular festive season as well. So that promises for around 15% odd kind of a growth in the earnings going forward in the subsequent 3 quarters of the business. Company looks reasonably positioned currently, having corrected on the price. I think so. Looks I think relatively better. And then earlier in the week before, we saw the AGMs and the presentations outcome coming in from companies like Bajaj Housing Finance. We find that housing finance business is picking up very well. In fact, I think in these times, we are seeing a good amount of demand for some of the premium to luxury and ultra luxury segment housings. And that's where some of these companies are relatively better placed. We believe that I think the price is attractive enough for companies like Bajaj Housing Finance, and given the kind of growth projection that the company has made, we find that I think business looks relatively more robust, downside limited, and opportunity is there for the upside.
Got that. Just one more area, right, which I think we should get some attention. I mean, the life insurance numbers for the month came through on Friday. And I think we have the data. Maybe we can pull it up. So the two strong numbers were Max Life, Max Financial Services, and SBI Life, which was pretty strong as well. In the insurance space, life insurance specifically, any thoughts, Devin, anything you like?
Yes, I think including LIC, the numbers have remained quite strong, and I think that's a fundamental point because amount of money which has been left in the hands of consumers by way of tax saving were supposed to go into the investment product along with the discretionary, non-discretionary spending. So within investment products, we are seeing continued inflow of money into the mutual fund, of course, but more importantly in the insurance segment too. I think we are seeing the higher amount of new business premium continuing for many of the insurance companies. And I believe that most of these companies have probably on a embedded value to EBITDA have remained in a very, very muted levels, I think, for last 2, 3 years. Given the kind of valuation advantage that you get because of the downside is limited and the new business premium is improving, we believe that I think some of the larger companies will definitely have better times going forward. Maybe one would not expect, I think, very dramatic upside, but around 15-20% kind of upside over a 12 to 15-month period is distinctly possible in some of the insurance businesses.
All right. Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure, as always. We'll take a break. We are back. We'll get you some technical trading ideas on the other side. We'll also, of course, focus on financials, and Jayant Kharote of Access Capital with us on whether there's follow-through to be expected on the SBI numbers. Stock went up. I mean, there's a bit of up and down, but it was up finally. Of course, also, as I was just discussing with Devin, Bajaj Finance and RBI's proposal on these flexi loans. So all of that in a bit.
Welcome back. We closed last week with the Nifty around the 24,570 mark, but the high that we hit was on Monday of last week, which was 24,774. So the ultimate close was about 200 points below that, but it was still a positive close for our markets last week, the second consecutive weekly gain. This morning, that's the pre-opening rates coming in. Early rates are positive, 175 points. We'll let them settle in. In the meanwhile, let's find out what the trading approach should be. Our experts join in, as always, bright and early. Sudarshan and Mitesh, thank you very much for joining in. Sudarshan, why don't you go first? If there is a gap up, as the pre-opening is suggesting, what should the trade be?
Good morning.
I don't think this is just early days yet. But if there is a gap up, you do nothing at all. Do not chase that gap up. That's a big if. If the market opens flat, which is what the GIFT Nifty is suggesting, then also there is no trade in the Nifty. Because remember, we have rallied from 23,600 to 24,600. That's a 1,000-point rally. The Nifty has this tendency of rallying, consolidating, then taking a new trend. So we are in a process of consolidation. The trade here is wait patiently. If you get a dip in the Nifty, because the trend is up, buy the dip. It's difficult to define the dip, but broadly somewhere around 24,400. In that zone, if the Nifty slides there, that's a buying opportunity. But do not chase any gap.
Okay, don't chase any gaps and be patient out there. The rupees, by the way, started trading as well. We've got the first rate starting to come through on dollar rupee as well, 95.17. It is absolutely flat at this point. Mitesh is with us as well. Gentlemen, morning. Mitesh, what's your recommendation?
Good morning, Prashant. So I've been maintaining that the market can still inch higher to about 25,050 to about 25,100. And a strong support comes in around 24,400, 450 zone. So I think I'll maintain that. While I agree with Sudarshan, it's not a market which is showing signs of roaring or a strong up move. But the drift is on the upside is what I believe, as all the short-term 10, 20, 30-day averages are rising. So buying on declines could be a good strategy in this kind of market, which is now showing extreme momentum, but it is trying to make higher highs. So as I said earlier as well, 24,450 broadly is my buying area, and keep a stop over 30, 40 points before the 24,400.
Yeah. What about individual trades, Mitesh? Why don't you go first?
Yeah. So on the individual stock side, I have three buys. Geo Finance, which had a breakout last week, is actually declined on Fridays back the breakout level. So this could be a pullback move, as all the other indicators are positive. So buy with a stop at 251.5 for targets of 267. CanBank is a buy with a stop at 128 for targets of 140. Then I also have a buy on APL Apollo. I think it was a recommendation last week as well. Still showing signs of continuing its up move. Buy here with a revised stop at 1945 for targets of 2020. And one sell call, that's Axis Bank. Sell with a stop at 1257.5 for targets of around 1200.
Sudarshan, what stocks would you go with?
I'll go with BEL. Buy BEL with a stop under 395. Buy Bandhan Bank with a stop under 170. GMR Airport is a buy with a stop under 105. I also have only one short sell, that is Tata Consumers. Keep a stop above 1105. But yeah, the chances are that mid caps would still do well even if the Nifty is flat.
Gentlemen, we'll come back to you. Thank you very much for that. Let's talk about State Bank of India. Came out with numbers on Friday towards the close at about 2 o'clock. Strong set of numbers. Loan growth 19%. NIMs expanded. Net interest margins contrary to what we saw with private sector financials. Asset quality contained. Net profits up 10%. In fact, did well on most of the parameters. SBI Chairman C.S. Setty, listen into what he had to say about the outlook going ahead.
Numbers, what you see now are a conscious effort in that direction. And whatever numbers you mentioned in terms of outliers, I think they're not outliers at all. The overheads uptick sequentially will always be there. And on the year on year, I think the overheads are contained. And what are the standing out numbers are in terms of our a proactive adjustment in our cost of resources. I think we focused on containing the costs. It's almost 7 basis point reduction. That really helped us in terms of ensuring that in a very difficult market conditions, margins are protected. And we also have a fair idea in terms of what is going to be our FCNRB trajectory in the Q2. So we have proactively reduced our bulk deposit. We have given a 12-month, the full year guidance at 3% NIM. I think we are still standing by that. And we have a pipeline almost more than 3 lakh crore as we speak on the corporate side. So that gives a good visibility in terms of growth rate. But I also linked, Ritu, if you remember, that our growth rate guidance on the credit side is essentially linked to the GDP growth rate. If nominal GDP is 12%, the SBI consistently has been growing 2 to 3% more than that. So the guidance is based on that.
Jayant Karote, Executive Director Banks at Axis Capital, is now joining in. Jayant, good numbers. I think the only miss perhaps or complaint could be on the deposit growth at 10%, lagging the loan growth by nearly 9 percentage points and weaker than what peers have reported, like an ICICI Bank or Axis Bank. What's your view on the deposit growth reported by State Bank of India, and what are the numbers that you're working with for the rest of the year?
Good morning and thanks for the opportunity. Firstly, just a disclaimer, I wouldn't be able to comment specifically on this bank. Sometimes we have certain restricted lists and other factors as well. But from a broader sector perspective, and PSU Bank's pack has reported slightly softer deposit growth through this, and this is probably a phenomenon that's been happening over the last couple of years. I would say accelerated in the last couple of quarters. So it isn't really a surprise per se. Banks are being more tactical with deposits right now, given the NIM pressures. Of course, the largest bank has the ability to be tactical. Can't say that about the rest of the PSU lot.
Do you want to tell us then the overall read on the earnings season and what would be the top picks after that?
So this earnings season is, in a way, a very good precursor to the very strong earnings momentum for this year. In fact, the earnings growth at nearly 16%, we feel is actually masking much stronger underlying trends. Because if you look at the core PPOP growth, the core operating profit growth, that is nearly 19%. And the reason we are seeing slightly lower earnings is because treasury profits are lower this particular quarter. But if you look at even below core PPOP, the credit costs are down YOY almost 40%. So our view is the underlying core earnings growth is north of 30%, but of course on a weak base. But for the full year, this sets up, I would say, a very strong earnings momentum. Last 2 quarters, we have observed this building up. One particular thing to call out this quarter specifically is the NII growth. After nearly 8 quarters of single-digit NII growth, we have had 12% NII growth, which means that these earnings look sustainable heading into the rest of the year.
Okay, I just want to quickly, Jayant, stay with us, but the pre-open has started and there's lots of stuff which is moving around. Maybe just want to take a quick look at this. The Keynes management was with us. Keynes is down 10% in the pre-open and 8.5% now. So it'll settle, but I think, or has it already? Yeah, I think we've settled in about 8.5% down. So the working capital issue and 163 days. The guidance is 100 days, and of course, I mean the OSAT thing has also been pushed out. Although they said well it's been just delayed by a quarter. So those are the things which the market seems to be focusing on. The fact that of course stocks run up a little bit in the last 1.5 2 months or so as well. Just look at Paytm if you can. Where is that settled? Paytm and Pine Labs and MobiKwik, those names. So Paytm is starting flattish. Pine is starting flattish. Nothing. MobiKwik is the other one which will come up as well. So it's generally a kind of subdued sideways kind of start. Jayant, I want to ask you about this MDR bit as well. But before that, there is the issue of this flexi loans, the draft circular, draft regulations which the RBI come out with, stopping this flexi loans from NBFCs, revolving credit. What is the impact? I mean, I don't know if you can comment about Bajaj Finance. Stock was down 6%. If you can't, but just talk to us about how serious is this?
Yeah, so I think from a systemic perspective, the loan book size may not be significantly large. Of course, the problem is specific to a couple of players over here. The idea, of course, RBI has been nudging or hinting at some domains which are specifically given to banks. Revolving credit is one such. So I would say it's a little bit more clarity that the RBI has given before these book sizes become outsized in the system. We have seen some fintechs also get into some of these products in the past. RBI was quick to react back then. In fact, I would say the timing could be very interesting because one of the things we are observing at a system level, and maybe if we do discuss this credit cycle at length, is the resurgence of some of the products that let's say are a little bit on the fringe of the regulatory setup. We are still getting regulated, and digital players are of course at the forefront of innovation. So I would say RBI is giving clarity much before any outsized issue could be disruptive at a later stage.
But do you think this will, one is the final regulations have to come, but after that, you think it's possible you get one, like a NPA cycle here in this segment? Because lots of people would borrow, and the thing is, well, you know, it's 4 years, 5 years out, I'm going to repay it, maybe by, borrowing from elsewhere or whatever. I mean, I'm going to have, but suddenly you can't refinance it. So you think, I don't know what that date is, but you think you should see a spike at some point down the line?
No. I think it's not that big an issue at a systemic level, as I keep saying. And one thing we have to be very cognizant is where we are in the credit cycle, and is access to credit a challenge today? I think definitely not. We are pretty much just 4 quarters into this credit cycle.
No, I didn't mean from a systemic standpoint, but for specific players like Bajaj Finance in that sense. Yeah, Jayant, we'll leave it there. Thank you very much. Apologies, we're running up into market open, but would love to continue this conversation at a later time. Thank you. We have Nimesh now joining in with the brokerage reports which are standing out to him. Nimesh, take it away.
Hi, Prashant. Today's standout is on Paytm. Bernstein has put out a note. They've actually raised the target price on Paytm to 2,200 from 1,500, a potential more than 50% upside from current levels. In fact, they're incorporating the MDR introduction on UPI transactions as a base case from FY28 estimates. And on basis of that, they believe that this could lift the net payment margins by 3 to 4 basis points, which would mean that the EPS can go up by as high as 30% from FY30 onwards. So that's the key premises on which they've raised the target price. Having said that, they believe that the risk can have shifted from implementing of MDR to how much will be the rate which will be retained. And on basis of that, there could be further competition from acquisition of merchants. And basis of that, the potential benefit could be slightly lower than what the street is anticipating. But if the MDR is implemented, they expect a 30% EPS growth against their forecast. And on basis of that, they've raised the target price now to 2,200 from 1,500 earlier.
Okay, well, that's the call of the day. Look at Hitachi as well. Hitachi is up about 7% right now. Nimesh, thanks very much for that in the pre-open. That's how it's ended. And we'll speak with the management of Hitachi in just a bit from now. Well, let's go to Sudarshan and Mitesh for 9-10 call. Sudarshan, what do you have?
It's GMR Airport. Buy GMR Airport with a stop under 105.
GMR Airports is Sudarshan's call. Mitesh, what about you?
I'll go with the buy on Canara Bank for targets of 140.
Okay, got it. Canara Bank is Mitesh's call. We'll just quickly recap. Gentlemen, thanks very much. The stocks we've discussed from the morning, and we'll give you a quick sense. So Titan, Hitachi, Oil India are some of the stocks which are starting. There's Ramco, there's Keynes, Apollo Microsystems, Akums Drugs, there's PFC, Delivery, and there's Ola Electric as well. Delivery, I think there was a bit of a EBITDA issue, EBITDA miss. So 456 on Delivery, and Ola is down about 3% as well, just under 40 odd rupees or so. I think we're getting we should start to get the first trades shortly, and we will. And by the way, lots of individual smaller companies which have reported numbers at the bottom of the screen, and we'll have those come up as well for you as far as stock reactions are concerned. So just sort of coming up with the market opening in a few seconds from now. 24,581 is where the Nifty is left off, about 10-11 points higher. So no adjustment needed in that sense, right? I mean, because if you look at Friday's cash session, it was very, very well behaved and in a very, very tight range, so nothing outlandish. Well, what do we have? 24,587 on the Nifty. You got the Nifty Bank, which is, I think, just about starting, and we will see where that lands. Small cap index is starting flat, slightly lower though, and the mid cap index is about 0.2% higher. Nifty Bank, by the way, is doing well. And is it a State Bank of India? Well, let's just look at SBI straight up. and should give you a sense of whether this is SBI. Well, not really. 1%, 10 rupees, 11 rupees on SBI. Nifty's sort of almost unchanged, 5, 6, 7 point change. So just finding its feet in that sense. Nifty heat map gives you a sense of what the 50 stocks are doing in a snapshot sense. And SBI is the biggest gainer, but with a 1% pop. ICICI Bank and Infi, TechM, etc. are behind there. L&T is the top loser, followed by Titan, Ultratech. But these are all small moves. I mean, they're just on both ends in that sense. But only about 2 or 3 points to show for it within the first 1 minute of market open. Rima.
Well, Keynes is your biggest loser. That's down 7% straight away at open. The top line growth is strong at 40% ahead of estimates, but the street is concerned about the operating cash flow being negative and the surge we've seen in working capital. Though the management guidance is it will come down from 163 days to 100. AB Fashion also under pressure reacting to numbers. That's down nearly 5%. Apollo Micro, Cello World are two of the other names. Again, negative reaction to the numbers. On the way up, the star is clearly Hitachi Energy. Stock surging to 34,500. It's a 6% gain on that, taking its year-to-date rally to nearly 88% now. In terms of the large caps, Titan is seeing some buying, so 1.5%. As Manglam said, sparkling quarter, and it's a fresh 52-week high on Titan, crossing the 5,000 rupee mark. SBI sees a continuation of buying from Friday, so another 0.5% at open. And some IT stocks are seeing buying today. Tech Mahindra, Infosys in the green, while private sector banks like ICICI, Kotak Mahindra Bank open in the green too. On the way down, Ultratech, Bharti, Hindalco, L&T, Eicher Motors, Asian Paints are some of the drags.
Well, that's right. Keep an eye on a couple of other names from the broader markets. Actually, Jamna Auto, that stock I think is getting a hard knock in today's trading session. That one should come up for you on the screen. It appears that the street is a little bit disappointed with those numbers. Stock is down close to around 15% or thereabouts. They've laid out an ambitious plan for the coming years, but for the time being, the street is not too impressed with these numbers. So that stock is down. The other one is PTC India. That one as well is down close to around 13%. Add to the list Ola. The troubles don't stop out there. That stock is down close to around 4.5% as we speak. And NLC India as well is down close to around 5%. So sharp downtick is what we're seeing on those names. On the flip side, a few stocks actually are doing very, very well. Sky Gold, the stock is up more than 10%. The street, it seems, like those numbers. So that stock has spiked up as we speak. Good move is what we're seeing out there. Vectors is up close to around 2.5%. So sharp up move out there. Electronics Mart, pull up that stock more than 10% higher. Volumes very, very large on that particular name as well. So solid up move is what you're seeing on Electronics Mart as well. Universal Cables, that one, those numbers look quite good. The revenue was up by close to around 57%, coming at around 945 crores. Much better than some of its peer groups. And also, they have done that JV with a Japanese partner. And now they're expanding their optical fiber capacity by close to around 3 times. So the street likes that, explains why that as well is reacting, on the upside to those numbers.
Okay, well, lots of stuff, right? In terms of individual movers, although it's a bit it's not a crazy screen out there.
BDC, just one correction. I mentioned the stock was down, but I think it's gone ex-dividend. So $20 dividend out there. So I think adjusted.
JSL, I don't know which one is this, 536. It's showing an 11% cut. But we'll just look at this in terms of what has happened. Is Jindal stainless? I'm not sure, but I don't think so. But we'll just check. HBL is down 4%. Raymond Realty is coming up with an 8.5% cut right now. 632 on Raymond Realty. So that's a large cut. Kernex is down 7.5%. Lots of stuff. Chennai Petro is down about 2%. AG's Logistics is down about 2.25%. Ashapura Minecom, Nigel, I don't know if you mentioned, but 10% lower on Ashapura Minecom. So 663 at this point in time. Azad Engineering is down about 3%. So there is, there's a fair bit of move coming through. 1,500 stocks are higher, about 1,200 stocks are lower. So that's a picture overall as things stand right now. Aarti Pharma, I think we mentioned, right? 20% higher on Aarti Pharma. It's limit up. 823 on Aarti Pharma. And it's got humongous volumes. It's the 5th largest volume traded gainer on the NSE. 1.2 million shares traded already. Doesn't come up at all in that way, in that very large volume way. Shilpa Medicare continues its run. Superb numbers, another 4% on Shilpa Medicare right now. Coforge is coming up with about a 2.25% gain. Info Edge is up about 3.5%. Sangvi Movers is up 6%. So Sedimac, the Pune-based auto comps guy, 4% higher, 29.27. Again, has done phenomenally well since listing, basically. Sandeep Bhatia is with us, Managing Director and Head of Equity India at Macquarie Capital. Sandeep, great to have you with us here. Thanks for joining us. Mid, small, that's all. That's the market for you, right, Sandeep?
I agree. Mid-small is better than no market, right? So I think we should be grateful for all the blessings we get in life. So yes, I think essentially what this demonstrates to me is that there was a broader overvaluation in the market. Growth was not as exciting, but actually I think this quarter numbers were much better than expected for both large cap and small cap. Yes, and we've seen small cap, which is easy to run up sometimes because holdings are limited. So we have seen good movement there. But I think broadly, economy and numbers have actually surprised on the upside. That's what the market would definitely believe.
I met someone who's now based in the US, and he was based here, very much here, and he was saying, well, my portfolio has done nothing for the last 1.5 years, and I've got all the top names and basically all large caps, right? But that's the thing. It is not large caps which have done well. But Sandeep, and I think we put this data up as well, lots of large global funds, right? They've really started to go down the list, market cap curve, right? Which was not, in many of these names, which was unthinkable 10, 15 years ago, Sandeep. So there is this realignment which is taking place as well by some of the sort of, highest quality, blue-blooded foreign investors.
Yes, we see that on our trading desk. We see a wider range list of stocks getting traded by traditional long-only FIIs, large holders. I would think there are two reasons for that. The question is the economy expanded, so those names are bigger than they used to be. Corporate governance in the small cap names have definitely improved over a period of time. I would rate in the Asian region, Indian corporate governance actually at the top tier across the board. So to that extent, definitely there is more demand and more appetite for mid-cap, small-cap names. And of course, as we discussed at the very outset, the large-cap names have been slow growing. So yes, a combination of factors, primarily the fact it's corporate governance and expansion of the market cap and economy.
So in terms of the earnings season, I think the strongest has been the autos, some of these consumption names. Do we have the visibility and valuation comfort? Which pocket of the market now are you most bullish on now, Sandeep?
So we do like autos. We've been pushing Hyundai India. We just published a note. We have put Ashok Leyland also there. What makes us like these names is the fact that the consumption growth is strong. Of course, in the near term, we would have the Pitru Paksh or the Shraddh period. So some of the numbers in October, September and October would have an impact. But you have to remember, we'll have the pay commission come through by June next year. So structurally, with the new model launches, there's definitely impact on consumption for discretionary products. Autos will be a large beneficiary. So we like Hyundai, we like Ashok Leyland, and essentially this segment will continue to progress.
What else? Top private sector banks were also some of your favored picks where you all were constructive on. But this quarter, most of the names sold off on the back of margin pressure. Was that an overreaction? And private sector banks should still be a part of your portfolio despite the lack of fantastic returns?
So private sector banks essentially suffer from over-ownership. Everyone knows that FIIs have traditionally been long owning these names. They are also one of the largest portion of the entire market cap in the country. So they are well owned. I would think that both ICICI Bank and SBI definitely look good. HDFC is for value buyers. And we think that HDFC has now bottomed out. So definitely private sector banks and even a large public sector bank like SBI make interesting buys.
Yeah, make interesting buys, and hopefully, price also starts to confirm, the thesis that perhaps this is it's essentially bottomed out in that sense. Did you any thoughts, Sandeep, on this on the RBI circular on draft still on flexi loans? Any thoughts? I mean, Bajaj Finance is the one which was down 6%. What have you heard from clients and incoming, outgoing? What's your sense?
I wouldn't like to comment on a draft note, but I think flexi loans, I think the system is still very strong. So the RBI is being very prudent. So to that extent, that's fine. But, I don't think we have, at least in the large listed names, we have an issue.
I see. I see. What other pockets, Sandeep, in terms of triggers, in terms of things which are set up in a way which allows you to make money from here? What's on the radar?
So we like DVs. That's something which is definitely done well and will continue to do well. In peptides, it has definitely an edge. The management is not the easiest to meet, but definitely this is something which we like. We continue to push that. I think what needs to be seen is how the entire consumer staples universe goes. We've seen ITC really getting hit. We have seen, growth in some patches. Nestle has done well, but but some of the names, things have not been good. I would expect that over the next, 12 months, let's see how consumer staples go. The other sector, of course, is IT. We have seen the entire sector get impacted over the last two plus years with AI. And that is one sector which also is probably going to set the sentiment on India. India is seen to be the top anti-AI play. And if we see some of the froth, which is definitely there in the Western markets, especially the US on AI names, if that comes off, then the tech sector will also come in. I think that's the big delta. If that happens, that would be the big sector to play over the next 18 months. But definitely needs support from the AI stocks in the West coming off.
Is the best of the entire energy, power, transmission play behind us? Because stocks have given very strong returns. Valuations are high. The earnings growth is coming through, but it's a discover theme. So in terms of market returns for that entire data center, electricity, transmission, power equipment, is the best behind us? Or do you all still like some stocks?
So we do like those names, and it's easy to like them, as you just said, because they have done well, and at least the capex plans and the delivery on those has been strong till now. So we definitely continue to like these names. I would just caution one thing, that if this entire AI universe sees a beating in the US, some of these names will definitely take a beating. We have to wait. We have to essentially monitor these very carefully. While India is not an AI play, this sector, especially the parents and the entire theme around the sector, is definitely benefiting from the AI capex, and therefore, to that extent, we have to be very careful.
So tech and this entire power equipment data center play would be on opposite sides of the spectrum. If one does well, the other does not.
Correct.
So should you hedge your portfolio by owning both at the moment?
Well, you should have owned the Power AI now. I would, if I'm an owner, then yeah, we can continue to hold. But these have to be essentially monitored much more closely than in the last 2 years.
Okay. We'll leave the discussion here, Sandeep, a bit out of time, and we've got so many managements waiting by, so we'd love it if you could just stay on and listen to them. So the first one is Hitachi Energy, buzzing in trade today after posting a strong set of Q1 numbers. Many brokerages are also very bullish on the stock. The stock has surged close to about 8.5% now. We have with us Mr. Venu, MD and CEO of Hitachi Energy. Thank you very much, sir, for joining in. Rima here. Let me begin with the margin performance. Very strong margins this time, 15-16%. How much of the improvement is structural versus a product mix? And therefore, what will sustainable margins look like for the company?
Thank you, Rama. Thank you, Rima. And thank you for having me in your show. And as you know that we have started in a very strong note on this financial year. Our revenues have gone by almost 68%, growth of 68%. In addition to revenue, we have very strong order inflows. And the good part about the order inflows is that it came from a multiple segments, not only our traditional segments like renewable and energy, renewable and transmission, but also the data center and the energy storage, etc. in that. But coming back to your specific question on the margin, I think margin is a combination of that. One is the volume effect and also the product mix. And then we have been consistently saying that a lot of improvement areas on the operational standpoint, operational excellence, all those things have played well. And this is also in line with what we have been saying consistently, that we continue to improve our margins in the double digits because we are taking several actions, and those things are in the play, as you can see.
Mr. Venu, we have lots of questions about the business gone by, the quarter gone by, but I just want to start with one forward-looking thing. Morning, Prashant here. This new HVDC order, sir, which is in the works, which has been in the works for some time. Where is that at right now? At what stage? And when will we see tendering?
Yeah, I think you're talking about the new project on the Barmer.
Yeah.
Barmer is, as you know, that it is in the middle of the tendering process, and we expect anywhere between 3 to 6 months to get concluded.
And it's basically like a binary thing, right? It's a huge order.
Yeah, right.
And either there are basically two of you there in the fray, in that sense.
I can't say about others. All I can say is that we have put our bid and we are looking forward to that.
What's the size, sir? What's the size of the order?
No, it is again 6 gigawatt. It is high 5-digit order. So we got to look at it. Since it is in a bidding stage, it's not possible to give exact number on that. But let's hope that let it get concluded and see how it goes.
All right. Hi, Mr. Venu. Good to see you in, sir. I recall when I visited your unit, at that time I was debating with you whether 5-6% margin can go to double digits. Now it's gone to mid-teens. So you've come a long way. I'm looking at a Jefferies note though, and they are talking about your revenues compounding at more than 35% for the next few years. And they believe that margins will be on the up move from year on. They are talking about margins of around 23% by FY29. Do you think that is possible? That could be an aspiration, since I know you normally don't give guidance, but that could be the aspiration?
All I can say, Nigel, is, and again, good to talk to you. And we have a very strong order backlog. As you see, we have highest ever order backlog, 32,000 crores order backlog. And our order backlog is very, very organic. And it is, many of our customers are looking forward for us to early deliveries, etc. in that. So the conversion of this order backlog into revenue is absolutely in line with our agreement with our customers. So naturally, the revenues will arise out of this. And in addition to revenues coming from the order backlog, we also have revenues from our book and bill orders in our service, digital, and then products, etc. in that. So if you add all put together, definitely there will be a revenue growth. Last year also we had a very strong revenue growth, and this year we have started very well in Q1. But Q1 cannot be taken as a benchmark, but we will have a very strong revenue growth.
Jefferies is not too far away, sir, from what you think that you can get. Would that be fair?
No, we cannot talk about that. All we can say is that consistently we are taking several actions and initiatives, and ours is basically investment-led growth. We have seen this surge coming in. We have taken several actions in terms of our manufacturing capabilities, and 4,000 crores is what we are investing in our greenfield, brownfield factories in that. And those things will help us to further take additional market share, and then also expand our factories and expand our product lines, etc. in that. So those things will be added as we go forward into our revenue expansion, and once the revenue growth comes, then margin comes out.
At 4,000 crores that you're talking about, that's a transformer capacity, right? At that Karjan unit, I think, and that comes on stream by 2028?
Yeah, that comes stream on 2028.
Revenue potential of this, sir?
There is 30,000 MVA capacity. So 30,000 MVA capacity, completely a greenfield factory. And this is in addition to existing, we already have existing close to, another almost similar capacity.
Revenue potential, sir.
In our existing
Mr. Venu, you're putting 4,000 crores, the facility that comes on stream by 2028, the Karjan plant. What is the revenue potential, sir?
So it's as you say, 4,000 crores is combination of various projects, and Karjan facility is and that's around 1,600 to 2,000 crores in that. So the revenue potential, we look at, your asset turnover, look at that instead of revenue per se. Right now our asset turnover is a little bit high because it's a low investment, but anywhere the asset turnover from 3 to 5 times. So look
This
at
is,
those things.
sorry, this is a transformer
The
segment.
Karjan one is the transformer, but our 4,000 crores investment is for all. It is for high voltage, it is for also HVDC, it's also for expansion of our automation products portfolio.
Okay, so just a quick one. There is, and this question has been put to you earlier, but I think between the last time we spoke and this time, there's again that news of Chinese competition, right? In the space, Korean competition. Your thoughts, Mr. Venu? How's will that put a pressure on margins? What will that do?
I think our view is very, very clear on this. Competition is absolutely welcome, and competition, whether comes from anywhere, Korean, Chinese, or European, is absolutely good, as long as the level playing field is there. So what we are looking forward to is that the level playing field is there, and for example, there is a set of guidelines here that you need to have a minimum local content, etc. And if anybody meets that, then we are absolutely no issue to compete with whoever it is, whether it's the Chinese or Koreans or anyone else in that.
Is there any indication? But right now, from what we understand, all that is there, right? The minimum content requirement, etc. Right? Or we don't know that yet. You're waiting for it.
All we have to see is that some of those people, whether how they are meeting it. When you say the minimum content means you need to do end to end in India, right? It's not that we get it from elsewhere and then say that we do a little bit of value addition. Is not the minimum local content, is what I believe.
So you also won your first battery energy storage order in the current quarter. Can you give us the size? Because you also said the pipeline is robust. What can we expect in FY27 from BESS and the margins?
Yeah. So we have announced in our investors conference in the month of April about getting into the new areas. Battery energy storage is one such segment where we believe that 80 gigawatt of battery energy storage requirement is there in the country from now to 2030 or slightly beyond 2030. And we have started looking at this segment very, very closely, and then of course we are in the process of localizing. We are not there completely to localize everything, but we have taken this order, 160 megawatt order from a C&I customer, and we are very keen to expand these things, offering the completely again end-to-end manufacturing, localized, and our solution is more of a containerized and also scalable versions in that. Easily customer can scale it up, and very, very compatible for execution and timelines, etc. This is a very tough timeline. We have taken around 6 to 7 months. We have to complete this project.
Okay, and what are the margins, sir? And when will margins converge with your core business?
Margins are already converging into the core business, but it will accelerate, as our revenue is growing up.
Okay, and exports, sir, currently about 25% of your revenues, 25% of your order backlog. What will that number grow up to?
Our exports, you're talking about exports, right?
Exports, yes.
Yeah. So if you're talking about the export, we have been saying consistently on this, we have a little bit of demand from the export market, but right now our demand from the domestic market is even stronger in that. And as you recall, I've been saying consistently that our main focus is to serve the local market, and that's what our play is going to be. And then we will take, as and when we have some manufacturing slots, etc. We do that, but in the range of 25 to 30% is what we see the exports coming in that.
Okay, Mr. Venu, you're at the frontier of what is a once-in-a-lifetime kind of demand cycle. And, the investors who are riding that wave with you are doing very well. So we wish you all the best of luck. Thank you very much for joining us. And good speaking with you, sir. Thank you.
Thank you.
Just one word, Prashant, with regard to that minerals bill, there is some kind of talk and there is some kind of, unconfirmed report that suggests that could be tinkered a little bit. And if that is the case, the royalty that currently, say, Ramco as well as Dalmia are paying in Tamil Nadu, that could come down because currently the state is imposing it. But if all authorities with the center, then maybe this may not be, be able to be imposed, which explains why Ramco, though the numbers are not good, that stock has spiked up. It's up close to around 3.5% because of this, because of the hope that something can happen. And the other one you look at is Dalmia, because out there as well, they are paying royalty. And I think NMDC is the other one that spiked up. We'll try to get in Lakshman, who is getting some of these details. So those are the stocks that you need to focus on.
Okay, well, Titan is the company in focus next, and the management is with us. So numbers are strong, but I think we'll talk about the outlook, and we'll go back to the reported quarter in a bit. Mr. Ajay Chawla is Managing Director of the company. Mr. Chawla, great to have you with us here. Good morning. Prashant this side. So talk to us a little bit about how demand is panning out, because, is demand a little subdued? That's the sense that I think in the commentary, etc., that we got, that maybe July onwards, people are essentially waiting for direction as far as gold prices are concerned. So there is a wait and watch. How has it panned out so far in this quarter, the quarter we're in?
So far, it's been good. I think there was a lot of nervousness amongst many of the analysts who spoke to us on the earnings call about how demand will play out if gold prices remain subdued. But to be honest, I think the quarter has panned out pretty well. Even as we speak, July and August has been good. Whenever gold prices either go up dramatically or come down, or people are unsure, there will be quite a few fence sitters, but that's not unusual. So far it's good, and I don't see any reason why demand should be subdued. See, the first half of last year was relatively soft compared to the second half. So we have also the benefit of the base effect on the first half. In the second half, it's the festive season which will take over. So I have no reason to believe quarter two should be weak, unless there are some extraordinary events.
I see. So is there some seasonality here in Q2? I mean, Q3, I'm assuming all the festive demand, etc., kicks off, right? And maybe some portion of the second half of we see that in Q2 as well.
Yeah. So last year, the festive season for the Dashara and Navratri, etc., started early towards the second half of September. This year, it will start only by October. So in a way, September month, calendar to calendar, could see some, different kind of demand. We won't be able to conclude on that so early. Other festivals are there during this period in quarter two. There is Ganesh Chaturthi, there is Varamahalakshmi, and of course, in the south, there is also the Ashada period, which is, the inauspicious period, which is currently going on. Later on in September, there'll be the Shraddh period. So yes, there will be some timing differences, but I think all in all, I don't think too much impact should be seen unless gold prices suddenly shoot up heavily or come down dramatically.
Sir, on margins, in the conference call you said we're targeting 11% jewelry EBIT margins with a potential improvement in H2 of FY27. Can you talk to us about what will lead to the improvement and to what extent on margins?
In the second half of
second half of this fiscal year.
Potential improvement, well, it's difficult to predict what will be the exact potential improvement that we might be able to see. A lot will depend on a product mix. If we are able to see a lot more sales towards wedding-related products or profitable gold category products, whether it's in color stones or polkis, etc., then we might see some impact. The second possible area for upside, I'm not saying it will happen, but these are the levers that we look at, is to see if we can sell more of lower caratage studded jewelry, which is 14 karat jewelry, because that traction is picking up well. A lot of work has been going on. And I believe as more and more customers come into that category, instead of 18 karat, if they're buying 14 karat, that improves the margins for studded. Thirdly, with gold prices, if they remain stable as where they are, or even correct downwards, there can be a line item improvement in gross margin for studded. And if gold coins product mix kind of, moderates down, So far, it hasn't really moderated down adequately. But if it does moderate down, in case people don't see the need to jump heavily into investing in gold, then that also will help. So these are all the in jewelry. These are the drivers that could impact gross margins in the second half.
And what is your target for studded share for the year? In Q1, I think it's 27%.
So I'll tell you what, I've stopped looking at studded share over the last 7 years. The reason being share is an outcome of the contribution of studded on the total. We have seen different demand drivers for the gold jewelry, for studded jewelry and gold coins. And we have started going with the view that maximize sales growth in each of these. Doesn't matter what share or contribution emerges. So we are not really targeting any studded share. It may remain at 25 to 27%, I don't know. It depends on how the sale of the rest of the categories plays out. Particularly, I told you gold coins, they have been, contributing, going up in contribution due to the investment orientation. So if that kind of swings, that will automatically impact studded share as well.
All right. Hi, Mr. Chawla. Quick question before we let you go. What about the international business? How do you see things pan out on that front? Growth, margin trajectory, as well as Damas? When does it turn profitable, break even?
Okay, I think international business overall for Tanishq has been very good, very robust. The demand is growing. In fact, it's grown 130% in this quarter. The US market continues to be powering ahead very strongly for us. Of course, tariffs notwithstanding, we can never predict geopolitical uncertainties of that kind. Our Middle East Tanishq demand has also been pretty good on the back of expansion and a few stores which we converted from Damas to Tanishq because they were serving more in the Indian and the South Asian catchment areas. For Damas, it's been slow. In fact, it's been a rough quarter and it is likely to remain a little choppy in the next few quarters because I believe market conditions there still have to stabilize. Damas caters mainly to the Arab segment, and amongst them, the footfalls are low as well as ticket sizes are low. And tourist traffic in Dubai on Middle East has yet to pick up, especially UAE and even to some extent Saudi with Makkah, Medina, etc. So tourist traffic plays a big role, much more in the UAE, and that has yet to pick up. We cannot predict. I think the next 2 quarters we should continue to brace for tough top line situation and tough demand situation. And therefore, I think break even is something we may have to start looking at next year, unless, of course, things turn around positively. We are all prepared for growing very rapidly the moment the situation stabilizes, but we have to wait for that. Of course, Damas contributes less than 2% of the overall consolidated top line of the company.
Mr. Chawla, thank you very much for helping us with some forward-looking picture as well. Very helpful. Thank you very much for being here on CNBC TV 18. Thank you. We'll take a break. We're back and we're going to be joined by the management of Oil India. Again, numbers in focus, but more on the other side. Stay tuned. Welcome back. Well, Oil India is the next company on our radar. It's gaining in trade after reporting a strong set of Q1 numbers. We have with us Mr. Ranjit Rath, the Chairman and Managing Director of Oil India, who joins in on the show. Hi, sir. Good morning, and thanks a lot for speaking to us here on CNBC TV 18. Let's get your production guidance out of the way first. Oil production was very, very strong in the past quarter, which is phenomenal. Could you tell us, is this kind of a run rate sustainable?
Will you exit FY27 at around 4 MTPA? Is that possible on the oil side? While also explain to us why gas production came down, what's the outlook? Is that guidance of around 5 BCM possible by 2028, or is it at risk?
Okay. First of all, thank you very much for having me. Good morning to all your viewers. Yes, crude oil production is on the rise. It's about 11% plus. And I can assure you that we will be able to sustain it throughout the year. So the guidance for 4 million metric ton looks possible to us. Having done actually about 54 development wells last year and about 100 wells planned to be drilled this year, we are very comfortable as far as oil is concerned. With respect to natural gas, the recently authorized Duliajan feeder line, which will actually connect the Oil India gas sources to the Northeast gas grid, will provide us the much awaited breather for gas evacuation. Once that is done, we will be able to definitely meet the 5 BCM target. In fact, one more positive on this is recently, PNG Harbi has already announced that the DNPL line will be a common carrier effective yesterday or last week, I suppose. Therefore, we are also seeing a kind of opportunity there that the DNPL can also carry the natural gas. So the evacuation constraint which we were having earlier will get eased out, and we will be meeting the natural gas targets.
Okay, all right. So we've got some clarity then with regard to the production numbers. Now, exploration write-off was low in the quarter. That's helped report a very strong first quarter EBITDA. Given the high exploration capex, will exploration write-offs rise in the coming quarters?
Well, I will able to tell you something that as we speak, we are carrying out 3 exploratory wells, one in KG DSF block, one in Kerala Konkan. So it is all contingent on the testing results that we would get. So it will not be appropriate in my part to talk about any to be written off component as we speak today. But yes, the Kerala Konkan well is about 5,200 meters. Our target is to do 6,000 meters and undertake testing. The Andaman testing as we speak is going on. So let's wait for that.
Mr. Rutt, good morning.
Good morning.
This new policy by the government, which is just about 10 days back, right? These 3 wells that you are on the exploration side, are you doing this under that scheme, which is like 50% cost is borne by the government? And
just to clarify, the scheme that has been brought in is primarily focused in the deep water exploration.
Right, correct.
So we would get benefited with this scheme. I'll explain that. But yes, a straight answer to your question is the ones that we are currently drilling is actually shallow water wells, and these are all OLP much before previous OLP rounds.
I see.
So, but as far as the Samudra Manthan, that's the National Deep Water Exploration Scheme is concerned, we have got about 48,000 square kilometer of deep water area in Mahanadi and KG Basin, for which the seismic API is already complete. The processing is going on. By January, we should be able to complete the processing. That's about 4,000 plus line kilometer of 2D seismic and 5,000 plus square kilometer of 3D seismic. That would give us a line of sight of about 4+4 deep water wells. And those wells we will be able to figure out from this deep water exploration scheme.
And
sorry, just to complete that point, this the seismic kind of survey is already has been done, or this is to be done?
No, that's the beauty of it. We got the block last year, May, and aligned with the deep water exploration mission, the data acquisition of 4,200 line kilometers precise, 5,300 square kilometer precise, out of a 48,000 square kilometer of deep water exploration acreage is already complete.
Okay, and you picked up the cost for this, or the government?
Pardon?
Did Oil India pick up the cost for this seismic survey, or did government?
No, this is Oil India cost. This is part of our exploration efforts.
I see. I thought that typically for seismic kind, because the Samudra Manthan scheme also says that the government will step in. But I was told that generally the practice has always been that the government takes care of this cost.
No, a bit of clarification. Whenever DGH carries out speculative seismic data acquisition as part of National Seismic Program, it is sponsored by government. But when we do dedicated, well-structured seismic data acquisition for our respective exploration, that is actually borne by us.
Okay, got it. So just to wrap this up, sir, what is for the full year, or you don't want to talk about the full year, but what is the line of sight with regards to volume throughput? What should we expect in terms of growth, sir?
Look, if we are able to, last year we drilled highest ever 74 number of wells, 22 exploratory and 52 development wells. Going forward, our target is to drill about 100 wells. And I'm sure that this year, with the kind of production trajectory that we have already overseen, we will be able to meet 4 million metric ton target.
Okay, got it. Thank you very much, sir. I had more questions, but perhaps at a later time. Appreciate you joining us here on CNBC TV 18. Always a pleasure.
Thank you. Thank you very much.
I think we have the management of BEML with us.
All right, well, let's focus on BML. I think the stock is higher in today's trading session, though the first quarter was more or less muted. The numbers, though, have beaten what the street was working with, and the street likes that. Explains why the stock is up close to around 4.5%. To help us out with what's the way ahead and how are things shaping up on ground, we have with us Mr. Shantanu Roy, the chairman and MD at BEML. Hi, Mr. Roy. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Always a pleasure to catch up, sir. The street likes what you've reported, but they'll want to know what's the way ahead from here on. So help us out with a few details. Last year was a little bit soft. We had some supply-led issues as well that resulted in you missing actually your FY26 guidance. However, for FY27, the street is far more optimistic. So what kind of revenue growth are you looking at? Exports as a percentage of those revenues will be how much? Margin trajectory as well as order inflows. So three big numbers: revenue growth, margins, as well as what is the order inflows you're working with.
Very good morning. The first quarter, in terms of the revenue growth, has been probably the best we have had in the last decade or so, almost 30%. And my expectation is a similar kind of growth in the second quarter, similar or better, and similar or better in the third and fourth quarters in terms of the revenue growth. As far as the margins are concerned, I think we should get back to the EBITDA that was there in 24-25. 25-26, there was a one-time correction that we had to do, because of which the EBITDA and other things went down. But this year, once that has been done, we'll get back to the EBITDA of 24-25 and even try to better that.
So that'll be 12 to 13%, right? Margins.
Yeah, it should be. It should be.
And the order inflow you were giving me?
I'm talking about the EBITDA.
Yes.
And order inflow, this year already in the first quarter, the order inflow has been, as compared to the last quarter, it has been more than 2.5 times. And currently we are sitting on order prospects of almost more than 40,000 crores. In the rail, in the metro, we have 6 tenders which are already out. One tender we have already participated. Then we have 2 big rail tenders for the commuter rail. 2 big rail tenders. One is the memo, one is the metro. Plus, we have quite a few orders in the pipeline for defense and in exports as well. And in mining construction, we are L1 for at least 900 crores of orders in the domestic sector. As I mentioned, exports, we are shortly going to participate in a major tender in the West Asia. So this year, our order inflow should be, if all goes well, because till now, no order has been finalized, no major order has been finalized. My expectation is that it will go to the third quarter these rail and metro orders should be finalized in the third and fourth quarters. And the defense orders, it should happen in this quarter. Some should happen in this quarter. Some should happen next quarter. The mining orders, where we are already L1, it should fructify in this quarter itself. Okay. And the export order, it should go down maybe to the last quarter. So in all the order inflow, if I consider, a probability of 25 to 30%, it should be around 20,000 crore. That is the order inflow that we are looking for.
Got it. All right. Yeah. Mr. Roy, so you're bracing for the best ever showing, I think, in FY27. If I punch in the numbers, around a 30% growth is what you're working with in terms of revenues. So you'll be ballpark, in that vicinity of around 5,500 crores. A little more than that, actually, with margins of around 12%, which means your EBITDA number will be more like 600 crores and your top line will be close to 5,500 to around 5,600 crores. Is that correct?
It should, because, this year has been very different from the other years. We started the year with a sizable executable order numbers. The executable, why I say it executable is all the rail orders, all the metro orders, the Bangalore Metro. We have cleared the proto and the bulk production has already started. So 2 more metro projects that we are currently doing, it will go into bulk production in the next financial year. But this year, there are 3 major commuter rail projects which are under bulk production and 1 metro project which is under bulk production. Plus defense, there is a continuous pipeline of orders and the supply chain has picked up. In fact, defense has done pretty well as compared to the last quarter, the same time. But the best performance has been from the rail and metro sector. It has grown phenomenally in the first quarter. Even though mining has taken a dip because the orders are taking some time to reach the stage of finalization. But this quarter, we are going to start execution of a major export order in mining.
Okay. So just, you said the order inflows for this year will be 20,000 because in Q1 you were at 1,180 crore.
Yes.
So we're expecting more than 18,000 crore of orders in Q2 to Q4.
You see already in the commuter rail and metro, 56,000 crores of tenders have already been announced. Out of which we have already participated in 1 tender, that is MMRDL line 12. The other tenders, we will be participating. The dates, the submission dates vary from some in August, some in September, some in October. So my expectation is these should get finalized in the third quarter or fourth quarter. I'm not expecting anything to be finalized in the second quarter. So if all goes well with the rail and metro and the orders which we are already L1 in the mining sector, plus the export orders that we are executing, we should have this kind of number this year.
Okay. Sir, out of time, but thank you very much for joining in. Always a pleasure. That's BEML for you. We will slip into a break. On the other side, we'll come back and talk commodities. Manisha joins in as always. Welcome back. Markets are flat. The Nifty is at the 24,550. But let's talk commodities now. Manisha is joining in as always. Manisha, you're eyeing copper today.
I am, because we've seen stronger gains continuing for this one. If you look at the last week itself, we saw all-time highs for the US copper prices to the tune of $6.7 a pound therein. And with that, if you look at the last 1 month, we've gained up by 6%. We are 16% up for this year and almost 50% higher from where we were in the previous year in the month of August therein. So it has been a one strong gain that you have seen come in case of the copper prices. Remember, LME did see an all-time high in the month of January, and the expectations are from where we are trading, you could be looking at higher highs continuing for this one. Let me tell you on what the prices are doing to begin with. When you look at the LME markets therein, well, they are trading in a backwardation. So when you look at cash through 3 months, well, that is trading with $100 of a premium. So cash is more expensive than what you are looking at copper prices 3 months later down the line. US markets are trading with a huge premium, $640 a ton to where the LME markets are trading. And that is where you're looking at a huge disparity coming in the global copper markets therein. There is copper hoarding in the US markets. This is in expectation of a duty on refined copper that US could be coming in from. US has been saying that they would levy a duty on 31st of June or 1st of July. And that is overdue by more than a month right now. We haven't heard of that, but that hasn't stopped copper from flowing much in case of US therein. More than 200,000 tons of copper has been shipped into US in the month of July, which is the highest in 1 month since 2014 therein. The COMEX inventories also have continued to surge. They are more than 40% higher in 2026 and are at record levels right now. And then apart from that, you have US right now holding nearly 69% of all exchange monitored copper in the global markets therein. And the rest of the world clearly is left with very less copper. So when you look at the global inventories outside of US, that is just at about at 7-month lows therein. And then you have had the Strait of Hormuz closure, which led to nearly 50% of all seaborne sulfur actually contained behind that blockade. Now, nearly 15% of global copper production needs sulfuric acid, and that is where the concerns are coming in from. Apart from that, you have Congo, which is banned exports of copper concentrate. You have Chile, where the mines have seen an impact because of the adverse weather therein. And then there is China's aggressive $574 billion of power grid upgrade initiative that would demand more copper going forward. And then operations at the Codelco's El Ternate mine also are expected to remain suspended for the next 2 years. So everywhere that you look, there are concerns coming in sense of supply of copper. The copper prices forecast then are expected to be on the higher side. We almost are trading at record highs for the US markets therein. And while we are holding around $14,000 a ton right now, there's an expectation from Citi, Trading Economics, even Bank of America for that matter. They see $15,000 a ton in this year in a bullish scenario, 13,400, 700 kind of an expectation coming in from Goldman Sachs as well. So bullish copper expectations going forward from here as well.
Right, Manisha, thank you very much for that. Well, we'll take a break. Lata speaks with Crisil's Krishnan Sitharaman and Vineet Jain of Care Edge on the NBFC sector as RBI issues a draft circular essentially looking to stop revolving credit, some of these flexi loan products in sharp focus. Stay tuned, coming up next.
Welcome to It's the Economy. The Reserve Bank is looking set to order NBFC companies to stop giving revolving credit. What does that mean? It means these companies cannot top up a partly repaid loan. The Reserve Bank's worry is probably that these topped-up loans are being used for evergreening a loan, that is, taking a loan to repay an older EMI. Brokerages like IIFL assess that only Bajaj Finance is big in this space with probably a 15 to 20% exposure to such loans, while Tata Capital may have lent about 10% of its loans as revolving credit. But the question we are asking is, can the banning of revolving credit push down NBFC loan growth and push up their NPAs? So rating agencies look at repayability very closely. I have with me two experts, Krishnan Sitaraman of CRISIL and Vineet Jain of CareEdge. Gentlemen, good morning. Thank you very much indeed for your time. Krishnan, have you all assessed NBFC exposures? And do you agree broadly with the market that there are one or two people, but it's not a sectoral issue? What are your numbers?
Hey, good morning, Lata. Good morning, everyone. Thank you for inviting me. So this consultation paper from RBI, in a nutshell, seeks to ensure that when NBFCs extend credit to their customers, it should be in the form of a term loan and not in the form of a revolving facility. And that, I think, is because in a revolving facility, there is a possibility that customers could borrow multiple times under the facility, some of which could be used to repay an older borrowing under the same facility. Whereas in the case of a term loan, each borrowing is treated as a different facility. Of course, credit card companies are now exempted from these guidelines. So in my view, we don't have too many NBFCs today who extends loans through revolving facilities. And even those who do have such products, they are typically termed as, say, flexi loans, line of credit facilities, and so on. They don't form a significant portion of their loan book. So I don't see much of a disruption for the sector as things stand today. That said, this is still a consultation paper, and we still need to see what form and shape the final guidelines take and what kind of timelines are given to NBFCs to move to the new regime. What I've seen is in the past, whenever there have been regulatory changes, and there have been many in the NBFC space, NBFCs have shown their ability to quickly adapt to the change dispensation, to tweak their products and processes wherever necessary, to align to the new guidelines. So I don't see this time being any different. So there could be in some of these players where who are offering these products, they will have a transition period where they adapt to the new dispensation. But given the quantum of these loans, I don't think too much of a disruption should be there.
Will NPAs go up? 1 quarter, 2 quarters, are they going up?
I am never kind of a proponent of quarter-to-quarter analysis. If I look at fundamental credit quality, I don't see there being too much of an issue there. There could be some few basis points here and there moving up because of underlying issues of broad level issues like inflation going up, interest rates, if they keep elevated. There could be certain segments in the lower ticket category due to over leveraging effect and so on. There could be some increase, but no systemic issue I foresee at this point of time.
Vineet Jain, good morning. Your take? Can there be an increase in NPLs, especially for some of the NBFCs?
So thanks, Sada, for having me. Before we go to the NPA question, I'll just go back to the question that Krishnan addressed, essentially on the revolving facility. So if you look at the definition, how the RBI is defined, they've actually not defined the revolving facility. They've defined term loan and said that anything which is not fitting into the term loan definition would be a revolving facility. So by implication, if you look at, there are three moving parts there. First is the facility will have to be a fixed principal amount, which essentially means that any facility where the drawdown could be linked to a drawing power or the value of security would actually not fit into the definition of term loan, which would actually cover additional working capital products being offered by NBFCs. It would cover loan against shares. It will also cover loan against mutual fund, etc. The second part that RBI has dictated is that each facility would have to have a defined repayment schedule, which essentially impacts your demand loan and call loans. And RBI actually specifically proposed to delete the section where they have said that the demand loan can be, the remits of demand loan can actually be decided by the board. Third piece is actually on the revolving facility, and the whole discussion that we are hearing is on the third piece only. We are actually missing on the first 2 points, which would actually be equally large in terms of size. On NPA side, the point that Krishnan made is correct. I would totally agree with that. Only thing that I would add is that because the customers are used to paying interest and not used to paying the full loan principal amount, there would be stress on the borrower, and to that effect, there could be some uptick in the numbers, which would be actually more demonstration of stress which was already existing rather than the fresh stress in the system.
Are you saying margin funding will not be allowed? Is that your interpretation?
No. So margin funding again, yeah, that would also get covered under the same.
It would be a revolving credit because if your share prices go down, higher loan is. You're saying even that nobody has given that interpretation that margin funding will be impacted.
That's one way of reading it. If you look at the first para, opening para of the definition, it said that the principal amount has to be a fixed amount. If I have to interpret that fixed amount, then obviously all these products which work on the margin and drawing power, etc., would come under question if unless it is clarified appropriately by the regulator.
Okay, so we have to really wait for Reserve Bank's clarification in that case. Krishnan, just you want to come in on that? Are we underplaying the definition itself? Is the market understanding it, to its advantage?
I think we need to look at form and substance. And I think the way we have looked at it is this is a call on the revolving facility. Some of the other aspects, that can be clarified. But I think the way I have looked at it, as you had commented on your opening comments, is an issue of the entire process of borrowing under the same facility to repay an earlier loan. So that clearly comes out in a revolving kind of a facility. In some of these other products, I'm not sure that will work out in that way. But that said, as I said earlier, we need to see the final form and shape of these guidelines. And at the end of the day, this is a consultation paper.
Okay.
And there will be market participants, stakeholders who will be giving in their comments. And I think there would be discussions and conversations before the final guidelines.
I believe FIDC is meeting them. We were told when we tried to get the SRO, they were unwilling to speak because they're going to speak to RBI. Vineet, would affordable housing be hit? Affordable housing guys may be giving top-up loans. In fact, housing finance companies would be giving top-up loans. You see a danger for that?
Two parts there. Before you move there on the replacement, if you look at demand loan and cold loan, right? That's actually, there is no replacement there. But RBI is saying that that's also not allowed. Coming to the HFCs, this is part of the overall regulation. The HFCs will also be guided by these regulations. On their plain vanilla lending, which they do, those are all tenured loans. It will not be impacted. Wherever they are giving construction finance loan or builder funding that they do, if there is an element of refinance, if there is an element of redrawal of the limit upon repayment, to that extent that they would be impacted. But my sense would be that would be very, very on the margins.
Okay. I want to move to the overall NBFC sector, but just a last question, Krishnan, any thoughts on this other? We are all concentrating on Bajaj Finance and maybe Tata Finance, basically consumer finance companies. We aren't looking at housing finance. Is there a likelihood over there as well?
Look, Karan, I wouldn't like to comment on specific companies, but if I look at the overall product suite that NBFCs are offering, these kind of facilities, revolving facilities, have typical names. So they can be called as flexi loans, what I've seen in the market. There are some line of credits. So line of credits are being offered by, I would say, some HFCs on the LAP portfolio, the loan against property portfolio. But that again is very minimal, if I understand correctly, in terms of proportion. I don't see too much of a disruption. Maybe some basis points here and there.
Okay. Well, let me use a little bit of the time to ask about the NBFC earnings season that has just ended. Your thoughts, Krishnan, are you... it has been a very strong loan growth. It's over 20% for most of the large guys. And for almost everyone, the GNPA or the gross stage 3 loan has ticked a bit lower, except I think for commercial vehicle companies. For almost everyone, it's ticked lower. Do you see that as the FY27 trend?
A couple of things we need to keep in mind, Lata, there. The credit growth is largely coming off a muted base. If you go back to Q1 of last fiscal, the growth levels for the sector was low, and that was largely emanating on account of the funding access situation at that point of time, because bank credit growth to NBFC, that was growing at a very subdued pace. However, if you look at the situation today, bank credit to NBFC sector is growing at around 30% year on year. So the access to funding has improved from NBFCs. And in the past, we see whenever their access to funding goes up, the credit growth on a like-to-like basis also goes up. So I think those are the two factors that we are looking at. So credit growth should continue to be reasonable for this. Towards the end of the year, the base effect will catch up. But we believe that through the course of the year, an 18 to 19% AUM growth for NBFCs should look reasonable at this point of time. As far as asset quality is concerned, whatever the portfolio reflects is a reflection of the underlying cash flow situation, underlying demand and business environment that we see in the Indian economy. If you look at car sales, vehicle sales, those are doing quite well if you see those numbers coming up. And if you see gold loans, they are going up at a very brisk pace. So if you look at across asset segments, even microfinance has picked up now. So across segments, things are looking better for the NBFC sector. And as I said, the underlying asset quality would be the function of how the underlying cash flow situation pans out. Overall, on account of the West Asia conflict, and if we see the monsoon situation today, because they are deficient, we have the El Nino effect play out. We have identified a set of sectors where there could be some impact. And if NBFCs are lending to MSMEs on those sectors, there could be some challenge on the cash flows. But I don't think that should be very substantial.
Not substantial. Vineet, your lasting thought, your parting thoughts on where would you worry? Are MFIs out of their zone of trouble? Secondly, are MSMEs, like, for instance, those exposed, those in the rural areas, are they the areas of trouble? Where would you watch out for trouble?
So I largely agree with what Krishnan said on the asset quality, the function of the underlying cash flows of the borrowers, except the MFI, right, where the numbers are looking good on back of corrective actions that have been taken in last few years, and also on back of huge write-offs. Other asset classes, we are seeing slight uptick in the asset quality, in the delinquencies. These are on the expected lines, nothing alarming as such.
Okay. All right. And you also expect this 20% loan growth to continue this year?
It would continue, and a lot would also depend on how the FCNRB pans out, how is the flow distributed, what is the RBI action on the OMO, whether to do OMO, etc. So a lot will depend on that also.
Well, at the moment, it does look like the Reserve Bank is taking to liquidity and rates very kindly. That was the last policy pronouncement. Thank you very much, Vineet Jain and Krishnan Seetharaman, for setting fears at rest. We still do not know the contours of this revolving credit definition and whether the NBFCs will lose more area. But I don't see why the Reserve Bank would want to disturb what is working well. They may be only looking at areas where they see evergreening, and perhaps the scope will be restricted rather than expansive in terms of what is allowed to the NBFCs. Wrap up on that note, Chartbusters after the break.
Hitachi Energy reports an all-round beat in the first quarter. Stock surges 9% as the order backlog hits a record high. Margins expand 400 basis points. The management tells CNBC TV 18 that double-digit growth will continue. Margins will continue to improve going ahead.
Oil India too rallies on strong numbers. Crude realization spikes nearly 50% sequentially, while margin also expands significantly. The management tells CNBC TV 18 that the crude production grew 11% year on year, and they will remain on track to meet their production guidance for this fiscal.
Ramco Cement's first quarter volumes rise 12% year on year, although a low base. Utilization levels also improve in the first quarter. The stock higher by nearly 5%.
And it's a weak first quarter profitability coming in from Aditya Birla Fashion and Retail. The stock is down close to around 8%. Higher cost weighed on margins, negating strong revenue growth from multiple businesses.
Inox Wind is the other casualty of poor numbers. Stock down nearly 3% as the company's revenue declines for the second straight quarter. Margin pressure also continues.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the market's more or less flattish with a very mild positive bias, Mangalam. But we've got plenty of earnings to deal with. So let's get straight to that.
Let's get straight to that. A bunch of stocks doing extremely well. Godrej Consumer, not necessarily one of those, but reported a steady first quarter with double-digit profit growth supported by healthy volume expansion as well. We have Asif Malbari, who's the CFO of the company, joining in to discuss the quarter gone by. Good morning, Asif. Let's start with how the business has continued into the second quarter so far. We've seen a lot of raw material volatility in the first quarter, but demand amidst all of that was resilient. Now, the second quarter, how are you seeing business grow and how's the environment?
No, so I think we delivered a good Q1, I think, and it was broad-based across, I would say, all clusters, across all lines, both in terms of top line and bottom line. I would say that we are on a similar kind of trajectory as we enter Q2. And I think a little bit more well-prepared compared to Q1, because Q1 was, we were taken a little bit by surprise because of the volatility in terms of global developments and commodities. Better prepared to manage the volatility in Q2, both in terms of supplies and in terms of prices.
Right. Asif, one of the call-outs that you had in your first quarter update is that by the end of the first quarter, you've started seeing margin improvement and they should progressively improve from here on. So in terms of an overall margin for the full year and improvement per quarter, could you give us a glide path or a sense?
So I think the fact remains that, commodity prices did kind of go to its peak. And we've seen some corrections in a few places. Having said that, there was also an availability issue, which means we had to kind of cover up as and when stocks were available. So I think towards second half is where we should start seeing the benefit of lower commodity costs. And I'm hoping that the global scenario also improves in terms of supplies and cost. But Q2, we should see very much a similar scenario in terms of cost, what we've seen in Q1.
All right, similar for Q2 as well. And specifically for your India margins that came in at 20% as against your guided band of 24 to 28%. How long before they go back to normative range? Do you expect that to happen in the second half?
I think I would kind of just wait for, I think, the situation on commodities to kind of come down to normal, because all said and done, it's unusual situation on cost. So for margin improvement, I would actually kind of wait for commodities to kind of come back to normative levels, because it's also in the current scenario, we don't want to kind of price up too much and then kind of pull back prices. So we are also being measured in the quantum of price increases which we're taking.
And could you quantify the kind of price increases that you've taken across your portfolio in the first quarter, and how much of that would also come by in the second quarter? How's demand held up in light of those price increases?
Yeah, so I think on price increases, we've kind of taken a price increase of close to 500 bips in Q1. We do see similar level of price increase flow from a UPG perspective in Q2, because it's again IYA. Last year, there was a little bit of price increase which we took. So bases kind of keep moving. So broadly, most of the price increases has been taken. That level of price growth should continue into Q2 and onwards. When it comes to demand, it has been, I would say, an environment in which there were supply issues, and hence to that extent, some of the fill rates were also low. We do see that normalization happening, I think, as we speak. So yeah, towards from August onwards, we do see normalization happening on supplies. Demand situation remains broadly stable. I mean, this level of price increase is something which I would say in the FMCG industry is something which is par for the course, and hence you don't kind of see an impact on demand for this level of pricing.
Right, let's talk about the fast-growing speedboat businesses, with all the new launches that you've announced and ideas. It's about 17% of your sales. Where do you see that happen, go to in the next 3 to 5 years? And at what point does it start adding to your margins rather than you investing behind its growth?
No, so I think this will meaningfully keep going up every year. We started the year with last year kind of base level of speedboats at 15. We've kind of come to 17. I think we should be more closer to 20 by the end of this year. And the salience of this should definitely continue to kind of go up for the next 3 to 4 years. So I think from a medium-term perspective, I do see the total quantum of speedboats get to that 30, 35 kind of band. Again, while we have a few speedboats, we also have some few more incubations which are happening. This quarter, we kind of launched Riz. Again, we added one more, I would say, incubation. Some of the incubations will become meaningful in the next few years. So we do see the journey of speedboats continue and the salience to kind of get to a third of our business in a few years. Yeah, I think when it comes to margins, yes, you're right. I mean, these are investments in the short term. And as they come to a particular size, you start then kind of meaningfully contributing to margin. I think that meaningful contribution is possibly, say, 2 years away from now, given that we are also continuing to kind of build more speedboats.
All right, a third of your business, and then you will expect margins to come by over the next 2 years. So this year, should we see a high single-digit volume growth, a few hundred basis points of price increase, so that takes your revenue to about low teens sort of growth, and margins, do they stay at least close to what we've seen in the first quarter with some improvement in the second half? Would that be a fair assessment?
I think that's where we would kind of do. So I think we did kind of give a guidance when we had our investor conference about high single-digit volume growth, and we did give a guidance in terms of double-digit revenue and profit growth. Yeah, the start has been actually better than anticipated. We've kind of actually moved ahead of our guidance. So we are confident that we should be able to move ahead of the guidance on a few lines for sure. Yeah, volumes kind of looking strong, revenues kind of coming in strong. Margin has been a bit of volatility, but yeah, profit growth definitely is looking at stepping.
Right. Just a final question then. Let's speak about the non-India part of the business. Indonesia spurted back to growth in the first quarter. How does it go for the remainder of this year? Do we see some moderation or acceleration?
I think Indonesia, again, started off well. We have been calling out, saying that, yeah, the business is looking like now stabilizing and now kind of moving on a right path to grow. I'm quite confident that the business should remain, quarter one was really strong at a double 10% kind of underlying volume growth and 15% revenue growth. Likely to kind of come down a bit, but definitely it should remain on a high single-digit volume growth trajectory for a while.
All right, high single-digit volume growth for Indonesia as it moderates from the double-digit that we saw this time around. Thank you so much, Asif, for joining in with an outlook on the remainder of this year. With that, we'll take a short break. You don't go anywhere, because on the other side, we have the management of Hindalco joining in to discuss their first quarter numbers.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, a fair bit of action is what we're seeing from the broader markets. The Vedanta Group stocks actually have perked up. Vedanta Oil and Gas, you recall the stock saw a sharp correction, but that in fact has perked up a little bit in the last few minutes. Vedanta Iron and Steel as well moved circuit to circuit on the downside as well as the upside. And Tilaknagar Industries, another stock that's actually been moving quite well. I recall when the management joined us after a while, the stock had corrected. And from there, that stock actually has pulled back. Yeah, the last, I think, 2 weeks or so, the stock has rallied close to around, close to around 14% or thereabouts. The other one is Universal Cable as well. What a big outperformer that stock has been. The growth has been better than what the street was working with. They have a JV with, a Japanese company. And, the street is quite excited about that. They're looking to triple their capacity out there. So the street likes that. It's already rallied big time. But in today's trading session, that as well is locked upper circuit as we speak. That said, let's get to the big boy, Hindalco. Reported a very strong set of numbers in the first quarter. Both the segments fired, copper as well as aluminium. They reported solid growth. Mr. Satish Pai, the managing director at Hindalco, joins us on the show right now. Welcome to the show, Mr. Pai. Well, you're going from strength to strength, but let's start off with the aluminium business. What's the outlook you're working with regard to prices that have been fairly volatile for this year? And in turn, what does that mean in terms of aluminium EBITDA per ton?
I think the aluminium prices in the quarter one of this year spiked up because of the Middle East conflict and, were running at around $3,600 per ton. So that certainly was a tailwind for us. Now, I think if you look at the outlook, and I think I have consistently maintained that this year the aluminium supply is going to be tight because quite a lot of Middle East capacity has gone off and will take some time, probably till the end of the year, to come back. So I think aluminium prices this year are going to be within that 32 to 3,400 range. And hence, as you said, our EBITDA per ton should be around the $2,000 per ton for the rest of the year.
Okay, all right. Because of the Middle East disruption, many industries have got impacted and cost of production has gone up. For you, what was the increase in cost of production in the first quarter if you compare it to quarter four? And in quarter two, it'll be higher, right, than quarter one?
I think, what it impacted is energy costs. So you have natural gas and you have furnace oil prices that have spiked up. And the other thing for us is CP coke. So on quarter one, it went up by 4% compared to quarter four. And we think that in quarter two, it will go back another 4 or 5% up. Now, the interesting thing is that on a dollar terms, our price of cost of production in Q1 to Q4 was flat because the rupee depreciated. So that is certainly one angle to take into account because since we are a dollar denominated business, the cost being in rupees actually works in our favor because the rupee has depreciated.
Oh, interesting. All right. So the currency as well is a bit of a tailwind and working in your favor. Got that, Mr. Pai. You give us the EBITDA per ton guidance on the upstream side for the aluminium business. But what is the guidance on the EBITDA per ton of the downstream business? And also, could you help us with some clarity on what is your hedging strategy? How much of your quantity at what price has been hedged?
Okay, so let me first take the downstream aluminium business. I think we are very happy with the performance of the downstream business. It is our new projects that we had put in on rolling and extrusions are ramping up. I think that we had some tailwinds because as the metal prices go up, there was a certain impact. We could get pricing even on the downstream side. And I hope that, in the coming quarters, the downstream volumes are also going to pick up. So I think overall, a good start to the downstream aluminium business this year, and it's going to continue in the coming quarters. I think as far as our hedging goes, I think this year we are hedged about 27% at $3,000 per ton. So, and I think next year we are now hedging and we are getting close to about $3,200 per ton for next year.
Okay, got it. So that clears out the hedging policy as well. Now, copper business. What a start that's been, right? The last quarter you told me maybe in fact this number is not sustainable. But I'll tell you what, Mr. Pai, the copper EBITDA is at the highest that I've seen in multiple quarters. It's enjoying the benefit of higher sulfuric acid prices as well. So what's the outlook? What's the run rate EBITDA per quarter we should expect from the copper business?
Yes, I think that the quarter two EBITDA also will be at the same levels of Q1 because of the byproduct prices, especially sulfuric acid prices have become even stronger than the Q1 levels. So we think that Q2, see, for us in Q1, the copper volumes were down because we had a planned shutdown. So in Q2, you are going to have a combination of higher volumes of sales as well as higher byproduct prices. So copper Q2 will be stronger than copper Q1.
So we have cleared out then the domestic part of the business. Let's go overseas. Tell us about Novelis. The EBITDA per ton has been impacted by various factors over the last few quarters. But now the Oswego unit has restarted. So going ahead, what is the trajectory in terms of the EBITDA per ton for Novelis?
So look, Novelis had a strong Q1. And I think if you look at the underlying EBITDA per ton of Novelis, it's around $525 per ton. Because of the scrap spreads, the higher LME, and all of those are positively helping. So I think the most important thing for Novelis is that Oswego will be up to its full run rate in Q2. And I think that combined with the Bay Minette ramp up that's going to happen from Q4, I think that Novelis's next 3 quarters are going to be a steady improvement over the quarters of the previous year. So I think Novelis is in for a very strong performance in FY27. And once Bay Minette is commissioned, the real ramp up in Novelis's EBITDA will happen in FY28 with Bay Minette volumes coming in.
That'll be good news then, because the street is looking forward to the ramp up of volumes at Novelis, which till now has been a bit of a headwind. Final question then, before we let you go, the net debt. That's a bit of an overhang, right? And that's why the street is still a little bit uncomfortable. But you're guiding for better times ahead. So given that cash flows should improve in Novelis and the India business looks pretty rock solid, what's the outlook with regard to the net debt to EBITDA ratio as well?
So I think the net debt to EBITDA at the console level, because Hindalco India is at a negative net debt and will remain there, the question really becomes on Novelis. So Novelis ended Q1 at 4.47. I think this is the peak. Q2 will probably be at the same level, but in Q4, they'll go below 4. So I think that the consolidated net debt to EBITDA, which is today at 1.95, will actually come substantially down when Novelis comes below 4. So I think that the worst for Novelis is really over. And as Oswego ramps up, the working capital release happens, inventories come down, I think you're going to see the net debt to EBITDA at the console level by Q4 coming substantially down from the 1.95.
Always a pleasure talking to you, Mr. Pai. Wishing you, the team, all the very best for the coming quarters, and we catch up soon. Well, for the time, we can slip into a short break, come back. We continue to focus on markets and stocks that are moving around. Stay tuned.
Welcome back. Among the stocks that are doing well this morning, we have Trent, which has moved to the high point of trade. We had seen some correction on the stock post its numbers and a weakish outlook on growth in particular. Saw a decline on Friday as well, but now it's moving higher. But one stock which is doing extremely well, moving from strength to strength, is Titan. It's up 3.5% right now, at a record high, was at a record high ahead of numbers, and those numbers justify the move, and the management commentary also fairly positive for this year. Let's go across to Vivek now, who joins us with an important, interesting story. Index changes, they could be on the cards with the NSE and the MSCI index reviews out in the next 2 days. Vivek joins in with what could go in and come out.
Well, that's right. It's going to be a busy week for passive index fund managers. Both NSE as well as MSCI reviews are expected this particular week. In fact, the NSCI index subcommittee will be meeting later today, and post-market as today, you could expect a whole raft of changes, especially as far as the NSE indices are concerned, in terms of inclusions and exclusions. Now, talking about the Nifty 50 and the likely changes there, well, Wipro is one stock that is most likely going to exit the index, and the street believes that it could be either BSE or TVS Motors that could go ahead and replace Wipro in the Nifty 50. Of course, there are a whole host of other considerations too that will be taken into account before that particular decision is made. The Nifty Next 50 index is where it is quite interesting. Some of the inclusion candidates include Wipro, Vedanta Aluminium, Power India, Idea, as well as Polycab. And the stocks that could make way for them include some of the underperformers, recent underperformers, names like Shree Cement, REC, Lodha, Indian Hotels, as well as United Spirits. Now, coming to the MSCI Standard Index, 12th is when the date is, so 13th early morning Indian time. You will get the whole list of changes, inclusions, and exclusions. The one that we are focusing on is the MSCI Global Standard Index. We are expecting 5 inclusions into the Global Standard Index this time around. Names that have likely made the cut, as per analyst estimates, are Loris Labs, expect inflows of over $500 million here. Biocon, over $300 million of inflows. Lenskart and Adani Energy both expect to see inflows of over $300 million. And Grow, a billion brains garage, could be the final entry, almost $275 million entry is what you're anticipating. With other stocks that could move out, some of the recent underperformance names like Balkrishna, SBI Cards, and Astral, all three could move out. And Swiggy, remember, it's not due to an underperformance, but it's due to the change as far as the ownership structure is concerned, where the company becomes an IOCC, an Indian-owned company. Foreign headroom has gone down, so that stock could see significant outflows of over $300 million. Whole host of these stocks will remain in focus in this week. Remember, a lot of these names have already priced in the possibility of inclusion and exclusion.
Got it. Okay. All right. Thanks a lot for that, Vivek. Well, on that note, though, we'll wrap up on this edition of Chartbusters. That's it from Mangla, myself, and the entire team that put this together. The team of Trading Hour is waiting for you on the other side.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, as always, Ritu Singh, joining in from the Bangalore studio. 28 points higher on the Nifty. Not too different from what we've seen a lot of days, all of last week. The market's been in a bit of a range right now, with higher levels seeing some supply, lower levels seeing some support as well. The Nifty Bank is down about 50 points, but no real worries till such time it holds that 57,500 mark, which holds both the 20 and the 200-day moving average. It's the broader market which is doing well. 1,800 stocks advancing for about 1,200 stocks which are declining. More stocks gaining makes your portfolios feel a lot better, and a lot of result reactions which are swiftly underway right now. Big moves is what we're seeing on a lot of stocks. Titan, for one, has moved to a record level. Hi, Ritu. Good morning.
Hi, good morning. Big moves on a lot of stocks indeed. Titan is one. HDFC Bank is another that's also helping the frontline index stay in that green, that little upward move that we've been seeing. HDFC Bank, one of the top contributors after Titan. But other than that, it's the IT pack that's holding up in trade today, while the bank Nifty is seeing some pressure. So there is some buying seen in IT. It's now trading with gains of almost 1% as we speak. The broader markets, like you said, they're holding up as well. The PSU banking space seeing some pressure, and the private banks as well. Perhaps some of the profit booking that's come in after that stellar rally we saw in State Bank of India on the back of those earnings on Friday. But as always, let's get you specific stocks that we should focus on in trade. Hormaz joins us now with his list. Hormaz.
The final week of the earnings season has finally commenced for this quarter, and the index is, holding or meandering around the flat line for the first couple of hours of the trading session. It's still around that 24,600 mark. Today's range has been 100 points so far, and the Nifty futures currently showing about a 75-point gap. So 24,675 on the futures rate, while the spot is still at 24,600. Take a look at the Nifty Bank as well, as Mangalam just mentioned. Well, around about 57,500 till the time that sustains, fairly okay. There are no reasons to complain. Has managed to defend that level yet again in today's trading session. Here too, the futures are showing around about a 200-point gap. 57,900 is where the futures are. They were above the mark of 58,000 before trade began today, and they are still around about those levels as well. Now take a look at the stocks that are seeing a positive result reaction, and no better than Hitachi Energy today. It's received multiple upgrades and an initiation from Nomura after its results. 9.5% higher on the stock. BEML came out with results during market hours on Friday, but it's extending its gains today. 6.5% higher here as well, and Ramco Cements too doing well for itself, around about 4% higher. Look at the negative result reactions. Aditya Birla Fashion is one such name, around about 7.5% lowest, trying to recover from the lows of the day. At one point was down over 9%. PFC, though, has extended its losses to the lows of the day, 5.5% lower here. NLC India is down 5. Inox Wind 2 is attempting a recovery from the lows of the day, 3.5% lower. But take a look at Keynes Technologies. When trade began this morning, the stock was down 9%. Now it's down only 1.5%. It's a very, very sharp recovery from the opening lows. And more importantly, the stock is in the F&O band today. So no new positions here can be taken. Look at the newsmakers. Paytm, first time in its history that it has received a price target over its IPO price. That is after Bernstein raised its target to 2,200 this morning. So 6% higher on Paytm. Aarti Pharma Labs is a result reaction, is up in a 20% circuit. And Electronic Smart 2 came out with results last week, extending its gains today, 9.5% higher on that one as well. And lastly, stocks at record highs. Look at Sai Life Sciences, 6% higher on that one. Look at Titan as well. The multiple price target increases coming in for this one, 3.5% higher. Sky Gold is up 9%. Shilpa Medicare too, extending its stellar run after its results last week. All of them at record highs.
Hormaz, thanks very much for running us through that list. Let's get back to focusing on some of the earnings then. It was a soft quarter for Sonata Software. Their margins have contracted on a quarter-on-quarter basis, and there was weakness across their top accounts. Let's get in, Rajshekhar Dattaroy, the CEO of Sonata Software, for more on their performance. Rajshekhar, thanks very much for joining us here on CNBC TV 18. In the previous year, you'd spoken about how these macro headwinds had led to, some of the softness that you've spoken about. Starting this quarter, how's the rest of the year looking like? I mean, what's the commentary from clients? What are the segments where you're seeing some pickup? Where do you still continue to see weakness?
No, I think some of the headwinds continued in the quarter that passed, but we are seeing good progress on the AI-led order book and AI-led pipeline. So that's positive. So we think that should accrete over a couple of quarters for us and generally in the industry as well.
Right, we take that point. Mr. Roy, you had earlier said that AI, which was about mid-teens contribution to your revenue, is likely to go all the way up to 20 to 25%. Could you give us a sense on how that trajectory has moved, and what's your updated outlook here?
Yeah. So I think our one of the good points this quarter has been that our order book has gone up 27% quarter on quarter. Yeah, our pipeline has gone up 21% quarter on quarter. So, and our overall pipeline, which is AI-led, is about 340 million today. So that's like a significant uptick and bodes well for the future. We have also taken quite a few steps to further accelerate our journey to AI by defining new set of offerings and segments that we are going to. So I think that should work well going forward.
You know, segmentally, apart from BFSI, which has grown by more than 22% quarter on quarter, pretty much everything else has seen a degrowth. Just tell us when you see a pickup there, and even in BFSI, is it delayed large deal ramp up, or is this finally some new order wins that you've clocked in the first quarter?
That's right. So we actually got, in BFSI, we have consistently won in the previous quarters. We actually had a large deal win last quarter as well. It's basically that our BFSI has grown faster than the others. Whereas certain segments, there are some softness, but I think we'll overall be able to at least come through on TMT, HLS very shortly.
What's your overall outlook for this year? I mean, the quarter on quarter, there has been a near 29% growth. If I look at it year on year, near double digit as well. So if you could give us a sense on, how the overall year would be for you, if you could put a number to that, maybe high single digits, low double digits sort of revenue growth, and also give us a sense on your margins, because first quarter seasonally the lowest, thereafter you see only progressive improvement.
No, I think coming back to first margins should see progressive improvements. It came out of 2-3 reasons, which are one are episodic and one time. So I think we should recover back going forward. So that's one. And I think the general guideline, we will maintain a similar trajectory with a positive uptick in a couple of quarters. That's how we are looking at it.
All right. Hope to regain some of those margins. But, in terms of deal wins as well, if you could give us a better picture. In the first quarter, you had one large deal only, and the international total contract value is actually down about 7.6% over the previous year. What's the pipeline like? Is it shrinking? Are you getting smaller accounts? Could you give us some visibility on what the book would look like?
I think the 2-3 things, if you look at structurally, we are trying to focus on few segments and certain accounts which we think have more propensity towards spends going forward. So I think that's what we are working on, and they have more propensity towards AI-led consumption of our offerings. So that's what we are trying to do to be able to go and regain our share of business as well as the overall volume growth that you have. On point number 2, on our order books, I think some of the larger order books are seeing elongated decision making, some postponement, so that's affecting our order books. But structurally, if you see our, especially the AI pipeline and the number of large deals are still trending pretty well.
Right. From the segments, if you could give us a sense on what is likely to outperform, what is likely to maintain the momentum that we are seeing this quarter, and what is still going to take some time to, recover.
I think RMD will probably take some time to recover just because of the overall softness of the segment itself. While we have got a win there, but I think generally this just one win. It's not a structural correction. I think our top segments that we should see improvement would be in TMT, in healthcare, life sciences, and BFSI. These 3 things looks promising.
Your international dollar revenue has been flat for almost the 6th consecutive quarter now. Do you see that trajectory reversing anytime during this year? Would that take even longer?
No, that's something that which has been a key focus for us. I think one, we have to understand that while it has been flat, we have also seen multiple client ramp downs, as many of you must be aware of, during the past few quarters, right? And yet we have been able to retain flat quarter. So that shows our resilience and being able to, and once we have gone through that pain and the churn, if you like, and then I think we should see some positiveness. But I don't want to put a time frame right now as we are going through still taking the new offerings, the new strategy into the market.
All right, we'll leave it at that. Mr. Rajshekhar Datta Roy, thanks very much for joining us here with your first quarter performance. Take a break on that note. Up next, we're going to focus on the bond market with Manisha Gupta. So stay tuned.
$24,600 for the frontline index. Let's go across to Manisha Gupta now, who joins us with all the updates coming in from Bond Street. Manisha.
Thank you so much for that. Well, when you look at the corporate bond yields, well, they are trading in a very narrow range. That's exactly what we saw on Thursday, Friday, and that's exactly what we're looking at into the markets right now as well. Well, much of the cues clearly coming in from the international markets, which also are trading flat. It is about the crude oil prices off the kind of highs that we saw when the month of August started. But the street has so much to watch out for in this week. But let me also tell you that when you look at the primary market, well, that has continued to be very, very strong. The key issues are raising sizable amounts here. So when you look at the overall market on Friday itself, the primary market issuances stood a tall 131 billion therein. The major issuances on Friday were big names as well. You had REC, Bajaj Finance, Ashok Leyland, TVS Motor, etc. And there are some major issuances which are coming into the market today as well. To begin with, you have Satin Finserv, which is looking to raise up to nearly 1.25 billion. They're doing it by issuances of 2-year bonds and of maturity of nearly 11th August 2031 therein. And then you have SK Finance. They're also looking to raise 5 billion. They're doing it via issuances of three bond maturing in 10th of August 2029. And then there is Avance Financial Services. They're looking to raise $1 billion as well. And they're doing it via issuances of bonds which are maturing in September 2027. And then there are some other bond issuances as well coming in today. You have Vedika Credit Capital. You have Monado Financial Services, Mahavir Finance India as well, which are into the market today for their private bond issuances, asking for bids that are happening today itself. If you look at the secondary market, well, the overall deals there have been slightly lower on Friday versus Thursday. Thursday was 121 billion. Friday slightly smaller at 74. But as I said, the primary market is the place which really seems to be buzzing right now. What is also going to be in focus in this week from the Indian markets is going to be the July consumer price data. Well, that comes in on Wednesday. Remember, when we saw the July numbers, they were 4% higher on a month-on-month basis. And the markets will want to see on the weather impact on inflation and, of course, the crude oil prices as that as well. So that is one data that the street will react to.
All right, Manisha, and we'll keep our eye out for that one. Thanks very much for joining in with that update on the bond market. Let's step into a break. When we return, we're going to discuss, with the management of Doot Transmission, the usage of their IPO fund proceeds. Stay tuned for that conversation.
Welcome back. Let's talk about the IPO that is opening for subscription today, Dhoot Transmission. It's an auto ancillary company looking to raise over 3,000 crores. Price band set between 829 to 871 rupees per share. We do have the management in the studio joining in with us. Mr. Dhoot and Mr. Kalani, both of them join in. Thanks a lot, gentlemen, for joining in. Look at the numbers. You know, a fresh issue of 1,400 crores, offer for sale of nearly 1,700 crores. You have about 1,000 crores of cash on your books and 850 crores of debt. So you're net cash positive. Then why raise 1,000 crores? What is the objective here? Because you already have enough cash to fund whatever growth that I'm seeing out here.
There were two acquisitions planned initially when the IPO was envisaged. One of those was a multi-link electronics company in south of India, and another was one company in west actually. One of those has already materialized. We've already paid about 421 crore in cash consideration and also invested about 100 crore on the working capital side. In addition to that, we have had other plans for that company. And the West India company also needed about a similar kind of a consideration. The second acquisition didn't materialize so far. So that's the reason why you see that excess about 400 crore on the balance sheet. The IPO money was required to repay the entire debt out of the books basically, and also prepare for the growth opportunities that lie ahead of us.
All right. So one of the acquisitions didn't go by. The other one is with you having about 500 excess cash on your books, for which you will continue to pursue acquisitions.
Right.
When it comes to your overall performance, I'm looking at your last few years numbers, 27% plus sort of revenue growth, margins around that 15.5, 15.7% sort of mark. Should these numbers continue to grow a certain way? I mean, how should we look at top line and bottom line for you? Have margins bottomed out?
So if you look at the sector where we are present today, it's a sector which is growing, and unfortunately the two-wheeler and three-wheeler sector, it doesn't cater only to the Indian market, it also caters to the world market from India, and we are very well placed with about 41% share in that market. EV, which was supposed to cannibalize the ICE, has not happened, and EV has been growing. So overall the market for the two-wheelers and three-wheelers is growing. That's the state. When you talk about the bottom line, so every customer of ours has two suppliers. It is not that we get a premium pricing to those suppliers. It's about superior execution, what we have to do. And there are a lot of areas like we clearly believe in sticking to the knitting. We do not do any irrelevant diversifications. We only put funds into areas which are related to our products, our business. So we do everything in and around the wiring harness, which means that at the end of the day, when we talk of technical pool of engineers, they will all complement each other. If you look at it, we have a decent amount of export wherein we have a good margin because of labor arbitrage which comes to us. We also do a lot of backward integration. We focus on localization. We have a management policy which doesn't have too many management layers. So very lean management.
27-28% revenue growth with margins around current levels, or should we see that improve towards 18-19% that it's been in the past?
No, this will remain towards current levels between 15 to 16.
And current revenue growth sustains?
Yeah, current revenue growth will sustain, should sustain.
All right. Ritu.
Hi, Rahul, and hi, Nitin, and welcome. Thanks very much for joining in here. I just had a quick question on your valuation. At your upper price band of 871 rupees a share, your implied market cap is about 17,800, which is 45 times your FY26 earnings. I mean, what can you tell investors about justifying this kind of valuations? What kind of top line, what kind of bottom line growth visibility you have? And also on your margins, which have continuously been coming down from 18.3% in FY24. What Mangalam was talking about now is about 15.7%. When do you reverse this trend?
Yeah, so thank you for the question. Actually, the multiples, if you look at those basically, the thing is, the multiples are derived on a weighted average number of shares outstanding, and that EPS is about 24.4 rupees. So at the upper end of the band, it translates into 36 times P. And also, if you look at the capital which has come recently, about 2,000 crore have been inducted recently by Bain, meaning last 1 year, and that is yet to be deployed. So all the effects of these M&As and all those things are not in the numbers, basically. That's one thing. What was your second question? I'm sorry, I missed it.
On the margins continuously falling since FY24, when do you reverse that trend?
Yeah, so there were two things actually which helped, I would say, improve the margins in FY24. It is not a, I would say, sustainable margin actually, what you saw in financial year 24. So that was an aberration because of softer commodity cycle and also our operating costs being at a very low level. Those were controlled during the COVID time period, and that led to a lot of improvement in that particular year. I would say sustainable margin is in the range of 15 to 16%.
All right, 15 to 16% margins. I want two numbers from you. In the next, say, 3 years, what should international business look like as a proportion of your sales? It's currently just shy of the 10% mark. And EVs, which has been seeing an increase in your revenue, it's about a fourth of your revenue. Where does that number go over the next 3 years?
So we believe that the international business should be at about 15%. And EVs should be at about 35% of our revenue.
EVs should be about 35 and international 15. Yeah. And Bain, after this stake sale, will still hold over 40% stake in the company.
Right.
What's their plan? Do they plan to periodically pare it down? It's a PE-owned company, right? So that's systemic liquidity events for stocks like ones which are owned by PEs. Yeah.
So it's clear that Bain's plan of exit is going to be next 5-6 years going forward. So it will take its own time. Right at this point of time, we had an opportunity for them to have a partial early exit. And we thought that it's a good thing because then we have 5-7 years for them to move out partially. And by that time, there'll be enough relationship with the right anchor investors who believe in the story, wherein we can just go ahead and formalize the relationships with them.
And so over 5 to 7 years, they exit entirely. What about the wiring harness business? You said that you're focused mostly on that. That's about 2/3 of your, rather 3/4 of your revenue.
Yes.
What's the growth plan for the non-wiring harness part of the business, and what does the revenue mix look like?
So if we look at it today, wiring harness business is at about 77% of our revenue. We believe 3 years from now, we are looking at a 69% wiring harness and 31% non-wiring harnesses with the same growth which is going to go on. So wiring will grow, but the non-wiring business will grow more.
All right. And at current levels, you are, close to about 4,500 crores on the top line.
Yes. We closed 4,500 last year.
Yep. So 3 years from now, is there a possibility that we see you over $1 billion? With all
we can't comment on the future numbers.
But if the current revenue growth sustains, which you said will sustain.
So I can only say that the future looks as good as the past.
Take that point. Thank you so much. We will obviously press you more when you guys list and then ask you for more numbers, which at that point you can obviously talk about a lot more when you guys are listed as against you being in the DRHP.
Thank you so much.
Thank you, Mangala.
We take a short break, come back on the other side. MDR on UPI transaction fees as the government has come out with a clarification. We discuss around that.
back. Now, amid all of that talk about a merchant discount rate or an MDR fee on UPI transactions, the government has come out and clarified, saying consumers will not have to pay transaction charges for using UPI, while the vast majority of merchant transactions will also remain free. The government has clarified that any future MDR rate, if introduced, is going to apply only to a limited set of merchant transactions, and that too above a specified threshold and at a nominal rate, perhaps even lower than the credit or debit card MDR. Dinesh Khara, former SBI chairman, and Upasana Thakur, co-founder of One MobiKwik, join us now to discuss this MDR rate on UPI after the government's clarification and what it could mean for the ecosystem. Upasana, Mr. Khara, thanks very much for joining us here. Mr. Khara, just from your experience to begin with, the wider concern, and legitimately so, has been if you impose any kind of MDR on the merchant today, what is to stop him from passing that on to consumers? Even if you're not directly charging the consumers for any transactions, what stops him from passing it on? How would you answer that?
Well, I think when it comes to merchant, they have to actually weigh their cost. If at all it's MDR is being paid or not. So actually, it's a convenience which is being made available to the merchant, and for that he is required to pay. In fact, before 2016, when the demonetization happened and when MDR was waived, before that, actually all debit card, even credit card, all these transactions were entitled for MDR discount. So we were seeing the adoption of it. And also, if at all we will look at the global experience, wherein, when it comes to even Brazil and China, these are the two economies where we have seen the adoption of the digital, and also there is MDR. And in fact, in case of Brazil, it will be as high as about 0.33%. And even in China, it's ranging from 0.33 to 0.40%. But nevertheless, we have seen that the adoption of the digital transaction is as high as about 90% in these two countries. Whereas in case of Brazil, it actually started even almost 2 years later than when we started our NPCI or the UPI transaction. So I think it's more of a habit, and merchant, of course, they have to weigh when it comes to their competitiveness. If at all they have to maintain their competitiveness, they will probably absorb these costs. And I would say that if at all you will weigh the cost of handling cash or cost of handling checks as compared to that, this would be almost negligible. So I don't see that it should be a major challenge when it comes to the adoption by the merchants.
Okay, that's an important comment. You think it'll, be economically more viable for the merchant to absorb the cost and pass it on, compared with the cost of handling checks or cash. But Upasana, let me bring you into the conversation because, as a fintech that's very much a part of this UPI ecosystem, what does it actually cost to offer UPI at scale today? And what, to your mind, is an ideal MDR fee that will make this business sustainable?
So firstly, thanks for having me here, Ritu. First thing I wanted to say, which Mr. Khara already mentioned, that even today, by the way, if I spend, let's say, 5,000 rupees from my bank account using my debit card, my Visa, Master, or any debit card, about 2,000 rupees, the merchant pays 0.9%. And below 2,000 rupees, the merchant pays 0.5%. This is the government RBI mandated MDR that is currently running on debit cards. So you see, my perspective is very simply, and to answer your question, and we all hear about, there is fraud happening, the scale of UPI is increasing. My perspective is that the cost of supporting the UPI transactions is something, that the banks and fintechs like mine are paying. And it is in the form of, the server cost to the reliability required, the uptime required to manage this huge scale of UPI transactions, the investments that go into fraud prevention and cybersecurity and innovation to make daily life UPI very easy for everyone. And, the subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. And, it's therefore to say that, UPI is free, it should serve the purpose of financial inclusion. It should always be free for consumers. But when it comes to the fact that zero MDR, as a framework that has been running, the cost has been borne, significantly by payment companies. And there are enough large merchants in India, who are doing revenues of multiples of thousands of crores. And they are paying today on credit card 1.8%. They are paying 0.9% on debit card. So why should they not pay anything on UPI? And why should the cost, be borne by players like us?
Well, Upasana, you're saying what the government is offering in terms of incentive, which as per the last budget is 2,000 crores, is only 10% of the cost. So 20,000 is the annual cost of maintaining the UPI ecosystem for the industry. And my question was, what is an ideal MDR to your mind that will make this sustainable?
See, according to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players is important. I mean, I can give you a very simple example, which will make this realistic, for our, audience. See, we are a scaled payments company. We are not the largest UPI player. I believe we are ranked number 12 or 13th, but we are the second fastest growing UPI app for the last 1 year. And, the every quarter, including this quarter, when I'm announcing the results, investors are asking me that your GMV is growing by 50% year on year. Why is your revenue not growing? I don't have any answer to give other than the fact that a huge amount of this growth is coming from UPI, where I'm investing resources but have zero revenue. And I'm saying this on behalf of every player in my industry. I'm just using it as an example to tell you that this is a major issue of sustainability.
No, absolutely. And sustainability is the word that the government also uses when talking about a potential MDR on UPI. But Mr. Khara, if you could simplify for our viewers, let's say the MDR fee is 50 basis points. How exactly is it split between, a fintech or an app that is offering that UPI, the issuer, the acquirer, bank, NPCI, any other players that are involved? And is that fee going to be, you think, introduction of this fee going to make banks perhaps, be more innovative as far as UPI is concerned, because payments as a whole has been completely taken away from banks into, the fintech ecosystem. They're not at the forefront if you look at the largest transactions. So do you think an MDR is going to bring about more innovations? And how would the MDR fee be split across various players?
Actually, when this MDR was not there, and we were getting only the subsidy amount on an annual basis, banks had started looking at payment as one of the hygiene factors. It has made to available. It has got to be made available to the customer. But when it comes to investment for upgradation, investment for technology upgradation, investment for cyber security resilience, so all those things, not as much of amount got allocated for this kind of transactions. But eventually, banks have to ensure their cybersecurity resilience overall. So that's why they were spending it per se, out of compulsion. But when it comes to sustainability of this activity per se, there were challenges. In fact, the payment companies were actually facing the brunt of it to a greater extent. So I think what has happened is that when it comes to split between, the various participants in the ecosystem, much of it will actually go towards the technology service provider. And also, when it comes to, bank issuers may not have as much of earning, but yes, of course, when it comes to settlement bankers, yes, they will be actually handling with large volume of transactions. So naturally, some part of it will go there. But in terms of exact proportion, much of it will depend upon the bargaining power of each of the players in this whole ecosystem.
Okay, so let's not speculate on that. Then, Upasana, let me ask you this. If you look at the competitive landscape of UPI, I mean, just looking at the, apps, between Google Pay, Phone Pay, and Paytm, that's almost 90% of the market. Do you think the introduction of an MDR will make it a more level playing field, introduce more competition for players like you as well? Or do you think that will continue to be the case, MDR or no MDR?
No, absolutely. I think the first thing you have to understand, and I also read some news articles where there is political commentary that the MDR is only going to help the card networks, the American-owned card networks. I actually think that it's completely contrary. I think that if there is no MDR, think about who is able to lead the pack. As you yourself said, the leaders are all people or companies with very deep pockets who can absorb without revenue going on for years and years of growth. How will all the other fintechs who don't have as much deep pocket, the independent Indian companies, how will they be able to cope up? So bringing in MDR brings in competitiveness in the market. It gives a reason for other players to invest in growth. Without MDR, there will only be the market will only be owned by people who are willing to burn, who have the pockets to burn.
All right. Unfortunately, run out of time there, not out of questions. But Mr. Dinesh Kara, Upasna Thakur, both of you, thank you so very much for joining us here and helping our viewers understand what MDR on UPI could mean. Thanks very much again for your time here. Slip into a short break on that note, but don't go anywhere. We'll get you more on the markets when we return.
Welcome back. Let's look at the frontline index right now. Stuck around that 24,600 mark for the frontline index. We've seen, contradictory moves coming in from both the Nifty Bank as well as the Nifty IT index. The IT index is supporting it, while the Nifty Bank is putting a lid on the gains that we are seeing. And both of them actually have interesting technical, data points right now. The Nifty finding some support at lower levels, but at higher levels, at the 200-day moving average, there is supply that emanates. For the Nifty Bank, which has been off highs, is finding a lot of support at the 20 and the 200-day moving average, making that 57,480 to 57,550 mark an important support zone for that index as well. But amidst all of this, it's a lot of individual stocks which are doing a lot better. We have advance decline ratio firmly in favor of advances. And because the frontline index is in this range, the option writers for options that expire tomorrow have been writing the straddle of 24,600 put and 24,600 call. Both of them come up together. You see that the combined premium of this is between 150 to 170 odd rupees. There you have it, the 24,600 call and the 24,600 put. For those who are writing this, they are bracing for a range between 24,450 at the lower level to about 24,750 at the upper level for expiry tomorrow. So that's the 300-point range that we're looking at on both these options. A lot of individual stocks, they are fairly excited. One of them is definitely Paytm, seeing a lot of long positions being added on that one, up 8% right now. Titan's the other one, which is up around 2.5% as well, at a record high for that stock with fresh longs backing it. With that, we take a short break, come back, getting more of the markets and macros.
Welcome back. Let's get you a quick check on all the macros. Oil prices climbing today. They crossed $84 or around thereabouts. Now slightly below it, about 83.61 on the Brent. Remember, both of the benchmarks had shed about 7% last week amid the hopes that there would be diplomatic talks between Iran and Oman that would lead to a swift reopening of the strait. But of course, that was not to be. Prices have rebounded after Iran stated that the waterway will only be reopened once US meets their conditions. Now, the rupee on the back of this, it opened slightly stronger at 95.70, but it quickly moved back to around the levels that you're seeing currently, 95.25 against the dollar. There's push and pull on both sides. There's weak US jobs data released last week that has lowered expectations of a September rate hike by the Fed, which has dragged down the dollar index, and that's helping the rupee. But on the other side, you have the higher oil prices that continue to exert pressure. The 10-year GSEC yields, that's trading firm around 6.77% or so. Relative stability there as far as the yields are concerned. So that's it on the macros. Back to you, Mangalam, in the studio.
Yes, that is it on the macros, Ritu. A bunch of data points that we're looking at as well. But, as we move further, just look at, the frontline indices. The auto index is actually doing a lot better. And let's talk about some of, the geopolitical developments as well. We do have Minister Abbas Araghchi's comment coming in where they're saying that they are nearing a deal with Oman to establish new maritime routes. Remember, this is Iran's minister, and they want that the deal isn't enough, however, to reopen the waterway of Hormuz. So let's look at that.
Our negotiations with Oman concern the establishment of new maritime routes through the Strait of Hormuz. These talks have progressed well, and I can say that we are in the final stages. The old routes will be replaced with new ones. Experts are currently working on the maps. This, however, does not mean that the Strait of Hormuz will be reopened. An agreement on the routes may be reached, but reopening the Strait of Hormuz depends on a separate set of conditions being met, and those conditions are being conveyed through intermediaries.
All right, with that, we wrap up on this edition of Trading Hour from Ritu Me. Thank you so much for watching. Stay tuned. The team of Halftime Report comes up next.
Medcaps perk up even as heavyweights hold steady. The market breadth remains positive with advances stopping declines, IT and realty gain while financials drag.
Titan perks up on 33% growth in Q1 same-store sales, riding a rise in ticket sizes and customer base. The jewelry to sari major expects the second half of the year to be even better as festive sales drive higher profitability.
Hitachi Energy delivers an electrifying performance in Q1, beating estimates on all fronts. The demand surges for its power gear from industry, data centers and renewable sector lifts its order backlog to over 32,000 crores.
Finance Minister Nirmala Sitharaman has clarified that merchant discount rate on UPI transactions, if introduced, will apply to merchants, not customers. She added that such a levy will support investments in infrastructure and security.
Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra. This Monday morning is Sonal Putra and Vinny Motiwala with me. Well, it's turning out to be a day which is a little mixed for the markets, you'd have to say. So we're just about consolidating in terms of the frontline indices, but the broader markets are doing better at this point in time. So we have the mid-cap index, which is up around 0.6%, and the bank Nifty, which is just about lower by around 0.2%. So we do have specific stocks which continue to shine. So Titan would be case in point. That one's the top gainer on the Nifty at this point in time, up around 3% and a couple of the auto stocks are managing to do well as well. So Hero Moto, for example, is up around 2%. Overall, it's a mixed day. Asia was marginally higher. We have Brent, which is hovering at around $84 per barrel, and gold, which is at 7-month highs. So let's see how the day progresses. As of now, it's a quiet start, you'd have to say.
Hey girls, good afternoon. We did see that recovery at around 10 a.m. We have been consolidating, as Ekta said, at those levels. So for the Nifty, 17 points higher as we speak. Nifty Realty is the top gainer in trade today. We do have mid-caps which are contributing. Even IT is not far behind. But some pressure which is coming in on the PSU banking side. You have oil and gas which is not doing so well. So it's the banking pack in general which continues to be under pressure. But look at the move that we are seeing in the broader markets, Vinny. A lot of earnings, but yes, finally, towards the fag end of the earnings season. So girls, time to take a break.
Absolutely time to take a break maybe, but still just a week to go, but a lot of movers on the back as well, right? Like Sonal mentioned, so we'll watch out for all those names through the show as well as through the day as well. Hitachi Energy, Azad Engineering, Inferge will report its numbers, Quality Power too. On that note, let's talk about what's on the show for you all today, and we'll be connecting with the management of Quality Power as well as Raymond Realty to discuss their Q1 numbers as well as the road ahead for the company. Vivek will also be putting the spotlight on all the stocks that are moving around in the trading session this afternoon, so stay tuned in for that. Manisha Gupta will be in conversation with Harshal Barot with the focus on sharp surge in precious as well as base metal prices. So we'll talk about all of that through the show as well.
Okay, all right. With that, let's move on and go across to Vivek. He's here to take us through the stocks that are moving around in trade. Vivek, good afternoon.
Good afternoon. Very, very sharp moves seen on either side, given the kind of reaction we're seeing to earnings as well as news developments. We'll start off with, the list of earnings first, especially on the positive side. Titan, a clear standout performer, very strong growth, triple SG growth, very strong. And on the back of that stock, one of the top Nifty gainers in the session. Paytm, again, a lot of noise regarding likely imposition of MDR on UPI. Bernstein has gone ahead and significantly upgraded their target price. That stock higher by 8% on very good volumes today. Capital goods companies, a couple of names doing very well in the session after strong results. Both Hitachi Energy as well as Quality Power doing very well in the session. Both, have gone ahead and hit the upper circuit levels. Some of the metals and mining names today, on the likely relief coming in as far as the MMRD Act is concerned. On the back of that, look at names like Dalmia Bharat, Ramco Cement, Nalco, NMDC. All of these stocks are moving higher significantly. And BML, the company has given very strong guidance. 30% uptick is what they're seeing in revenue growth for FY27. On the other hand, quite a few drags as well. Keynes Technologies, while results were quite strong, The fact that working capital remains quite stressed is something that the street hasn't liked. That stock low by 3% has recovered quite significantly from the intraday lows. ABFRL or Aditya Birla Fashion again quite muted in terms of margins. That stock down 5%. Lupin, one of the top pharma drags in the session today. Q1 EBITDA margins was 29%. Management has guided for 25% for rest of FY27. Street has gone ahead and cut EPS targets marginally for Lupin. REC as well as PFC loan growth has slowed down for both of these names quite significantly. CLSA has cut target prices, both of these stocks down significantly, down 5 and 6%. And NLC India, while the results and especially power offtake was quite strong, one-offs have tracked back that particular stock down almost 5% in the session today.
Okay, all right, Vivek, thanks very much for that. Yes, absolutely. Lupin is under pressure in today's trading session. Remember, the conference call was post-markets on Friday, so the stock seems to be reacting to the fact that the margins would not possibly be 29% sustainably, according to the management. So that's Lupin, the stock down around 111 odd rupees. We'll take a short break, but up next we'll connect with the first company on the show, Quality Power, to discuss their numbers. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, while the market is managing to hold on to 0.1% of gain in the trading session, what's doing well today is some of the names that are coming in on the capital goods side. Whether Hitachi Energy, strong numbers that came in here. Other company that reported a very good set of numbers was Quality Power. Strong growth in terms of revenue, profitability of the company has improved as well. Order books, interestingly, stand strong as well. What is the outlook of the company from here on? We have Barindaran Pandyan, who is the Joint Managing Director as well as whole-time Director at Quality Power, joining us right now. Mr. Pandyan, good afternoon. Thank you so much for joining us on the show. And firstly, obviously, congratulations on a good set of numbers coming in here. Help us in terms of the division that is coming in for Quality Power in terms of revenue growth, Meru as well as Endox. What is the division between all these three in terms of revenue, and how was the growth this time here?
Good morning, ma'am. Thanks for having me here. All the businesses have grown. Endox, this is a second quarter for them internally where they had Eid holidays. So their growth has not been so significant. It's basically in the Indian arm, that is Quality Power, which has almost increased by about 170, 180%. The coil products business and the instrument transfer business, which again grew about 30, 40%. That is what has led to the growth. The profitability has been the highest in the coil products business, where we have been supplying mostly high voltage equipments at 65 kV and 400 kV. That is driving the profits.
So if you could also help us with the breakup. I believe in terms of revenues last time, standalone basis, Quality Power was 520 crores in last quarter is what I'm seeing. What is that number right now?
I think last quarter was about 300 crores. That was a Q4 last year. This quarter, we did about 256 crores as a total revenue as against 194 crores of same quarter last year.
Okay. And so what about the margins as well? You have highlighted that, raw material constraints and some of the products are still there. So then what is the outlook in terms of margins from here on? Last time you had given a guidance of around 25% margins for India business. Meru is expected at 15%. This time on a calculated basis, the margins are coming around somewhere at 18%. What is the target for FY27? And the challenges that come in, do we expect a bit of a downtick here then?
So the margins actually, when you look at, because we have an Ind-AS adjustment of about 8 crores, which is a non-cash expenditure, the margins of the EBITDA level stand at close to 28% and a PAT at about 21.5%. We are expecting similar guidance of 20% plus over the year. Most of our revenues are going to be strong at Q3 and Q4, where a lot of deliveries of the power converter systems for the solar products are getting out. The new factory for the PCS and the best businesses coming online, most probably Q3 this year for us. And we have bagged almost close to 1 gigawatt of BESS orders in the market, in the European market, basically.
So you did 17.5% blended margins, and you're expecting that to improve to 20% because Q3 and Q4 would be the key quarters where that contribution would come through, correct? Yeah, Mr. Pandyan? I think there's a little bit of a disruption in that feed, but nonetheless, Quality Power telling us that they are expecting that margin improvement to come through. So what they are guiding for is around 20% in terms of margins, and that improvement to probably come through in the second half of the fiscal. We'll do one thing. We'll take a short break and we'll reconnect with the management of Quality Power and be back in just a jiffy. Stay tuned. Welcome back. Well, a good advance decline ratio on our hands. So 2,400 stocks advancing to around 1,900 stocks declining at this point in time. So that's the picture on the Bombay Stock Exchange. But let's continue our conversation with Quality Power. We have Mr. Pandian, the joint MD and the whole-time director with us. So, you know, before we had that disruption in terms of connection, you were talking about the margins and you want to close out the year with 20%. Q3 and Q4 look good. But if you just could elaborate in terms of what the data center opportunity is looking like for you at this point in time. How much did you get in terms of Q1 from that particular segment? What is the pipeline looking like for you? And what can you guide on that particular opportunity?
So at this moment, most of the data center bids are under negotiation. We are talking in excess of about $150 million for the coils product business. That is what we're negotiating. We believe there is a long runway, especially in the American market for the data center business. And we may get some good news in Q3 and Q4 this year. Large order wins is what we're looking at.
You say good news. Can you quantify what you are talking about in terms of, say, the opportunity order wins in Q3 and Q4? What might the quantum be?
Most of the data center orders, along with being large, also have a timeline. They expect us to deliver in about 9 to 12 months. This creates a certain stress on the manufacturing capacities because you cannot allocate all your capacity to one single customer or one single project. So depends on how much of factory we are able to bring alive, the new capacity online. And once we are comfortable with the capacity coming online, I think we can book far larger orders than what we are booking on the coil product business. The margins at the data center level look quite good at this moment. And we see in the next 2 years that being the growth drivers for especially the high voltage coil products business.
Okay, so data centers would be the growth driver from here on. You do have a lot of expansions which are coming on stream as well. Be it Sangli, which is targeted for August 2026. You have Endox Turkey facility as well. Are these on track? What is the incremental revenue that you're expecting in FY27 itself? Assuming it will not be at peak capacity utilization at that time. So what is the additional revenue here? What kind of revenue will you see at peak?
The Endox Turkish facility is built to be about 4 gigawatt for the best PCS business. We are anticipating at least 1 gigawatt we should be able to deliver in the next 9 months' time. That is what we are attempting to do. Apart from it, we are also looking to bring the PCS faster than expected into the Indian market because we are able to get the scale what we wanted in the international market. That brings down the price drastically for us to enter the Indian market. Apart from it, from the Indian factory, I think we should be seeing at least 50-60% incremental growth in the next few quarters before we start talking much larger numbers.
What is the absolute revenue that you're expecting over the next 9 months from the international and the Indian facility?
This year we have guided to be about 20%, and the next year on that base, another 50% is what the current guidance are. We would like to stick to it. The order books are quite strong. Even the order pipeline is extremely strong, what we have bid. The Endox PCS and the best battery storage business is strong at this moment. On the instrument transformer business, which was earlier a low margin business, we are delivering close to almost 18% this quarter in spite of what happened with the copper, oil and coal. Otherwise, our expectation is that we would have delivered about 23-24%. That would have increased our margins more. Overall, I think we have been managing the execution quite well, and we hope to continue doing a good job the next few quarters.
Okay, strong execution expected to continue. Margins also will be 20+% around by FY27. And you said 50+% growth on the 20% growth that you would see. So next year we would be seeing better growth of around 30% then, right? For FY28.
Maybe more, ma'am. Okay. Maybe more. Okay. The order books need to be delivered in about 15 to 18 months' time. So we have the customer behind us than the investors.
Okay, absolutely. And, thank you so much, sir, for joining us this afternoon, giving us an outlook in terms of the company as well as what we should be expecting in terms of growth here as well. Thanks so much for that. That is the management of Quality Power, 20+% growth, margin expectation at the end of FY27, 20+% growth in terms of revenue as well expected this time. But that's the update there. Stock is locked in upper circuit. Let's move on and go across to Mangalam, who's here to tell us what's happening in the world of F&O this afternoon. Mangalam, afternoon.
Well, there's so much uncertainty all over, and apart from that, there are news on both the good and the bad side for the frontline index. Nifty has decided to just consolidate, and that's exactly what is taking place as well right now. Smidge higher right now as against what we saw about 15 minutes ago, holding about the 24,610 mark, but it is still in a very tight band. The important thing, however, to track is how the Nifty Bank moves from here on and whether the IT index continues to maintain the recovery momentum that it has seen in the past. But amidst all of this, there is a decent sense of optimism in the broader markets. That's what we're seeing in the advanced decline ratio as well. Through most of today's trading session, we've had a few more number of stocks advanced than the number of stocks which are declining. That makes portfolios feel a lot better, especially after these moves on the upside largely have come by on the back of good numbers. But ahead of expiry tomorrow, weekly options expiry, we've seen the 24,600 straddle, which is a call and a put, both equally active. 2.5 crore shares added in open interest for the 24,600 put, premium of 75 rupees, telling you that around 24,500 there would be support. And the 24,600 call comes up for you as well. And we've seen a lot of writing there for a premium of almost 97 rupees. Around 24,700 is where the expected resistance is for the frontline index. For those who are writing both the call and the put together, are playing for a premium between 150 to 180 odd rupees. Again, the broader range that they are expecting expiry for tomorrow would be 24,450, 24,420 to 24,450 as support, and on the way up, 24,750 to 24,800 as resistance, and that ties in with the 200-day moving average on the Nifty itself. So those are a bunch of cues that we'll be tracking from the F&O standpoint in tomorrow's trading session. Right now, the Nifty is slightly higher, but 24,600 is definitely the fulcrum.
Okay, all right. Thanks very much for that, Mangalam. So that's what's taking place in terms of the F&O space in the markets. Just watch out for a couple of stocks such as Sudeep Pharma. That one has been on a tear post its numbers, which came out last week. It's up around 10% at this point in time. It's rallied 19% on a month-to-date basis and is up a cool 74% on a year-to-date basis. So that stock is managing to hold up. But to talk more about the markets and the technicals and the setup, we have Somil Mehta of Mirae Asset Sharekhan joining in this Monday. Somil, thank you very much for taking the time out and talking to us. Well, 24,600 is being maintained on the Nifty. What's your call technically?
Good afternoon to everyone. So my call is positive. I'll be positive on the markets. Nifty is trading about 20, 40, 200 daily exponential moving average. Nifty's been trading in a triangular shape pattern from the last week, probably 5 to 6 trading sessions. I'll be expecting this pattern to break on the upside. And the most important part is that Nifty is holding on to 10 daily exponential moving average, which is around 24,500. Now, on the upside, my targets would be around 25,000 in the short to medium term outlook. I'll be expecting this rally to continue. We are making higher top, higher bottom formation since a little while now, and I'll be expecting it to continue. There are sectors which are looking really good. Metals are looking good. IT is looking good. And in fact, even PSU banks are looking good. It's just a halt today, but I think PSU banks are looking good as well. I have 2 stocks from the metal pack and the defense pack as well. So I have one Jindal Steel on my list. Jindal Steel is looking good. It's been trading about 200 daily moving average. A small consolidation breakout on the upside. My targets for Jindal Steel is 1080 and the stop loss is 1090. The second stock which I've chosen is BDL from the defense pack. BDL has just started moving up, started making higher top, higher bottom formations. This is a reversal trade I'm taking. I'll be preempting this move that in the medium term outlook. My stop loss for BDL is 1260 and the target is 1380.
Okay, take that point, Somil. Thank you so much for joining us as always. So those are some technical bets and levels on the benchmark index. Time for a break now. On the other side, Manisha Gupta will join Harshal Barot of Metals Focus. Stay tuned for that conversation.
Welcome back, and joining us on the show now is Harshal Barot, who's Senior Consultant, Southeast Asia and Middle East Metal Focus. Thank you so much for joining in, Harshal. What is your sense, first of all, in sense of the gold prices? Strong gains in the previous week, and that usually does happen around August and September, where we see a week where we've seen very strong gains. So 6% up for gold, 10% up for silver in the previous week. What is your sense on what's happening, and where are the markets taking cues from?
Good afternoon, Manisha. I think, both gold and silver have finally, seemed to have turned a corner. We've seen on the lows, 4,000 odd dollars, that being defended very well. The market made, quite a few attempts to go below that. But given the macro backdrop that we have now, we think that prices will start to gain from here on. So the uncertainty about the Fed, although it still remains, but we believe that the Fed is not in a position to, hike rates aggressively. So even if we say, for example, see just one rate hike happening this year, we don't see this as a start of a monetary tightening cycle. And the markets itself, I think, have started casting doubts on the ability of the Fed to hike rates, given the employment numbers that we saw coming from the US, given the volatility that we've seen in currency and the bond markets, in the US as well. So all in all, I think, even seasonally, the biggest consumer, India, we are seeing, we are nearing the festive and wedding season in India. So demand also has started to pick up. Investment sentiment also has started to improve with the price starting to go up. So I think all in all, we think the price trajectory is up from here. We could see some resistance to the price coming around $4,500, but eventually I think we should be closer to 4,800, 5,000 odd levels, by the end of this year.
The Indian demand is what I wanted to come back to on. When you're looking at lower carriages and lower weightages, would you say that the volume perhaps could see a decline this season?
So volume, of course, Manisha, as you said, because of the structural reasons, we are seeing a pressure on volume in a sense. But given the sentiment that we've seen, I was in the IIJS last 3 days, and retailers and even manufacturers, are very, very optimistic. The order volumes that the manufacturers have seen has been, in fact, higher than last year, and according to some, the highest since COVID that they've seen. So there is this element of pent-up demand in the market, given the first 2 quarters of this calendar year were slow. So yes, the trade is optimistic. The consumers have started to come back with the price stabilizing, over the past couple of months. And I think, so people are geared up for a good festive season, and we definitely think that demand should improve compared to the first half of this year.
Harshal, how are the import numbers into India now looking like? Because we do understand that April, May, June weren't so great. Is July any better? And what are you looking at as in sense of imports in the first half of this year and your expectations for the second half?
So first half, as you said, Manisha, was slow in a sense. January, February was stronger, but after that, we've seen, a series of declines in terms of imports. July, although we don't have any official indication, at the moment, but it certainly looks that the market is better than June. But I think the key numbers to watch for would be August onwards, because based on the order flow that fabricators are getting at the show, we could see, demand pick up from this month onwards.
Also, what's your sense on silver? Because 10% of gains in the previous week, is it a buy call coming for this one too? By year end, where is silver standing? And also the silver import numbers, how are they looking like?
So silver, a couple of things, Manisha. Broadly from a trend perspective, it seems to always follow gold. So we are, looking at an uptrend in silver as well. So by the end of this year, $68 to $70 levels. 68 to 70 could be in the next month or so, but eventually we are looking at 85, 90 odd levels as well coming into silver. But in the short term, I think there are some challenges from an Indian demand perspective. So although we are seeing, festive season demand starting to pick up, but the imports, whether the trade will be able to import to, fulfill the demand is a question, because the quotas that traders are getting at the moment, are lower than what typically the demand is during the season. So premiums in the market could stay. So currently they are around $2.50 an ounce premium in India. So that's come up from the peak of around $6.50 that we saw in July when the imports were absolutely not coming in. So some trickle of imports started to coming into India with people getting permissions to import, but the absolute quantity that they've got is far lower than what the typical demand in India is at the moment. So if the trade is not able to import as much, I think that should pressure the price in a sense or keep the rally capped in our opinion. So in the short term, it could probably underperform gold is what we see.
In sense of prices or demand?
In terms of prices, it will underperform gold. In terms of demand, as I said, although there is demand in the market, but whether we are able to fulfill that demand by bringing in imports is the question that needs to be answered.
All right, after a very long time, it's gold that is the place to be and not really silver. So gold perhaps expected to outperform silver in sense of prices going forward.
We haven't heard it in a long time.
Right,
Gold.
yeah.
Okay, all right. Thank you, Mr. Barot, for joining us today. Thank you, Manisha, for taking us through that conversation. With that, we'll slip into a short break. When we come back, we'll connect with the management of Raymond Realty to discuss their Q1 numbers and the road ahead. Welcome back. You're still tuned into Halftime Report. Let's talk about Raymond Realty. Posted a good quarter. Pre-sales more than doubled and collections were also up sharply on a YOY basis, driven by demand across ongoing and newly launched projects. To discuss the quarter and most importantly, the outlook going forward, we have with us Mr. Harmohan Sahani, the MD of Raymond Realty, joining us now. Mr. Sahani, good afternoon. Thank you so much for joining us. Well, you've maintained your pre-sales growth of 20%. You're also looking at a return on capital employed at 20%. So that's the guidance for FY27. But if I look at the numbers for last 6 years, your pre-sales have grown from around 680 crores in FY20 to around 3,000 crores in FY26. Give us a sense of what will the next 6 years look like if you're looking at a long-term number. Will pre-sales double? Will you be growing at that 30% CAGR that you've seen in the last couple of financial years?
Well, Ipi, thank you. First of all, thank you very much for having me on the show. And yeah, if you look at the past trend, yes, the base was low, so obvious growth is very steep, and that's how you see it. But going forward, the guidance we have given is about 20% per annum. And if we look at a 20% per annum growth, if we just do the maths, you know, in every 3 years, 3.5 years, we would be doubling. And that is true for pre-sales as well as the top line. And that's how the entire calculation has been done. If we look at the next 5 years long-range plan that we have drawn up, I think that also shows us that every 3.5 years approximately we should be doubling.
Okay, so every 3.5 years, your pre-sales would be doubling. We're also talking at a time, Mr. Sahani, when we have seen a big surge in pre-sales in the last couple of years because of the real estate cycle seeing an upswing. Now, there have been projects, there have been developers who are offering concessional payment plans. There was a project where 10% upfront payment and 90% on possession is the kind of, offers that are given out to buyers as well. Do you think this is something which could happen to more projects, more builders? And what does it talk about the demand that we're seeing currently in the market?
Well, if you look at the demand, our experience has been so far the demand is quite strong. There is no dent that we have seen which is of a significant nature. It is a seasonal business, so that's something we have to account for. So Q1 is always the lowest that the industry sees. Q2, it marginally picks up. And Q3 and Q4 is when you see most of the sales happening. Yeah, our experience has not been that we have seen any
Mr. Sahani, it's just not a quarterly. No, I'm just not talking from a quarterly perspective. I want to understand industry dynamics in general. If a builder is providing, payment plans at such concessional rates, do you think we could see a ripple effect of this? Are we at a juncture in the real estate cycle where we could see more discounts coming in, or at least better terms being given to the buyers?
So these kind of payment plans have existed even in the past. It's not as though you're seeing them now, but I'm not seeing a trend that everybody is offering them. If you look at, the real evidence is going to be when you look at strong players. We are not talking about marginal players or players who don't really have the financial strength or the balance sheet, and they have taken on a large project. If you look at all the established developers, the corporate balance sheets, which are there, I don't see a trend where everybody is offering this 90-10 scheme. There will be instances where people are offering different kinds of schemes, and it could also be project specific. Now, it is not across the board, not for all projects, not for strong developers. So there is no trend emerging. Anecdotal evidence can only tell you that much. You can't draw real conclusions about the industry based on anecdotes unless there is a clear trend which emerges.
Right, so point taken there, Mr. Sahani. Good afternoon. This is Vinny joining in the conversation as well. What about your collections as well, right? Collections have been improving. So what is the target in terms of collection growth for the full year that you have? And if you could help us understand the lead cycle time also that is there normally for collections, post the project is sold, what is it over there?
So, collections really follow the construction plan. If you see 80 to 90% of our sales that we have done in the past and we continue to do are all construction linked plans. And, we talked about other collection plans which are there, which broadly constitute 5-10% depending on consumer demand. But by and large, it's construction linked. So typically what happens is on launch, and by the time your excavation gets over, you get almost about 30%, 35% of your total sale value in hand. And by the time your superstructure is ready, the industry norm is you have collected around 80% of your money. And it's only after that, some bit is relating to your finishes, and then the balance is going to be for possession. So as far as we are concerned, I mean, Q1, we've had good trajectory as far as collection is concerned. 550 crores we've collected, which is almost a 45% jump from the corresponding quarter last year. So there is a bump up that we are seeing. Well, that's also an equation of how many projects we have launched. Last year itself in Q4, we launched 4 new projects. Which was outside of Thana. Other than that, in Thana, we launched a few projects. So in all, 7 projects were launched last year.
Sure.
So all that collection will start to come in this year. And as projects mature, more and more collection we'll see. Last year, our full year collection was, if I am not mistaken, in the range of 1,800 crores. And we'll definitely do better than that in the current year, because we have many more projects in terms of collection. But the flip side is that with all these projects, there is also a demand on cash flow, because projects have to move fast and forward, and we have a reputation of delivering on time, before time for all our projects. So we'll continue to do so. We are currently in a high growth trajectory. So when there is growth, there is always demand for capital. So we will have a certain demand for capital, and but yeah, collection still looks pretty strong, and it will grow more than 20% compared to last year.
All right, Mr. Sani, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So the collection growth should be around 20-odd%, not seeing any sort of big disruptions in the market at this point in time in terms of pricing. That's the word coming in from Raymond Realty. Well, for the markets, it's absolutely quiet at this point in time. The mid-cap index is managing to hold up with a gain of around 0.7%. Talking about real estate, we do have some news coming in from Man Infra. So maybe that should come up for you. The stock is up around 2-odd%. Raymond, as you can see, is down and out in today's trading session. We'll take a short break, but a lot more in terms of the markets and a lot of stock-specific action on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. While the Nifty is holding on steady at around those 24,600 mark, around that level, slight bit of a dip from that level as of now. But yes, still holding on to that 0.1% of gain. What's not doing well in today's trading session? That's going to be Inox Wind. They reported their numbers, Q1 FY27 numbers over the weekend, a weak set of numbers that's coming from the company. Revenue that's declined for the second consecutive quarter, this 1% degrowth that we're seeing in terms of revenue for the company. Margins have continued to be under pressure even during Q1 FY27. 18.7% is what the margins came in at versus last year of around 22%. Now, in terms of the order book, that's standing at 4.4 gigawatts. They've said that 4 times wind turbine prototype that will remain on track and that will be installed by August 2026. This is the commentary that came in from their con call as well. And this is overall, they're targeting a commercial launch for this by the end of this year as well. So that'll be interesting to watch out for. Now, the company has reiterated their FY27 guidance for a strong growth of 75% YOY revenue growth, while in terms of 20 to 22% in terms of EBITDA margin. This is according to the con call highlights. But despite all of this, the weak set of numbers, execution still a bit of a concern that everyone's keeping an eye out on. And that is what the street still seems to be worried, despite the guidance, despite all the installations coming in as well during the second half of the year. So the stock is down almost 4 to 5% in the trading session, Ekta.
Okay, so that's on Inox Wind. That stock is under pressure, down around 4.3%. But I'm also tracking one stock which is down close to around 4 to 5%. So a little more details with regards to Lupin, and really has not gone down well with the street. So remember, the FY27 guidance is organic growth at high single digits, EBITDA margins at around 25%. The US business is guided to be around $1.1 to $1.2 billion, and that is better than what the initial estimates were. India should grow around 1.2 to 1.3 times of the Indian pharma market. Now, FY28, the US business should see growth on the back of exclusive first-to-file opportunities, biosimilars, 505(b)(2) products. So that's basically what they are guiding for in FY28. But what has really deterred the street is basically the FY27 guidance. You've done around 28-29% in terms of margins this quarter. So why are you not confident in terms of your margins going forward? So that is because of reasons such as tolvaptan, which is one of their key drugs in the US markets. That's probably going to see some amount of competition. That's going to impact their realization, as well as there would be cost pressures with regards to the geopolitical risks that a lot of the companies are facing, and that's why they're sticking to their guidance of around 25%, and that's what's making them a little cautious on that. So that's the reason why the stock is currently down around 5% in today's trade.
Okay, that's about Lupin. By the way, CESC, an important flash at the bottom of your screen. It's a big acquisition, 4,900 crore rupees. They've bought over Renew Solar Power's solar portfolio, that is around 1.4 gigawatt. The stock spiked, then it came off from the highs of the day, so it is a big one. Their arm, Purva Green, will be making this acquisition. So a big deal in the renewable space. We'll, of course, get more details how it will be funded. So this is going to be funded by the parent company, which is CESC. How are they funding it? Where will they get these funds from? All these details are something which are important to understand, but it's a big acquisition, a 4,900 crore, 1.4 gigawatt acquisition from Renew Solar Power. That's the announcement coming in from CESC. And with that, it's a wrap on this edition of Halftime Report. Let's do one thing. Let's take a break, and Business Lunch will take all the action ahead.
Mid-caps perk up even as heavyweights hold steady. The market breadth remains positive with advances topping the declines. IT and realty gain while financials are the big drags.
Titan perks up on 33% growth in Q1 same-store sales, riding a rise in ticket sizes and customer base. The jewelry to sari major expects the second half of the year to be even better as festive sales drive higher profitability.
Hitachi Energy delivers an electrifying performance in the first quarter, beating estimates across fronts. The demand surge for its power gear from industry, data centers and renewable sectors lifts its order backlog to over 32,000 crore rupees.
Finance Minister Nirmala Sitharaman has clarified that merchant discount rate on UPI transactions, if introduced, will apply to merchants, not customers. She added that such a levy will support investments in infrastructure and security.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. You know, it's a mixed day for the markets, and the Nifty, they're consolidating at those levels. So right now about holding close to 24,600 at this point.
There's not much action on the index. The broader markets is where the actual action has been through the day. The Nifty today too has had a 100-point range all through the day, and it has continued to remain so. The broader markets had an initial dip, but that dip got brought into, and now the mid-cap index is at the highs of the day. And well, that's where the action is. We are into the final week of the results season, and the result reactions are the ones that are dominating proceedings here. Just look at PFC before we move on. The stock is now moved to the lows of the day. 8% lower now on PFC, and it's been a big gash after a rather relatively subdued quarter for the company. Paytm, though, on the other side, not an earnings reaction, but is possibly the stock of the day now. The first time in its history as a trading company, as a publicly trading company, has it received a price target in excess of its IPO price, and you can see the reaction on your screens as well. 9% higher now on Paytm at the highs of the day, 52-week high to say. Nonetheless, of course, there are plenty of other result reactions that we are tracking through the day, awaiting results as well from Bharat Forge and Vodafone Idea and Zee Entertainment. So it promises to be an action-packed second half as well.
Absolutely. And speaking about earnings, Titan doing really well on the back of those strong numbers. And we've got Keynes Technology, which is actually lower in trade because, you know, it had a weak quarter. But if you look at the sectors, realty is the top gaining index and is up 1.8%. We've got DLF, that's up nearly 3%. So if we can bring that up, Brigade Enterprises nearly 5% in the green, and Godrej Properties nearly 2% higher. We've also got those IT names that are managing to clock some gains today. The index is 0.5% in the green. We've got LTM, Coforge, Emphasis, all of them between 1 and 3% higher. On the downside, we've got those PSU banks, which are the top losers today. We've got SBI, Canara Bank and Bank of Baroda, all of them between 1.5% to 2.5% in the red. But our top focus today is Titan, Hormuz.
Oh, indeed. And it's a record high for Titan now. It was a very sparkling quarter, as Manglam has been highlighting since the morning. Let's go across to him as well, who will give you more details on this. Manglam.
Well, it has been indeed a sparkling quarter for Titan this time around. The stock going into numbers was at a record high, going into its pre-quarter update was at a record high, and now post its numbers is also at a record high. And that's because, you know, the leader outperforms on such a large base, you know that it is execution and growth engine which is firing for them. Yes, the jewelry sector on the whole has done a lot better than the other parts of the consumer space for the last many quarters, and in that Titan's growth has come back. And how? The revenues come in at close to 18,101 crores. This optically looks slightly shy of our poll, and that's largely because the poll does not take into account, you know, the variability that we see on account of the gold ingots that the company sells at the end of the quarter as well. But the EBITDA, that has come in at 2,550 crores. This compares with the poll of sub 2,000 crores. The net profit at 1,700 crores. That compares again with a poll of 1,250 odd crores as well. Even if you discount the impact of higher realizations on account of, you know, the increase in gold custom duty by about 386 crore and some inventory revaluation in the watches business, adjusted for that, the EBITDA is 2,150 crores, which is still 150 crore plus beat coming in on the CNBC TV 18 poll. If you look at what the management commentary was as well, same store sales growth in jewelry business at 33%, average ticket sizes grew by 31%, buyer growth came in at 5% as well, and studded share at 27%. All the other growth drivers of the company doing extremely well. They are committed to double-digit growth in the company for this year with buyer acquisition and market share gains. and they target jewelry margins to be at 11% with a possibility of an improvement in the second half of this year as well. They've maintained and gained market share at around 8.5% of the overall market, and they believe that even though competitive intensity is elevated, it hasn't materially worsened. All these things, sounds of music to the investors, and that explains why the stock, despite being at a record high and record valuations, continues to do well.
All right, Mangalam, many thanks for taking us through those details. Now, Dhoot Transmission's 3,067 crore rupee IPO has opened for subscription. The company is among top 2 players in India's 2- and 3-wheeler wiring harness market with 41% share. Earlier today, we spoke to the management of the company to understand the growth prospects going forward. Listen in to what they had to say.
There were 2 acquisitions planned initially when the IPO was envisaged. One of those was a multi-link electronics company in south of India, and another was one company in north, west actually. One of those has already materialized. We've already paid about 421 crore in cash consideration, and also invested about 100 crore on the working capital side. In addition to that, we have had other plans for that company. And the West India company also needed about a similar kind of a consideration. The second acquisition didn't materialize so far. So that's the reason why you see that excess about 400 crore on the balance sheet. The IPO money was required to repay the entire debt out of the books basically, and also prepare for the growth opportunities that lie ahead of us.
So it's clear that Bain's plan of exit is going to be next 5-6 years going forward. So it will take its own time. If we look at it today, wiring harness business is at about 77% of our revenue. We believe 3 years from now, we are looking at a 69% wiring harness and 31% non-wiring harnesses with the same growth which is going to go on. So wiring will grow, but the non-wiring business will grow more.
Now, the government has issued a clarification over its plan to charge UPI transactions. Person-to-person transactions will remain free, and the MDR, if introduced, will only be levied on select merchant transactions above a certain threshold. Earlier, we spoke to former SBI Chairman Dinesh Khara and the management of MobiKwik to understand how these developments could be implemented and impact payment companies. Listen to what they had to say.
This MDR was not there in the system, and we were getting only the subsidy amount on an annual basis. Banks had started looking at payment as one of the hygiene factors. It has made to be available. It has got to be made available to the customer. But when it comes to investment for upgradation, investment for technology upgradation, investment for cyber security resilience, so all those things, not as much of amount got allocated for this kind of transactions. When it comes to split between, the various participants in the ecosystem, much of it will actually go towards the technology service provider. When it comes to settlement bankers, yes, they will be actually handling with large volume of transactions. So naturally, some part of it will go there. But in terms of exact proportion, much of it will depend upon the bargaining power of each of the players in this whole ecosystem.
Subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. According to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players is important.
The government has tabled the Mines and Minerals Act in the Parliament. The legislation will allow the centre to impose additional conditions for state governments to levy tax, cess or levies on mining rights in mineral-bearing lands. Ashmit Kumar gets us all of those details. Ashmit?
Well, what we're picking up is that the MMDRA amendment bill has already been introduced in the Lok Sabha. Now, this will be important not just for the centre, but also for the states as well as for various mining companies. Why is that? Well, essentially, what the amendment seeks to do, amongst various other things, is to impose conditions on the power of the states to levy a tax, a levy, or as far as royalty is concerned, on mining rights as well as mineral-bearing lands. Now, this is important because the centre will now have the power under this bill, if it's passed subsequently, subsequently by the Parliament, the centre will have the power to prescribe these additional conditionalities. Why is that significant? Because bear in mind, circle back to 2024, that is when the Supreme Court in fact had held by way of a 9-judge bench judgment in favor of the states that states can levy royalty as far as mining is concerned. That came in as a big win for the exchequer as far as state governments are concerned. However, that did spark concern as far as the mining companies are concerned. They were batting against such a levy of royalty, saying that this royalty is tantamount to additional taxes being levied. However, in 2024, the Supreme Court had held in favor of the state governments, but there were two important caveats. Number one, the Supreme Court had said that there is no existing restriction as far as the state's power to levy such a royalty is concerned, a tax, a levy, a fee. There's no restriction as such. Number two, the second caveat that the Supreme Court had given is that the centre is at liberty to come out with fresh restrictions if it thinks it necessary through additional legislation, through a new law, which appears to be happening as far as this particular amendment is concerned. The MMDRA amendment bill, it's currently been introduced in the Lok Sabha. We have to see whether or not it gets passed by the Parliament, but importantly, will have big implications on one, the royalty output as far as mining companies are concerned, and of course the state governments themselves in terms of how much money they can look to garner from such mining operations in their respective states. Back to you.
Ashmit, thank you for that. An important development that we'll be keeping an eye out on. Numbers from Astra Micro at the bottom of your screen. Profit down by a quarter. Revenues are down 11.5% as well. There has been an impact on the operating performance for the company. It will be interesting to see what are the kind of internals or what are the factors that have contributed to this fall and this weak operating performance that the company has reported. 8% lower now on Astra Micro, a complete nosedive that the stock has taken. Margins are narrower by 140 bips as well, so 19% compared to 20.5% in the same period last year. Take a short break. Back with more on the other side.
Welcome back. You're still with us on Business Lunch. On to the latest updates from West Asia. US President Donald Trump says Washington is only semi-negotiating with Tehran and will wait for economic pressure on Iran to mount. Meanwhile, Iran's Foreign Minister Abbas Araghchi says they are nearing a deal with Oman to establish new maritime routes, but warns that the deal isn't enough to reopen the waterway. Take a look.
Our negotiations with Oman concern the establishment of new maritime routes through the Strait of Hormuz. These talks have progressed well, and I can say that we are in the final stages. The old routes will be replaced with new ones. Experts are currently working on the maps. This, however, does not mean that the Strait of Hormuz will be reopened. An agreement on the routes may be reached, but reopening the Strait of Hormuz depends on a separate set of conditions being met, and those conditions are being conveyed through intermediaries.
And Dan Murphy now joins in with the latest updates from West Asia. Dan.
What we're waking up to once again this morning is more narrative whiplash from both the Iranians and the United States. Just a week ago, President Trump was close to ordering a return to major combat operations against Iran. Now, in this new interview with Axios, he's signaling a very different approach. President Trump making no new military threat, saying the U.S. is, quote, low-keying it, as he put it, and only semi-negotiating with Tehran. Now, the pressure campaign is largely economic, it would seem. President Trump saying Iran is in very bad shape and also crediting the U.S. naval blockade with deepening its financial crisis. But the Strait of Hormuz, as you've just heard there, remains a major sticking point. A framework negotiated by Iran, Oman and the United States has been pending for several days now. Iran, of course, now adding a broad set of conditions, including an end to U.S. military pressure, sanctions release, the release of frozen funds. They want compensation and war reparations as well, once again shifting the goalposts on what could have been an agreement here, an agreement that the U.S. Treasury Secretary alluded to CNBC earlier in the week that would be coming. U.S. officials essentially describing this as a split inside Iran's leadership between those that are pushing for a deal to ease the economic crisis that the president is talking about and those hardliners inside the regime that are also resisting concessions as well, essentially pushing for this long-running conflict to continue. What's also interesting is that Washington, for now, appears willing to wait as well. The Vice President, J.D. Vance, also summing it up in an interview on Fox News this weekend, saying this thing is not over. We are in the middle of the game. So oil prices attempting to ultimately price what could happen next here. But of course, no major diplomatic breakthrough at the weekend and the rhetoric continuing to harden on both sides.
All right, Dan, many thanks for those details. Now, keeping it with the news flow from the U.S., the U.S. Senate has passed an aggressive sanctions package targeting Russian energy revenues amid its offensive against Ukraine. The bill, with an 86-11 vote, clears a procedural hurdle and heads to the House of Representatives before becoming a law. Remember, the measure, if passed, sets up to 100% tariffs on nations importing Russian oil and gas, such as India, China, Azerbaijan, Hungary and Slovakia. India, remember, is the second largest buyer of Russian crude following China, and the said legislation threatens Indian exports to the U.S. with tariffs on top of the 50% already in place since August of last year.
Take a short break then. More news and updates on the other side. Stay tuned. Welcome back. Now, U.S. employers unexpectedly shed 23,000 jobs in July, while gains for the previous 2 months were revised sharply lower by a combined 103,000 jobs, painting a weaker picture of the labour market than earlier data indicated. CNBC's Steve Leisman is here with more details.
Some weakening in the job market, but at the same time, it's in line with the relative stability that Fed officials have talked about. I'll show you the numbers here. Minus 23,000 on non-farm payrolls, but not, unfortunately, far off what's needed to keep the unemployment rate unchanged between 0 and maybe 100,000 somewhere, but the unemployment rate falling in part because some people dropping out of the workforce. Average hourly wages, though, not showing much inflationary pressure, down 1/10 for a 3.2% year-over-year rate. The decline of participation rate, part of the reason why the unemployment rate fell. And these jobs, where they were, it's kind of a curious number here. Construction doing well, manufacturing, maybe that's part of the AI story. But leisure and hospitality off 40,000. Not sure what's going on there. Could be a World Cup a backside of that, as well as maybe some concern about driving and vacationing because of higher gas prices. And local education, some people think that's a statistical problem there. Here are the percentages now, down to 44%. That's down about, 10 points or so on the probability of a rate hike. And then, but still strong, 77% for a December rate hike. Kevin Warsh in the new regime, I think, is going to be less data point dependent and more, I think, ultimately, what would you call it? Trend dependent is a better way to put how he probably thinks about all of this in a world with little or even negative job growth, in part due to immigration policies and a jobs number that has a big statistical error rate. Minus 23K still in the middle of the range. The inflation trend, that's going to be the important thing for the Fed.
So Steve Leisman there with that. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward. Stay tuned.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and Vivek Iyer will join me in just a bit. Markets consolidating at the 24,560 mark for now. It did see a sharp recovery at the start of the trading session at around 10 a.m. and has been consolidating at those levels. The midcaps, though, are doing well in trade. We'll discuss this and a lot more, but let's start the show first up with the top headlines. Benchmark indices trade near the flat line at midday with IT and realty leading sectoral gains. On the other hand, financials, pharma and oil and gas drag. Mid-caps outperform. Shares of Paytm rise in trade as Bernstein revises their target of 2,200 rupees, indicating a 52% potential upside on the stock. The brokerage states MDR could lift net payments margin by 3 to 4 basis points, driving a 30% increase in EPS for FY30.
Quality Power hits a 5% upper circuit in trade post strong earnings. The management tells CNBC TV 18 they maintain a 20% margin guidance and expect better performance in H2. Hitachi Energy, meanwhile, reports an all-round beat in the first quarter. The management tells CNBC TV 18 that double-digit growth will continue and margins will continue to improve going forward.
Shares of PFC and REC trade with cuts of over 5% as Power Finance Corporation posts a weak operating quarter due to muted disbursements, soft loan growth and net interest margin pressure.
And shares of NLC India trade with steep cuts as the company's profit sees a near 40% decline to 480 crore rupees, impacted by a one-off regulatory tariff booking.
Okay, all right. Those are the top headlines that we are tracking. The mid-caps, they continue to be on our radar. We do have a lot of focus on earnings. They're coming in thick and fast. We have Jain Irrigation right now, low by 4.5% because of weaker margins. And just a while back, we got Info Edge as well. And there was Hind Copper as well, which reported numbers. So there has been a sharp reaction to earnings across the board. We'll discuss that in a lot more. But let's talk about our special segment, Mid-Cap Movers. Ria is here to take us to the mid-caps that are moving around in trade. Ria.
Well, yes, let's start off with the gainers first. BEML has been gaining ever since posting strong results on Friday's close. Continues its gains since then, and management commentary was also optimistic in their interview to us today, wherein they said that FY27 order inflow is expected at 20,000 crores for the year. Paytm also continues to gain today. It has hit its 52-week high today after Bernstein has raised their target above the IPO price for the stock for the first time. Sai Life Sciences as well as Sirma SGS, both of these continue to gain, hitting their 52-week high as well as their all-time high today. And Aarti Pharma Labs also up on the back of its Q1 results, hitting an upper circuit of 20% today. Also looking at the top sectoral gainer today, which is the Realty Index, up nearly 2%. There's Brigade Enterprises, DLF as well as Godrej Properties, all on the list today. On the flip side, looking at the losers, we have NLC India, Apollo Micro as well as Inox Wind. All three of these reacting to their Q1 results. In fact, Inox Wind has also hit its 52-week low today. And apart from that, we have Lupin as well as Amber Enterprises, which are lower in today's trading session.
Well, thank you so much, Ria, for taking us through all of the stocks that are moving around in trade, especially from the broader end of the market. But as promised, Poly Medicure is the first management joining us on the show. The revenue saw 30% uptick, while profit and margins witnessed a fall on a year-on-year basis. To break down the quarter gone by, we are joined by Himanshu Baid, MD of Poly Medicure. Good afternoon, Mr. Baid, and thank you so much for joining us. Well, Q1 EBITDA margins actually improved, to a little over 24%. But, when we are comparing it to FY26, and to FY25, it's still on a slightly downward trajectory. Is this now the margin band that you expect slightly lower, or can we now inch upwards once again to the 25-27% range?
See, basically, if you see the margins are consolidated margins, including our subsidiaries, the companies we acquired late last year. But if you look at a standalone performance, we are almost close to 28% EBITDA. And if you look at a consolidated basis, because those companies are still operating at a lower EBITDA margin, it'll take for a few more years for them to catch up to that close to that 20% number. So hopefully we will see those improvements coming in coming years. Definitely, we are sure about that, because as synergies kick in, we'll see that margin improvement.
Okay, so margins will improve once synergies kicking from these acquisitions. Mr. Baid, on the acquisitions itself, they are driving significant growth for the company. What is the revenue and EBITDA contribution expected from these acquisitions in FY27? And when you're talking about FY27 growth, can you split it up for us? How much will come from organic? How much will be the inorganic growth going forward?
See, as we had initially told in probably end of the financial year last year, we have talked about India business to be in the range of 1900 to 2000 crores. And that would be probably at an EBITDA level of around 26 to 27%, which is still higher today, is around 28% today, but we are guided for in that range. And then if you look at the international businesses which we acquired last year, this would be around close to 400 crores. In there, we see a EBITDA maybe of around 11 to 12%.
Okay, so 11 to 12% from the acquired entities is what you're targeting. Well, one particular point of concern has been the renal segment. Revenues declined in Q1, and we believe that this is due to presence as well as pressure from Chinese players. We do now have an anti-dumping duty in place. So can we now say that majority of the pressure here is behind us? Can we expect uptick in revenues as well as EBITDA margins going forward?
See, anti-dumping duty is not initiated. The investigation initiated so far.
Okay.
So hopefully, in next few months, we may see some measures from the government. So we are trying to push the government to look at this segment more deeper with India self-reliance. And I think it's very important that India develops a self-reliance in core sectors, especially cardiology, renal, oncology. And I think that's one of the areas we are focusing with the government right now.
So, Mr. Baid, if it does come through, right now it's an investigation, if it does come through, what kind of benefits are you seeing? And how serious is the threat from Chinese competition right now? If you can give us some numbers in terms of the landed price versus what we are seeing in India itself for domestically produced instruments.
So we have told that there is an injury of around close to 20% right now. And that's what we have requested the government to at least, give that kind of, advantage to local manufacturing, because the injury is pretty grave. And we've seen that a lot of these products are being sold at a higher price in home markets like, China and Malaysia. That's the two countries where anti-dumping is initiated. So hopefully, if everything goes well, we'll see that, injury margin being given to Indian companies.
Okay, Mr. Baid, another question is, as far as FY27 is concerned, can you give us the guidance that you have set, for yourself? What is the top line EBITDA margin as well as PAT guidance?
So we have given a top line guidance of 2,300 to 2,400 crores, as I just stated a few seconds ago. And then on the EBITDA side, we should be between 24 and 25% on the consolidated level. Standalone should be between 26 to 28% now.
Okay, so consolidated will see an impact of acquisitions, which you said once the synergies kick in, could go higher in coming years as well. Mr. Baid, let's talk about the international revenues as well. They grew 36.7%, but we did see an impact in the Middle East because of West Asia crisis that we've been seeing as well. Do you expect that to be done away with now? Because we're not talking about it so much and maybe things are normalizing. What is the targets as far as international or the export markets are concerned? Are the margins also higher there?
See, margins are definitely higher. I'll come back to the crisis. I think the bigger crisis is we have a strong order book, but the problem is we can't ship the goods right now because of non-ability of shipping routes to West Asia and Middle East markets. And I think that is impacting us a bit. And I think we have seen almost a 2-3% impact on revenue on the top line because of that right now. So hopefully in coming months, that kind of eases out and we'll get the growth back in West Asia and Middle East markets. I think they contribute to close to around 6 to 7% of our current export basket, but currently they are down.
Can you quantify the impact that you saw, in margins due to, the increased costs that you've seen due to all of the supply chain disruptions? And the second question, we do understand that as per Vision 2030, you do have a couple of acquisitions that you've eyed up as far as, the export markets are concerned. So one, quantify the margin impact, and number two, a little bit on the M&A strategy.
See, margin front, I think, once these, acquisitions are integrated into the company, and typically in medical device industry, it takes 2-3 years because of the regulatory, challenges which we face. Because, once we move the production to a new location, we have to get all the products recertified, and that takes quite long. And I think that's what we are waiting for. And I think we have already done for, Plan One Health, which was our first acquisition. Second one, which is Pendrocare on cardiology, we are already working on it right now. And same for GDFE, which is on the orthopedic side. So that will take that own journey. But I think we are trying to find small synergies right now. The bigger ones will come in next couple of years as we, move more production and also do more production in India actually for these kind of products. Because these are completely new technologies and we have been developing them now internally with their help to scale up production in India. In terms of, I think, of course, margins I've talked about. On M&A side, yes, we see maybe more on the direct presence side in some core markets. And that's where we are focusing on to go more direct in some core markets and some adjoining technologies, whether in orthopedics or cardiology or oncology. So we are looking at more adjoining technologies, and wherever we find an opportunity, we'll definitely go for that.
Okay, thank you so much, Mr. Baer, for joining us, giving us a sense of the guidance for FY27, your M&A strategy as well, and all of the impact that you've seen due to the Middle Eastern disruptions. Thank you so once again. Well, we'll now slip into a short break. Up next, we will connect with the management of InfoEdge to discuss the Q1 numbers and the road forward. Welcome back to Midcap Radar. One of the large thermal power companies, earlier largely thermal power dominated CESC, has gone ahead and announced an acquisition as far as its renewable energy arm is concerned. The name of the renewable energy arm is Purva, and it has done an acquisition of almost 1.4 gigawatt peak. This is both a solar as well as a small wind portfolio. And very interestingly, it has been done from one of India's largest unlisted private companies. Of course, it's listed in the US, and that is Renew Solar Power. The total value or the total enterprise value of this particular acquisition for close to 1.4 gigawatt peak stands at a little over 4,850 crore rupees, out of which, as per the press release, over 1,850 crore is the equity value of this particular transaction, and the remainder will go as debt for all of the SPVs that will come into CESC's fold. Now, very interestingly, if you look at the transaction valuation, close to 1 gigawatt of gigawatt peak capacity, once you try and do brownfield, works to close to 5,000 crore. So this is a slightly good acquisition, come at pretty cheap valuations. So that is what the street will be watching out for. CESC, remember, is one of the cheapest thermal power stocks that is currently available. But with that, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. It's still tuned in to Mid-Cap Radar. Let's talk about Info Edge. Reported numbers just a while back. It was a strong set. Revenues up 11.3% on a YY basis. Margins expanded to 38.7% and profits were up 43% as well. The stock is up 5% on the back of strong numbers. Let's welcome Hitesh Oberoi, the Managing Director and the CEO of the company, to understand the outlook of the business going forward. Mr. Oberoi, good afternoon. Thank you so much for joining us. Well, it's been a strong set. Give us a sense of what did well this quarter. Recruitment revenue growth has been at around 13%. The margins have improved to 56.1%. Even 99 acres is EBIT positive yet again. What is the outlook for FY27 and what are the growth drivers from here on?
We had a very good quarter. Our two big businesses, Naukri and 99 acres, both did very well. Billing growth in Naukri was 17%. 99 acres billings also grew by close to 17%. EBITDA margins and PBT margins improved substantially. 99 acres is now close to breaking even. The matrimony business, Jeevan Sathi plus IL, again had a good quarter. Again, Jeevan Sathi is now sort of making a little bit of money for us. The big thing, of course, for us was growth came back to Naukri. Naukri billings were up 17%. Margins became very healthy. We rolled out a lot of new AI offerings during the quarter. Our new AI offerings, AIRX and Talent Pulse, are being received well by the market. And and if we continue to sort of do well on this front, then of course the outlook for the Naukri business will change going forward. It's not as if the recruitment market is a very hot market right now. It's not as if every company is hiring a lot of people. There is, of course, a lot of demand for AI talent. There's a lot of demand for machine learning talent. There's a lot of demand for data engineers. So in pockets, there's a lot of demand. But otherwise, it's a reasonable market. But our numbers are good because of the new products that we took to market last quarter, which have received a very good.
That's right. Good afternoon, Mr. Oberoi, and thank you once again for joining us. All eyes will be on Naukri because after seeing billings growth, at 11% in second quarter, third quarter last year, it dropped down to almost 9.5% in fourth quarter. It's been a significant ramp up that you've seen as far as Q1 FY27 is concerned. What led to the kind of growth that you saw in Naukri billings, and can this growth rate be sustained for the rest of FY27? Because we believe that at the end of the last quarter, you had said that in case it stays around the mid-teens mark, you could see EBITDA expansion as well.
Yeah, see, it continues to be a tough hiring environment. It's not as if all companies are hiring in large numbers. In pockets, there is some hiring, but it's a modest market for hiring overall. Now, there are two parts of the Naukri business. There's the Naukri B2B business and there's a B2C business. The B2C business had a healthy quarter, billing through by close to 15%. Now, sometimes, billing growth, not too much should be related to one quarter of billing growth because sometimes clients renew in advance, sometimes renewals get deferred. But yeah, it was a better quarter overall compared to the last 2 or 3 quarters. Our candidate services business also had a very good quarter. Billings in the candidate services business grew by 35% this quarter, and margins also improved significantly. I think a big part of this growth is because of the AI offerings that we've rolled out both on the job seeker side and on the recruiter side. On the job seeker side, we have now introduced new offerings like AI agents for job seekers, AI resume making capabilities, AI mock interview capabilities, and a lot of candidates are lapping them up. On the recruiter side, we've launched our agentic AI offering for recruiters, to help them become more productive and to help them do their job faster and better. We rolled out a free trial for over 4,000 clients, and we were able to get 400 of them to pay last quarter. And this quarter, we've now expanded the trial to over 10,000 customers, and we are hoping to add many more paid customers going forward. So the new products that we've rolled out using AI are helping. If this sustains, then of course this will be a better year than previous year. A lot will also depend on overall economic growth. GCC hiring continues to be solid, but a lot will also depend on whether non-IT companies start hiring in big numbers going forward.
We can say you're cautiously optimistic on growth from here on.
Yes. That's right.
Mr. Oberoi, I wanted to understand, this is a question which is very important for investors otherwise as well. Is there a plan to offload some stake in Eternal? Is there a monetization plan in place?
Well, the Eternal business continues to do really well. It's a large market opportunity. They are leaders in both food delivery and in quick commerce, and they've been executing to near perfection. So we're very, very happy with how they've sort of executed till now. And of course, we are bullish on their prospects going forward. So as of now, there is no plan to offload anything in Eternal. But yeah.
And is when is a buyback likely as far as Naukri or InfoEdge itself is concerned?
So as of now, there is no plan for any buyback. But these are things which the board sort of reviews every few months.
As far as Naukri billings are concerned, as well as 99 acres, what is it that you're targeting?
So 99 acres, we've been very happy with our performance over the last few quarters. We've gained substantial traffic share. So the 99 acres traffic share used to average around 34-35% in a three-player market. We're now comfortably close to the 50% mark, and we've been maintaining this traffic share for a while now. And this is now beginning to reflect in our numbers. Billings were up 17%. Costs did not go up at all, or maybe were up maybe 2 or 3%. So we saw a healthy improvement in margin. And, we are hoping that we can accelerate growth in 99 acres going forward, continue to gain share and continue to improve margins.
Take that point, Mr. Oberoi. A lot more questions, but we are completely out of time. But thank you so much for joining us today with your take on the business going forward and the clarification that there are no plans to monetize stake in Eternal and no plans for buyback for Naukri as well. Bharat Forge's numbers flashing for you on the screen. There's a sharp downtick from the highs of the day. The EBITDA has come in lower than the poll at around 710 crore rupees. There is an element of a one-time loss, and that is the reason why the bottom line looks so skewed. The margins also are lower, 15.3% versus 17%. Look at that net profit number, much lower on a YY basis, lower than the poll as well. As I said, it is because of an element of a loss, a one-time loss that the company has reported. The company does give their outlook in their press release just in a bit after they report numbers. So we're waiting for that. But for now, a quick reaction. The next important thing to track will be the management's commentary, because they talk about the international markets, Indian markets, and how the different segments are doing for them. But for now, it's a sharp downtick on the numbers, and there is a reason why the profits are lower as well. With that, we'll do one thing. We'll take your leave on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studio. I'm Vinny. Along with me is my colleague Arundhati as well. Arundhati, good afternoon. And today the markets have been from where we started. Did see a bit of a dip, and then again 24,590 around that mark is what the Nifty is continuing to trade at in today's trading session. Now, obviously, what's doing well today and what's better than the benchmark indices is the broader end of the market. So mid and small cap is doing much better than the broader end of the market. So that's where we'll watch out for as well. The mid cap, small cap, all of them continuing to trade near the day's highest point. Let's look at the numbers at the bottom of your screens, right? We have Bharat Forge that reported its numbers. Standalone numbers, margins have come in at 24.9%. So that's the margins there. Profits of the company have seen a decline of 5% as well, coming in at around 321 crores. Revenue, on the other hand, have seen an uptick of around 11.5% on a year-on-year basis, coming in at 2,300 approximately crore, 2,340 crores approximately over there in terms of the revenue of the company. So that's in line with what we were expecting at CNBC. EBITDA also 624 crores is what the expectation was. So let's watch out for that. Margins have seen a bit of a contraction on a year-on-year basis, and the poll also it's lower than what we were expecting. So there's a miss that is coming in here. There's a one-time loss coming in at 358 crores versus nil last year. So that one-time loss is also a factor that you should include in terms of the numbers as well. That is a factor that is impacting the overall profitability of the company as well. And versus the poll, we're seeing a miss coming in on the EBITDA front as well. Board has approved that fundraise of up to 2,500 crores via issue of securities. So that's as of now the numbers coming in for Bharat Forge. We're seeing a bit of a decline coming in since the numbers have been reported, down 4% in trade as of now, a sharp downtick for the numbers over there.
Absolutely, a sharp downtick there, and you can see 4% lower, and that's how Bharat Forge is doing after a slight miss on a couple of those numbers there. But otherwise, the markets, the realty and IT pack clocking some gains, while we've got the PSU banks that are in the red, that's pulling the Nifty Bank lower in trade, that's 0.2% in the red. But on to an exclusive now. CESC, through its subsidiary Purva Green Power, is acquiring a 1.4 gigawatt peak operating solar portfolio from Renew Solar Power for an enterprise value of 4,859 crore rupees. My colleague Vivek Iyer spoke to Shashwant Goenka, Vice Chairman at the RP Sanjeev Goenka Group, and began by asking him about the rationale behind the acquisition and the outlook going forward. Take a look.
So as you're aware, we had set up a target of setting up 10 gigawatts of renewable capacity over the next couple of years. And for us, our strategy has always been clear. It is going to be a combination of disciplined greenfield development and selective acquisitions, which will help accelerate value creation. And today's transaction is a step in that direction. This transaction today will create a more balanced portfolio across operating, under construction, and contracted capacity for us at Purva Green. And a little bit on the transaction, today we're acquiring 6 SPVs from Renew Solar for solar assets which are operating across Rajasthan and Karnataka. And these are long-term PPA signed up 25 years PPA with SECI and with Karnataka Discoms, and have been operating for over a year. So we're very excited to have this now as part of our portfolio. And with this acquisition, our overall contracted capacity now goes up to 4.8 gigawatts.
Okay, Shashwat, get that completely. Now, give us a sense of the total EV. We understand that the EV is slightly northwards of 4,800 crore. Give us a sense of the total equity you're committing, the total debt that you will have to assume, and does the portfolio have any debt?
So the EV is 4,859 crores, and the cash component is going to be 1,582 crores in a nutshell.
Okay, and the debt figure that is there on the books?
The remainder.
Okay, so the remainder out of, leaving aside 1,582 crores, the remainder goes towards the debt repayment plan. Okay, give us a sense of the renewable energy plans that you have in place. You alluded to the 10 gigawatt plans that you have in the next couple of years. If you could set out a timeline, FY30 is something that you'd guided the street to earlier, but we understand that you're now running a little ahead of schedule, especially in terms of the near-term targets. What is the kind of steady-state EBITDA you expect to garner from your renewable energy portfolio or from Purva? And also a word, you did have plans to go ahead and ramp up both cell as well as module manufacturing facilities. What is the status there?
So from a steady state standpoint, when we get to 10 gigawatts, we should be northwards of 8,000 crores of EBITDA for Purva. And our manufacturing plans on the solar components of module and cell are on track. We already have 1 gigawatt of module manufacturing live in Rajasthan, and we're looking to set up 3 more gigawatts. And as far as the cell manufacturing is concerned for solar, we have started with groundbreaking in UP, and we should be ready by the 2nd to 3rd quarter of next year.
Okay, so you already have plans in place. Groundbreaking is expected as far as cell and manufacturing, module manufacturing capacity is concerned. Give us a sense of, especially in that particular part of the business, the total capacity that you have envisaged as far as solar cell is concerned, solar module is concerned. Will modules come up first, or would you expect to remain an integrated player?
So 1 gigawatt of module is already live, 3 more coming up. And we've got about 3.8 gigawatts of cell capacity, which is going to come up. And the idea is cell feeds into module, module feeds into our IPP arm. And that's how we're setting up this business.
Understood. So the solar cell and module facilities feeds the IPP arm. With this transaction and along with the cell and module manufacturing facilities in place, Purva also stands to now become almost a fully integrated renewable energy player. At any point of time in the future, do you think it makes sense for you to go ahead and hit the primary markets with this big portfolio?
I think at the right time, possibly yes.
Okay, that's an important update there for CESE and a conversation that we had with the management there. So interesting chat there. But on that note, we're going to sip into a very short break. After the break, we'll come back and solve your stock-related queries that you all have sent us with our experts. Stay tuned in.
Welcome back to Your Stocks on CNBC TV 18. Joining us now to answer all of your stock queries are Gaurang Shah of Geojit Financial Services and Ashish Kyal of Wave Strategy Advisors to answer all of your stock queries. Gentlemen, thank you so much for taking time out and being here with us on Your Stocks. The first query coming in from Chetan, who writes to us from Dubai. He holds 200 shares of Swiggy at 455 rupees. He is making a loss on that stock. And he has 100 shares of HDFC Bank at 935 rupees. And he's making a loss on both of these, so Swiggy and HDFC Bank. And he wants to know if he should continue to hold, buy more shares or sell at current levels. So Gaurang, let me come to you first. Swiggy and HDFC Bank, what's your view on that? We saw Swiggy's earnings come in, HDFC Bank's earnings come in. What are your views on those two stocks?
Hi Arundhati, good afternoon to you, to Vinny, and to my good friend Ashish Kyal and the entire team of CNBC TV 18 and all the viewers. A standard disclosure as required by SEBI. All recommendations that I'll be sharing with you on your show, Arundhati, they are part of our fundamental research team recommendation from a long-term point of view. Our company, Geojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment interest. So firstly, on Swiggy. Now, we covered the stock during the IPO, but post the IPO of Swiggy as well as Zomato, which is now known as Eternal, and even if you compare the earnings which have been delivered up far, our sense is that Eternal is a better investment idea if you want to stay with food delivery platform or QC, that is quick commerce. Eternal has 2,400 plus dark stores and they're going to increase the number. In terms of number comparison also, I think Eternal is a better company. There are no specific comments on Swiggy, but if you want to stay in this sector, then Eternal is the company that we have a coverage on. On the second one, HDFC Bank, well, the number were a disappointment. But every time the stock has gone to 700, 730 levels, it has found its floor over the last couple of months. And then it has tried to, pull back close to about 760, 780 levels. As a disclosure, again, we do have a hold and a buy recommendation on HDFC Bank. So first of all, hold on to it. If you get a downward movement in HDFC Bank, maybe closer to 700 odd rupees. And if you are a long-term investor, you can, and if you have investable capital, you can add to it. And if you want to make a fresh investments, you can do that as well.
Okay. Point taken there, Gaurang. But Ashish, what's your view coming in for both these names, Swiggy as well as HDFC Bank? On the technicals, what should Chetan be doing?
See, if you look at Swiggy, the overall, the stock has underperformed and definitely compared to Eternal, the stock has been, if you do the ratio analysis, Eternal is a preferred choice. So I go with Gaurangji that it's better to switch to Eternal. But if he wants to stay with Swiggy, the levels I'll give is a very important support level at around 250 and break about 300 is very crucial because the stock has multiple attempts at 300 failed to break out from there and has reversed down. So if it manages to break about 300, we can see some short-term reversal towards 350 levels. So keep a watch on those levels. And as far as HDFC Bank is concerned, 730 is the 725, 730 is the level which we saw in April, again in June, and now again at these levels. So it has been an underperforming bank within the bank Nifty, but this is a very, very crucial support. So my take is going to be maintain a stop loss of around 710 for the positions. Otherwise, it will give a downside breakout if 710 breaks. And on the upside, we need a move back about that 762 20 days average. Once that happens, we'll see some kind of a positive traction in HDFC Bank.
Okay, that's a view there on HDFC Bank on the technicals as well. But let's move on to the next query for today. We have Shiva who's writing to us from Hyderabad, holding 160 shares of NTPC Green Energy. 93 rupees per share is what he's bought it at, as well as 100 shares of ITC Hotels. And he's bought this one at 170 rupees per share. So he's making a marginal loss on both these ones right now, around the buy price, right? So what should he be doing? Continue to hold this for the next 1 year or get out of both these names? Gaurang, afternoon, ITC Hotels as well as NTPC Green Energy. What's your view?
Afternoon to you as well, Vinny. So on NTPC Green, we had a subscribe recommendation during the IPO, and the stock is, if I'm not mistaken, well below the IPO price. The IPO was floored at about 108. Currently, it is trading at 92, 93. So if I have to keep that IPO note as a base of my recommendation, continue to hold on to it. And normally, Vinny, for clean and green energy generating companies, you need to have a longish time horizon. So you hold on to it, provided you have a long-term point of view. I'm giving this recommendation on the basis of the IPO note. On ITC Hotels, well, are there better investment ideas? Firstly, we are positive on the entire hospitality sector. The preferred investment idea is Indian hotels. And a lot of these, companies which are associated with hospitality or hotel sector, they've lined up huge capex, Vinny, either through new properties or capex. So we are positive on the sector, but Indian hotels would be a preferred investment idea.
So Indian hotels are preferred investment idea, and hold on to NTPC Green for now if he's a long-term investor. Ashish, what's the technical view on both of these stocks? Should he continue to hold, or is there another option that you'd look at?
See, NTPC Green, we can clearly see the stock has moved from 120 levels towards the low of 90. There is no kind of relief rally also from here on that we are seeing here. So my recommendation would be to be holding here with a very strict stop loss of around 89 on the downside. If that is broken, then be out from NTPC Green. On the upside, 98 is a very important hurdle for the stock. As far as ITC Hotel is concerned, again, the stock has an underperformer, showing short-term reversal on the upside from 160. So I'll use 160 as a very strict stop loss. Break below that, be out of the stock. On the upside, 190 is the hurdle.
All right, so that's the view coming in there on both of that stocks. The next query coming in from Raj Agarwal, who writes to us from Bangalore. He holds 40 shares of LIC Housing Finance at 609 rupees. He's making a loss on that stock, and he wants to know if he should continue to hold or should he sell at this point. Gaurang, what's your long-term view on LIC Housing Finance?
So under the 2 points over here, interest rates are stable, and the comments from the RBI governor seems to be pointing towards a stable interest rate scenario. We're not going to see an upward move. Second point is real estate sector is doing quite well with the kind of sellout number in a record time for any project launched specifically in the high-end category. These 2 points are more positive as far as the HFC segment is concerned, that is housing finance companies. So if you're a long-term investor, first of all, hold on to it. Take advantage of this price correction you've gotten at 600 plus, currently trading at 501. If you have investable amount, I think it will be a prudent strategy to hold and average at current levels.
Okay, that's the word on the fundamentals. Before I go to Ashish for the technicals, a quick check in terms of Bharat Forge. We had the presentation that came in as well right now. What Baba Kalyani is saying and what the company is saying that they're maintaining this 20 to 25% growth outlook for the India manufacturing business, and they're expecting it to be more pronounced in the second half of FY27. But the stock is continuing to trade at the day's lowest point, now down 6% in the trading session. That's just an update that's coming in on the Bharat Forge earnings as well as the commentary that came in from the management. But Ashish, coming to you, and LIC Housing, we have the viewer, Raj, who's actually bought it at 609. So what should they be doing? Hold, say, sell, average? What's your suggestion?
See, LIC Housing over the past 7-8 days has shown sharp move on the downside. However, the stock has a very crucial support, which is going to be around 488. So my sense will be hold on over here. 488 is an important support. The interest sensitive sector is doing well, especially the financial companies have started outperforming. So there is a chance that this stock can also catch on the upside. And the target can be around 555 levels, which formed a triangle pattern at that level with a vertex at 555. So that can be the short-term target over here.
Okay. That's a view coming in there on LIC Housing. Let's move on to the next query for today. We have Ramesh, who's writing to us from Coimbatore. He's holding 1,000 shares of KC International. This is at a price of 485 rupees per share, making some bit of a loss on this one. Wants to know whether he can continue to hold for the long term, and also wants to know the target for 1 year. So on the fundamentals, Gaurang, what's your view coming in? The company will be reporting their numbers as well. And in the past, some bit of that execution challenge, we had some of those challenges that had come in the past. So now what is the outlook from here on?
Yes, last financial year, Vinny, was quite disappointing for KC. A couple of quarters were very disappointing on fallback of lower execution of the order book and, of course, unable to continue with the profit margins. The entry point is very attractive where the investor has got invested at, though it is marginally below his acquisition price. Won't be making any forward-looking statements on the numbers front. But I hope, based on the commentary and the verbatim that was given out by KC International's management, I think now road to recovery should start. It will not happen immediately, Vinny, but it will take some time. So long-term hold will be the recommendation on KC International.
So long term is a hold recommendation. All right, Ashish and Gaurang, thank you so much for taking time out and being here with us on the show and answering all of our viewer queries. And with that, it is a wrap on your stocks. But do remember to email us your queries and we will address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade. From Vinny and me, goodbye and many thanks for watching.
Beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Taiwanese index, which is up close to 2%. The Hang Seng is up almost 0.8% as well.
Right now, we're trying to see if they're willing to make the kind of long-term changes.
Rebels have struck that port. They also claim that they've struck a Aramco or Saudi oil facility.
Working capital cycle, everything will come down.
They believe that this will lift the net payment margins by 3 to 4 basis points.
Well, what do we have? 24,587 on the Nifty.
The capex plans and the delivery on those has been strong till now.
But in the range of 25 to 30% is what we see the exports coming in.
Damas contributes less than 2% of the overall consolidated
top line of the company.
Novelis's next 3 quarters are going to be a steady improvement.
The market's been in a bit of a range right now, with higher levels seeing some supply, lower levels seeing some support as well.
The cost of supporting the UPI transactions is something, that the banks and fintechs like mine are paying.
Markets consolidating at the 24,560 mark for now. It did see a sharp recovery at the start of the trading session at around 10 a.m.
Well, that is the day so far. Markets, of course, are up about 15 points on the Nifty, 24,585. It's an absolutely quiet session, but it's all about individual stocks, individual moves. 1,700 to 1,600 is the advances to decline ratio. That is on the NSE. So, but as I said, I mean, don't let the tepid Nifty change fool you in terms of what's happening. There is enough and more action which is underway, which is going to be the focus. Single stocks, the focus here over the next 60 minutes. We are coming to you from the CNBC TV 18 Moti Rosewar studios. I'm Prashant. Nigel is with me. Nigel, hi, afternoon.
Hi, afternoon, Prashant. Plenty of stocks actually from the broader markets are moving along, and I think Bharat Forge is a stock that catches your attention. We'll be joined by the management in just a bit from now. But I think that one, in fact, is catching attention because I think there is a bit of a margin pullback, and that's why that stock is at the low point of the day, down close to around 7% as we speak. In the next 20 minutes or so, we'll have the management who will be joining in. And the Vedanta Group stocks are unusually very active today. So keep an eye out on them. Vedanta Oil as well as Vedanta Steel in particular. The smaller names, they are fairly active as well. So, and volumes very, very large. So I'll be interested to see whether or not there are some names that come out of both those two.
Absolutely. Let me just quickly run you through what's lined up here. So we'll talk markets, banks, healthcare under pressure, metals, real estate are leading. Bharat Forge is a big slump, and you'll hear from the management come up in just a bit. So Baba Kalyani will be with us on these numbers. MDR is coming, and we've been sort of highlighting this from the word go this morning. Paytm is up 10, Pine Labs is up 5, MobiKwik I think is up about 3. So that in some detail in terms of, and of course some calls as well on what you need to do with these, with some of these names. How should you position yourself is the question. Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you with us here. So let's just tackle the Nifty first, then we'll look at individual names. What's the view?
So, good afternoon, Prashant. I think on the index, I have said that we are in what I would call or classify as a movement which is, like an upward drift. So we move up a little bit, consolidate, and then again move up. The good thing is that all the averages indicators are in rising mode. So buy on dips is a good strategy in this kind of a market, which is not showing great momentum. You don't need to buy it at every gap up. But yeah, 24,450 is your buying zone, and I think eventually we will have the strength to head towards 25,050, 100. I think 25,050 to about 100 is a gap area that could be a good target in the for the next couple of weeks.
Okay, you've been maintaining that bullish bias towards, with the Nifty heading towards 25,100. What about stocks, Mitesh and morning? And any particular technical call coming through on Bharat Forge after the slump?
Yeah, I just covered the stocks first. I think BDL, defense stocks had given good breakout on Thursday, and then Friday was some kind of follow through. BDL pulled back, but now is rising again. So that's a buy with a stop at 1283. For targets of 1360. And Imber Enterprises, Imber I think is a sell. It's broken below its last swing lows, some negative crossovers as well. So that's a sell with a stop at 7,120 and a target of 6,900 to about 6,875 can be looked at on the long side. And on Bharat Forge, I think there's clearly some kind of a strong profit booking and breakdown in the short term. It's broken its 10, 20, 30-day averages. Last time the stock was consolidating was at the level of 2,100. We are right there. But I'm assuming that with this kind of a candlestick, will break 2,100, and therefore the correction could see the price head towards around 1980, 1985 levels to begin with.
1980 to 1985. Hitachi Energy, after the 10% up move, stock is, 35,000, almost 36,000 now with a kind of up move, but it's still 7% away from its recent 52-week high. Do you see it headed up? Is there momentum?
I actually haven't been covering Hitachi very closely, so difficult to give an immediate comment on that.
Okay, let's get back to the stock of the day, and that's Bharat Forge, and slumping hard, slumping fast after Q1 numbers missed the mark. The company is sounding very cautious on the margin front. Harmis joins in with the details. Harmis.
Another case in point, when the stocks go up too much, just average results don't really make much of a difference to the street, and that's why it's showing the kind of reaction that it has. 8% lower now on Bharat Forge, the biggest single day fall since April of last year for the stock. And if you take a look at the numbers as well, both standalone and consolidated numbers were a miss on expectations. The profits were down 5% on a standalone basis, the revenues were down 11.5%, and even the EBITDA figure, which was expected to be around about 9% higher from last year, that's up only 2.5% as well on a standalone basis. And the margins, which were expected to be relatively stable, have narrowed considerably on both the standalone front and on the consolidated front as well. Now, the highlight of the consolidated number is the fact that they've reported a net loss this time around of 90 crore, but that is of course due to a one-time exceptional item that they had to report, that was around 358 crore. Multiple factors that led to the one-offs, but the predominant one among them is the restructuring of the German subsidiary that they had to do, as a result of which they had to take a provision of around 330 crore this time around, and therefore is what led to the net loss. Now on the ordering front, their one orders were close to 1350 crore this time around. Half of it came from the defense business, and the defense outstanding order book now is close to around about 11,200 crore at the end of the June quarter. Now for the road ahead, they have continued to maintain that 20 to 25% growth guidance for the India manufacturing business this time around. Now they are saying that the growth will be more pronounced in the second half of this fiscal, and they are embarking on this ambitious capex plan for the sunrise sectors that they are going into, be it data centers or aerospace and so on. They have planned a capex of anywhere around 1,800 crore rupees over the next 12 to 18 months, and once that comes on stream, that will start to contribute to the incremental revenues as well. And they have also approved, for this purpose is what they have approved, a fundraise of around about 2,500 crore rupees via equity and via debt. So a miss on expectations on the results front for Bharat Forge. It'll be interesting to see what the management has to say on whether. There's one more point that they have highlighted, is that they are going to continue to explore the restructuring of their global manufacturing footprint, particularly in areas where the medium-term profitability, achieving that appears challenging. Now, that is something that we'd like to hear more from the management on, is whether there is something more on the anvil after the restructuring of the German subsidiary. But for now, Bharat Forge, a forgettable quarter for them, the stock down 8%.
Thank you very much for that. Now let's talk about Paytm, Pine Labs, MobiKwik. These stocks are surging, and Nimesh, in fact, had highlighted it. In the morning, there was a Bernstein note, and he said that this potentially could be the standout sector stock of the day. Bernstein on Paytm. Nimesh, take it away. Refresh us.
Well, the stock is reacted 10% on the back of that big report coming from Bernstein. They've raised a target price on the stock to 2,200 from an earlier target of 1,500, and they were expecting a potential 50% upside. The key reason for this big, target price increase was they've incorporated MDR introduction into on UPI transactions as a base case starting FY28. And on back of this, they believe that the payments margin can go up by 3 to 4 basis points, which would mean that the EPS estimate can go up by 30% versus the previous forecast. So that's the key reason why they've sharply raised the target price. Now, the risk to this entire thesis would be that everybody now expects that the MDR will come, but the quantum of relief is something which we need to figure out. And on basis of that, you might see a further increase in the competition as well in the merchant space. So that's something to figure out. But purely from the fact that MDR is possible on UPI transactions, Bernstein has raised the EPS estimates by 30% by FY30, and they believe that this can improve the payments margin by 3 to 4 basis points. So that's the key reason why Paytm has rallied. And on back of that, we've seen other players as well, like MobiKwik and even Fino Payment, not Fino, the others as well, are rallying in today's market. But the big gainer today is, of course, Paytm on the back of that big Bernstein raising the target price.
Thank you very much for that. And the government has made it clear that consumers will not be bearing the charges or the brunt. It will be the merchants who will make the payments, and that too for high-value transactions. Dipan Mehta is now joining in. Dipan, you want to comment first on this MDR issue? Looks like it's here now. Even on the legislative front, the decks have been cleared. But from a stock point of view, what should one do?
I think it's a great development for all the payment companies, especially Pine Labs and 197, which is Paytm. I think certainly it will provide them with an additional impetus in terms of investing more in the payment business. At the same time, I think a lot of the overheads also will get covered because of the MDR if and when it comes. But look, we need to understand the exact kind of complexion of this particular levy. and how it's going to actually play out and whether it's going to affect the volumes as well. Because sometimes, the behavior of the merchants also needs to be seen over there. But nonetheless, I think net will be positive for these companies. And in any case, I think these companies, whether be it Pine Labs or Paytm, they were focusing on a lot of other ancillary businesses based on their kind of a relationship which they had with their existing customers. And that business continues to grow very well. This would just be an additional, I would say, a spike in their income as and when it takes place.
So the best bet would be Pine Labs?
Yeah, even Pine Labs as well, I think, because basically these are platform companies. They have set up the technology, they have set up the entire network, and the network is growing also very well. In the case of Pine Labs, they are gradually scaling up even the lending business over there. That's a new growth engine for Pine Labs. And now if they have the payment benefit of the MDR as well, then that would be like, absolutely great news for the Pine Lab management and shareholders as well. But as I said, I think, let's just understand what the exact quantum will be. But whatever comes through, I think it'll be positive, and it's like fresh income coming in, a lot of which will flow to the bottom line.
Okay, all right. Deepan, I want to ask you about Bajaj Finance as well. The stock saw a fair bit of a correction in the last few trading sessions. And today, from the day's low, it's bounced back. I think a promoter entity as well had sold some small 20, 30 crores odd. And that's what ruffled the feathers, I think so. But in today's trading session, it's coming back strongly. Your view on Bajaj Finance?
Yeah, see, I also read the note about this revolving credit, and it is quite disconcerting. It is disconcerting for us also as customers of Bajaj Finance. But RBI in their wisdom, if they proceed to do this, then again, I think it may be a setback for Bajaj Finance and other NBFCs. But then they tend to get over these setbacks. I think Bajaj Finance has been able to manage the regulatory environment pretty well over the last several decades or so. And they'll figure out how to, go beyond this thing. But there's no denying the fact that it will make the banks more competitive versus the NBFCs. What was happening so far is that over the last several decades, I would say, NBFCs have been gradually increasing their market share at the expense of the banks because of the flexibility of their products and the speed with which they are able to deliver the credit. And this particular thing certainly puts a lot of NBFCs at a disadvantage. So one has to see how this will actually play out. Right now, it's just a kind of a suggestion made by RBI. It's like they're asking for feedback. And I'm sure the NBFC lobby will heavily try and avoid this particular situation. But if it does, then I think at least 2-3 quarters, maybe a year or so, we could see slowdown in the kind of revenue growth as well as the new loans, and the AUM growth certainly will get affected if this comes into play.
When we chatted with the Axis Scam banking analyst on this NBFC Flexi loans, he said today the systemic loan book is not very large. It's restricted to only a few players. One of them, of course, is Bajaj Finance. But the RBI is giving clarity before it becomes an outsized proportion of the financial systems, and basically reinforcing that revolving credit is a domain traditionally which is going to stay with the banking space, but they're basically reacting before it becomes an issue right now. But for Bajaj Finance, it is still a part of their portfolio, and therefore the street is a bit concerned. Kaynes Technology, that is under pressure. Now, despite the core business, the EMS business doing very well. In fact, the overall revenue growth also was ahead of street expectations at 40% growth, ahead of the company's own guidance of 30%. But the street is concerned about the inventory, the receivables, the working capital days ballooning to 163 days. Although the management is saying things will improve on the operating cash flow and receivable days, but the street perhaps is still not convinced. Listen in to what the management had to tell us in an earlier interview.
As far as revenue growth is concerned, we are seeing good headwinds, and there are many products which is in the development stage. So we are very confident more than the market we will grow. This time done around 40%, we should grow 30+%. Margins, we always have told we will be around last year's margins, and we are very confident of reaching there. This first quarter, there are too many turmoils, material availability as well as dollar fluctuation, which all amounted to a small drop. But I am overall in the year, we see that margins will be around the same number.
Dipan, on this operating cash flow being negative for Kaynes Technology, it's sort of been a shifting goalpost on when it turns positive. And now again, the company is telling us that maybe by, I think, Q3, he said operating cash flow should get turned positive. And though they have shown an improvement quarter on quarter, on working capital, he said it should come down to levels of 100 days. But are you convinced? Is that a credible guidance shared by the management?
No, all that is fine. It's just the valuation which is just a bit daunting. And how the OSAT semiconductor plant, how that is actually going to scale up. And also they made a lot of heavy investment in capex, so that's also another reason why we are seeing the bottom line being pressured, although on the operating profit margin they are maybe doing fine. So it's a kind of a company which is in an investment mode, and as investors we remain invested in the company. But from a fresh investment perspective, I think that at these levels the margin of safety is not there. And again, the view over here has to be a bit more long term. Maybe one or two more quarters also may be pretty soft, and you may have sideways movement in the company. But if they're able to get the expansion plans profitably going and scaling up well, then certainly the stock can do well. But I think that's just a kind of a wait and watch approach that we take in the company at this point of time.
Okay, all right. In fact, I was looking at a Jefferies note. They say that the stock is trading at approximately 50 times PE. But in the past, it's been trading at even more elevated valuation. So if you look at it on, in a comparative, PE, historical average has been 60 approximately. So they are positive because they are saying it's trading at a discount. Let's see how that goes. For the time being, the street is not buying into those numbers, down 4.5%. But InfoEdge, that's the other stock that's buzzing on the back of stable results in the first quarter. Going forward, the MD and CEO, Mr. Hitesh Oberoi, believes the AI-led synergies are here to stay. Let's hear out what he had to tell us.
Candidate services business also had a very good quarter of billings in the candidate services business grew by 35% this quarter, and margins also improved significantly. I think a big part of this growth is because of the AI offerings that we've rolled out both on the job seeker side and on the recruiter side. So the new products that we've rolled out using AI are helping, if this sustains, then of course this will be a better year than previous year. A lot will also depend on overall economic growth. GCC hiring continues to be solid, but a lot will also depend on whether non-IT companies start hiring in big numbers going forward.
Dipan, what's your view on this one, InfoEdge?
First, a disclosure that we have invested in the company, and for many, many years we've been invested in the company, and it's been a steady performer. The only regret is that apart from the jobs business, none of the other portals have really scaled up. And from time to time, they make losses which tend to depress the bottom line. But look, I think they had a winner when it came to Policy Bazaar and Zomato, and they have invested in so many of these unlisted companies that, and the track record also is good. So assuming that they'll be able to, fish out one more Zomato or a Policy Bazaar, then the stock is attractively valued even at these levels. And the core recruitment business, I think, continues to grow. In fact, it seems to have gone into a new growth phase also. Last 2-3 quarters, those growth rates also have improved over there. And it's a great operating leverage business. Again, it's a platform has been set up, and now the network effect also we are able to see in the numbers. So I would remain invested in InfoEdge, but from a fresh investment perspective, I'm not so sure.
Okay, what we're going to do is we'll take a quick commercial break here. We'll come back in just a bit. Dipan, thank you very much for being here, as always. We're going to come back with Dinshaw Irani of Helios Mutual Fund to talk about markets. Nimesh also will join in with D Street Chatter and what he's picking up. Stay tuned.
Welcome back. Well, let's hop across to Nimesh, who's joining in DC Chatter to tell us what is he picking up. Nimesh?
Hi, Nigel. Flat on the Nifty, but there is a lot of momentum in the broader market names. The mid-cap index is up nearly 1%, and the breadth is also positive as well. So clearly, there is a bit of momentum back in the broader market stocks. From a flow perspective, a mixed day, but there is buying, especially in select financial stocks. So that's been the trend for the last many days and weeks, and that continues even in today's market. I guess now that we are towards the fag end of the earnings season, watch out for a large supply of paper, both from the block deals and from the QIP's point of view. So that potentially can cap the upside on at least in the near term. But there is a lot of paper which is lined up in the weeks to come. Now that we are close to the earnings season.
Okay, all right. Tell us some of the stocks then that are going to be in focus, Nimesh, that you're picking up tidbits on individual companies.
So Vedanta Oil and Vedanta Iron and Steel both are buzzing on large volumes. I understand there is a very strong buying flows from larger HNI desks. And also, Street is anticipating some corporate development in the group company. So potentially a creeping acquisition is the buzz as far as this smaller Vedanta group companies are concerned. That's the first stock. Second, as I said, a lot of QIPs and blocks are lined up. The first stock on my list is Apar Industries. Been a big mover of late, but now I guess the QIP is round the corner. Company is likely to raise funds by QIP very soon, potentially this week as well. So watch out for a large QIP in Apar Industries. Third, couple of names where the Street is anticipating large block deals very soon. Dr. Lal Path Labs, Viva Scientific, as well as Dr. Agarwal Eye. All the three names where Street is anticipating large blocks soon. So watch out for that. And the last is Stellite Technologies. It's been quite volatile post the earnings as well, but the Street is anticipating a large order win for the company, and then some bit of buying is resumed in Stellite Tech at current levels.
Okay, well, Nimesh, thank you very much for that. So those are individual stocks with what's happening and the chatter. So we'll track some of these names. We have Dinshaw Irani, who is now joining in from Helios. Dinshaw, great to have you with us here on the program. Thanks very much for joining us. I think you guys have been buyers in a auto comp name lately, and it's done phenomenally well. I mean, I don't think you can talk about names, but I can. So I think Sona BLW, right? And there's been news around it, etc. as well. But the space is doing so well. Sona, of course, is a larger name, but there are so many smaller companies which are doing well in their lines of businesses. But there is also the story in a few like Sansera, etc., where there is diversification out of the auto business into allied industries where you can use the same manufacturing to supply to other end user industries. Defense, for example, is one which comes to mind. Just talk to us about the space. If you want to zoom in into Sona specifically, feel free to.
Hey Prashant, first of all, thank you for having me on your show, and a very good afternoon to you and your viewers. So basically, auto ancillaries, I will not talk about company-specific names. Auto ancillaries per se are supposed to be precision engineering companies. Autos is as good as a defense, as good as aviation, right? So that's where the whole interest came in from us, at least in that space. What we did realize was that European aviation manufacturers were looking at options outside of China. And given that the INR has depreciated much higher against the yuan, India became a very attractive bet for outsourcing and China plus one play. I think that's where the real pickup happened for us, at least on that space. And we started looking at all these ancillaries, which have a very good optionality of getting into other spaces per se. So that's where we're coming from, Prashant. You've seen our portfolio. I won't talk about any specific stock names. Anyway, give heartburns to my compliance guy when I'm on TV. I don't want to add to that. So I'll refrain from talking about company-specific names.
What is the overall read on the earnings season, at least for the stocks in your coverage? What was the performance like? And is it sustainable? And in which pockets? You think the performance that we've seen is strong in Q1, but it may not last?
Actually, Rima, we believe it's the other way around. Frankly, I mean, this quarter was supposed to be the worst quarter possible for all the three mid, large, and small caps as such. The fact was that the raw material prices had shot up, crude was at a peak. Obviously, your input prices had moved up. They managed it very well. Unfortunately, the large caps haven't done that well. I was just checking the results up to Friday, And what my guys told me was the large caps are growing only at 6%. The numbers, the earnings growth for large caps is 6 or 8% or so. Don't hold me against that, but it's like single-digit earnings growth as such. In the case of mid caps, it was some 26, 27 odd percent, and for the large small caps, it was like 30% plus, which is fairly exciting. I don't think these guys are going to slack off. As I said, that if you look at the cohorts within the mid and small caps, they're mostly new age companies, auto ancillaries, chemical plays, what have you, I mean, infra plays, and so on and so forth, where the growth rates are really high. Unfortunately, the large caps are stuck in the cohort of IT, FMCG, banks, and stuff like that, which is like, I mean, mid to high single digits growth rate is what one can expect. In the case of IT, it's not even that much. It's like low single digit growth rates. So that's where the problem arises. And unfortunately, that's a problem for India itself, because the passive flows track large caps, rather the indices, which are large cap heavy. And that unfortunately may not move as such. So you may not see big money from passives coming in, but actives are certainly on the ball now. I mean, if you've seen the movements in various stocks where the actives have been present, one instance today has been Paytm.
Yes.
I mean, look at the move in that stock. Fortunately for us, it's our largest holding in our flexi cap fund. So we're quite happy with what's happening there.
Tell us a little bit more about that, because that was the stock that, I wanted to understand. We have this, all this news about MDR coming, and the stock has done very well. Some of those IPO allottees will be quite excited now, because their price could almost be here. Just imagine a stock that went down to, I think, a fourth of what it was, less than $500. Now it's almost at around 1,600 rupees. The theme is something you'll have liked. You'll have been playing this, as you said, you'll have a fair bit of a holding on Paytm. But tell us a further read-through.
So basically, I mean, we didn't apply in the IPO, by the way, Nigel, just to clarify. We
absolutely.
Picked it up much later. So, and saw it half also.
You'll have been on the right side, Dinshaw.
RBI action was undertaken, and we held on to that. We added to that name, and it's done phenomenally well for us. So here's the thing about not only Paytm, but all the new age companies. I think rather, let's talk about the MDR bit first, so that's out of the way. The fact is that the government also has acknowledged this. Earlier, they used to give a subsidy. They've been cutting off that subsidy quite regularly in their budgets as such. And what they did realize was, for the private sector to go on participating for in the UPI and so on and so forth, rather give optionality in the UPI space, you need to pay them back something. And I think that's where the MDR thought process came in as such, which is already there in credit cards. And they've clarified it's not the user who's going to give it, but it's actually not the consumer who's going to give it, but the end user, the end beneficiary, which is the merchant, who's going to pay the MDRs as such. So I think that's where it's come from. Frankly, I mean, that wasn't the only reason why we liked fintechs. I think the options that they have on the table today are huge, given the fact that India is probably the most advanced in terms of banking systems and so on and so forth. I think that's where the comfort came in, and that's why we are there. And as I said, new age companies, given the treaty of Jandan Aadhaar and cheap mobile data, I think we are on a real cusp of a good offtake.
Okay, well, then sure, we'll leave it there. Thank you very much for joining us. Good speaking with you. You were talking about auto ancillary companies, precision engineering companies. Well, we've got Bharat Forge Management joining us, then sure, so you may want to listen in. But of course, I mean, they do a lot more. Baba Kalyani is with us, CMD at Bharat Forge, as always, to talk about the numbers. Mr. Kalyani, good morning. Good afternoon, beg your pardon. Prashant here.
Good afternoon to you.
Thanks. Thanks very much for joining us. I just want to start by asking you about, I mean, usually we get you to give us the big picture, but maybe we do the reverse this time. Margins, Mr. Kalyani, if you will allow me, have come off a little bit at about 170 odd basis points lower. And I think the commentary is that margins would have been 28% normalized for input cost increases. So could you give us a sense of how much of this is sort of temporary, how much of this can be passed on, these input price increases can be passed on to customers? And when should we expect the reported numbers to get back to the 27 to 28% range, sir?
Actually, you would have seen the same range even in this results that we came out with. We have had almost 160 basis point increase in the energy cost, which we will recover from our customers. And, with the growth that we have, as we have committed, we will see better margins coming up. I mean, even for that last quarter, we will recover this cost increases that have taken place.
Right. Could you give us a sense of when you will be back in that 27-28% range?
I think this quarter itself.
The quarter we're in, Q2.
Yeah, Q2.
Okay, so this basically was inability to pass this on immediately. I mean, as the
problem is when you have this kind of inflation, and this is largely because of the West Asia war and shortage of LPG to start with, then switching to other fuels and all those things. It takes a little time with customers to give them all the information that they need in the level of detail that they need for us to get our increases. But all the understanding with all our customers, both domestic and export, is that these are, metal prices, energy prices, and of course, transportation. In case of exports, that's a big cost increase. They will get reimbursed.
Okay. So in the press release, the language you've used is continue to reevaluate the current global manufacturing footprint. Does this go beyond the CDP restructuring, which is already ongoing? Will we have more exceptional costs related to CDP? And are you looking to further wind down any of your other global operations? Is that getting extended? And if yes, some details about it.
Right now, no. I think right now we are quite busy with getting the CDP restructuring done. We have now signed an agreement with the Works Council, so that's pretty much finalized. And I think we will complete that. It will take probably middle of next year to complete it, and we will see how things go. Germany is in a bad shape right now. As you've probably heard, almost all the companies are suffering in Europe because of this problem. So let's see what happens.
All right. Hi, Mr. Kalyani. Good to see you in, sir. You're talking about growth bouncing back in the second half of the year. Will that mean that quarter two as well will be a little bit softish, or you're expecting to get back
No, we should see quarter two reasonably strong.
Okay.
And, of course, quarter three, quarter four will be even stronger. The problem is that we are seeing growth from many areas which were not traditional. And I think it takes a little time to prepare for that growth and get it going. Actually, the growth momentum is very strong for us. And we just have to put in the requisite capacities in place to take advantage of this. So we are doing that. So we will see growth. We will definitely grow this year by 20-25%, as I had committed last time in our standalone business. All our other subsidiaries in India are doing well. They are also growing.
Okay.
And of course, we have a problem in Europe. You're all aware of this, and we will fix this.
Okay. All right. You're also taken, you'll have taken an approval to go ahead and raise some equity, some money via equity. That's 2,500 crores. Something we should hear about? It's just an enabling resolution, or are you going to be tapping the market soon?
No, I think, we've taken an enabling resolution from the board to raise funds because to make the growth happen in the next 3-4 years, we need to put in a lot of capacity in addition to our normal capacities, because our growth is happening in a lot of new areas. And those new areas require new things to be put in, and they are far more technologically sophisticated and also good margin businesses.
Okay. So this is enabling for now, Mr. Kalyani, right? And this allows you to do it if you need to. I just want to just to go back to the earlier point about the global operations and the global footprint, Mr. Kalyani. Should we expect? I mean, I think there is a 358 crore consolidated exceptional charge in the first quarter. Should we expect more of this year in FY27, sir?
No, I don't think so.
Okay.
I think, look, it takes a lot of time and effort to restructure a business. So we've been able to now restructure CDP in a very appropriate manner, a very beneficial manner to our company, matter of fact. We've been able to sign an agreement with the Works Council there, which is the most important part in Germany, if you are. So I think it's pretty much good by middle of next year. All this will be done. We will get a lot of new business because of that. So things will get much better.
So you mentioned Europe specifically, but even US, right? I think has Q1 27 year on year is kind of sort of turned negative. If you look at the EBITDA,
we had a specific problem in the United States. In our forging plant, we had 2 forging presses out of the 3 broken down all of a sudden, and that created a lot of problems for 2 months. Hopefully, you will see better results in the next quarter from the U.S. side.
You're saying no exceptional charges now ahead in FY27, essentially, right?
Exactly.
So did you also absorb a tariff impact in Q1? Was that also a reason for the margin drag?
No, there is tariff impact is not that much. It's been the same what it has been. There's no new tariff yet. But the problem is, in the aluminum business, a lot of U.S. has no primary aluminum capacity. So all the aluminum comes from Canada. And there is a hefty duty on aluminum coming from Canada. So the raw material prices are high, and that's a big problem.
Sir, the other announcement that you've made is an investment plan of 1,800 crore over the next 12 to 18 months for sunrise sectors. Can you tell us which of these sectors and when do these planned investments come on stream and start showing up in your P&L?
Actually, the sectors are fundamentally aerospace, our defense sector, and our sector on semiconductors and data centers.
Okay. And for this
data center component sector will be up and running by February, March of 27. So we are making a big investment there. We are putting up a big forging facility to make those large components. We should also help our aerospace business. That also will be up and ready by December of this year or January of 27. So this is all going to happen in the next 6-7 months.
And how sizable, sir, is your capacity which caters to data centers?
We make all the large engine crankshafts and components for data center power generation engines. So that business is pretty large. I think it's almost close to 120 million in addition on an annual basis.
Right.
And on the aerospace side also, we see almost like 100 million new business coming in on an annualized basis.
Mr. Kalyani, on the defense side, order book is another 11,000 crores. Could you give us a sense of how much of this is going to be executed in FY27 and FY28? What's the timeline looking like for this order book?
We still have to get clearance to start production on the artillery gun and the small arms. Hopefully that will happen next month. And once that happens, then it's a question of a few more months, we'll start production. So we should see something happening in end of Q3 and beginning of Q4.
And so once once the global operations are completely restructured, what will be the contribution of global revenues to the overall portfolio?
Our global revenues are largely going to happen out of India going forward, because that's the best cost position that we have in terms of global revenue and global operations. So I think more and more you will see India contributing to global revenues, not only from Bharat Forge, but from all our subsidiaries. We are exporting castings, we are exporting aluminum castings out of our sub. We will soon start exporting other products. So there is a lot of traction that is happening on global revenues from all our companies.
Got it. Just one last question, Mr. Kalyani. For your plans in Odisha, what is the situation on that environmental clearance? I think I asked you this last quarter as well.
We haven't got it yet. We are working on it.
Okay.
I hope it will come.
Okay.
That's all I can say.
Any line of sight to this visibility in terms of, is it back and forth and
No, I think it's a process that takes time. It's just probably in a couple of months, 2-3 months, we should be able to get it.
Got that. A great chat. Thank you very much. The stock is already recovering, listening to you. And thank you for joining us here on CNBC TV 18. So I think we started with about an 8+% cut on Bharat Forge. It's, as you can see, ticked up a little bit from there, essentially saying that, you know, they should be able to pass on bulk of this cost increase, which they saw in Q1, which was which ate into margins, and margins should be back in the 27-28% range by the second quarter. In second quarter itself, which is the quarter we are in, maintaining the India manufacturing guidance at about 20-25%. Of course, I mean, it's all have to come in the second half now, but confident that they'll be able to do it. And I mean, you know, no more restructuring charges, the global operations, etc. Europe is in a tough place, Germany, etc., as we know, but no more restructuring, exceptional charges after what the charge they've taken in the first quarter. So that is a Bharat Forge for you. We'll take a quick commercial break here. Mitesh is going to be with us with some last hour trades on the other side. Stay tuned. Welcome back. We've got Mitesh now joining in with what to buy or sell for a reverse trade tomorrow. Mitesh, good afternoon. Welcome back. What do you have?
Yeah. So, Prashant, I have a BTST on Britannia. I think that's closing with strength. Take a stop at about 56.18 and a target of 56.60 can be looked at. And the other stock is STBT on Coal India with a stop at 412.5 for a target of around maybe 413 and a target of around 406, 407.
Yeah. By the way, CAS has begun. So just taking note of it. If you can just look at the Nifty. Nifty's, by the way, stopped trading 24,560. Let's just look at the Sensex as well. Futures will be trading, remember, and cash is not trading now. Sensex, let's just look at it where we are at 78,478. And just look at the Nifty Bank as well. So Nifty Bank is at 57,606. I mean, actually, last week, if you looked at it from Monday all the way till Friday, things got much better. No outlandish swings. I mean, the Nifty, for example, started last Monday with a 200-point difference between 330 and 315. We finally, on Friday, had an 8-point difference, so nothing. And hopefully, that trend now continues as well. There's no expiry today. So option prices, etc., remain unaffected. Tomorrow, of course, we've got an expiry, so we'll have to see. Amrish Baliga is with us to run us through what he's making of things. Amrish, why don't you start with by running us through your pick for the day? I think it's an auto anch name.
Yeah, Prashant. My pick is Endurance Technologies. It's one of India's leading automotive component manufacturers, dominant position in aluminum die casting, suspension, braking systems, as well as alloy wheels. They have 33 manufacturing facilities, 19 in India, 14 across Europe, plus R&D facilities, test track, and technology centers in Europe. EVs require lightweight aluminum components, so this company is more or less future-proof. And quite a few EV-specific products they have. Maxwell Energy Systems, which they acquired some time back, is into EV battery management system. So capacity ramp-up has happened. Strong order wins have been there. Has now diversified beyond 2- and 3-wheelers. Now the focus also is on 4-wheelers as well as non-auto space. So if you look at like last year's revenue, 69% was from 2-wheeler and 3-wheelers and 29% from passenger cars. That should keep changing going ahead more towards the passenger cars. And earnings is on 13th August, so should be a positive surprise. And slightly longer term, expecting an EPS of 95 for FY28 with a target price of 3,515.
3,015?
515, yes.
3,500.
Oh, 3,500. 3,500. Okay, got that. Let's talk about the MSCI index changes could be on the cards with MSCI and NSE index reviews due over the next 2 days. Vivek joins in with the potential changes that you should keep in mind. Vivek.
Good afternoon. That's right. So later today, the NSE Index Subcommittee will be meeting, and they will make a list of all of the likely changes that you could expect as far as the NSE indices are concerned. We will look at the Nifty 50 as well as the Nifty Next 50 and the likely changes. And also remember MSCI on August 12th, and the changes will be known to us early August 13th morning for, as far as Indian time is concerned. Now, first coming to the NSE changes, remember, as far as the Nifty 50 is concerned, you could expect both either BSE or TVS Motors to go ahead and replace Wipro in the Nifty 50. The announcement could be done later today. Nifty Next 50, there are quite a few interesting candidates. Wipro, Vedanta Aluminium, the spun-off entity from Vedanta, Power India, Idea, as well as Polycab are the likely entrants. And the ones making way could be Shree Cement, REC, Lodha, Indian Hotels, as well as United Spirits. Now, coming to the MSCI Standard Index, remember, a lot of these names have been doing the rounds for quite a bit, given the kind of moves that we have seen. The likely inclusion candidates, there are 5 candidates. First amongst them being Laurus Lab, could see inflows of over $520 million. Biocon, Lenskart, and Adani Energy Solutions, all 3 of them too are candidates that could see inflows of a little over $300 million. And also Grow, Billion Brains Garage, is the one that could see inflows of over $250 million. On the other hand, quite a few companies could make their way out of the MSCI Global Standard Index. Remember, Swiggy, on account of the change as far as the ownership is concerned, it has now become an Indian oil control entity. So that that no longer leaves a foreign room as far as holding is concerned. So that could make its way out, over $300 million of outflow. And the other stocks on the account of performance could be Balkrishna, SBI Cards, as well as Astral. These are the names that could leave the MSCI Global Standard Index.
Okay, all right. Thanks very much for that, Vivek. And we'll keep an eye out on some of these names. PFC shares are under pressure. And there was a operationally weak quarter, but I think there's some other information there as well, which perhaps is not, which is taking a bite out of the stock. 8% lower. Ananya is here with details. Ananya, take it away.
Well, yes, PFC is under pressure after delivering a soft quarter. If you look at the NII growth, it was down 4% and PAT was up 5% only, reflecting softer lending yields and margin pressure here. But the main concern was the growth. Disbursements were down 44% year-on-year basis and declined nearly 2% quarter-on-quarter, impacted by the rundown of RBF book, elevated prepayments and seasonally weak Q1 disbursements here. Now, management expects growth to improve in the second half. Now, margins were also under pressure, like I mentioned, with the NIM down 28 bips quarter-on-quarter and 38 bips year-on-year basis. Now, asset quality, however, remain a clear positive with stage 3 ratios benign and PCR above 86%. Now, coming to brokerage, CLSA also called the quarter mix for both PFC and REC. PFC delivered 4% year-on-year loan growth versus just 1% for REC here. Now, the good news is that the RBPF rundown is now largely behind them, with RBPF book down to around 3% of REC's loan. Now, REC, however, saw a sharp forex hit due to rupee depreciation also here. Now, PFC had earlier indicated that it is targeting completion of the PFC-REC merger by April 2027. So, the investors will watch out for that. CLSA has trimmed FY27 PAT also estimate for both companies by 2 to 3%. And the target prices of 500 for PFC and 420 for REC here. So, yes, operationally weak quarter for them. A lot of metrics to watch out for going forward.
Ananya, thank you very much for that. By the way, at the side of the screen, you got the indicative closing price, which is, so the cash session has started. 3:20 is when the cash session begins. It's 3:22, and this will run till 3:28, 3:20 to 3:28, and then there'll be a random close between 28 and 3:30, and after that you will have the price which will be found. But you got the, as you can see, you got the indicative closing price there, 24,611. And it should converge closer and closer, I'm assuming. But that's a useful addition that we have on the screen for you. You'll be able to see at any point where will prices be, where are prices, how's the book settling in the closing auction session. And I think we should be able to have it for most stocks. I mean, one of the things which Anand Narayan, formerly of SEBI, was essentially saying is that many broker terminals are not showing this data in terms of the indicative closing price at any given point in time, and that perhaps was leading to, at least in the earlier first half of last week, not proper price discovery, because people aren't be able to see how the book was being built. But I think you've got this now on your screen. So there's still time, about 5 minutes to the closing auction session to come to a close. We'll take a quick break here.
There's a trading boycott which has been called on 12th of August because traders are unhappy with CAS. So there is a social media campaign which is doing, so they're urging traders not to execute a single trade on 12th of August. So sort of a trading boycott because of CAS. I don't know how much traction it's going to get, but it's doing the rounds on social media.
Yeah. But why 12th? Expiry is tomorrow, right? 12th is day after.
Yeah.
That is Wednesday.
It's Wednesday, so maybe no expiry day. Between the expiries, right? So
but
I don't know how many people have signed on, but just...
I saw that. Yeah. Well, we'll take a quick break here. Ambrish Baliga is with us, and we'll kind of come back and talk about more stocks with him. And I want to ask him about PVR. Some interest coming in at lower levels. And has the view changed, or, I mean, this is just a bit of a tactical bounce that we are looking at. Stay tuned, coming up.
Welcome back. Well, we're waiting for the rates to settle down for the time being. Let's get back Amrish. Amrish, any view on Bosch? You know, the stock has been quite strong actually in the last month or so. You have view on the stock, $43,000 now.
No, I've not really tracked Bosch very closely, so difficult to give a view.
Okay, all right. I think some of these other companies you had a view, right? Some of these Vedanta-related names. Today there was very, very high volumes on both Vedanta Steel, Vedanta Oil and Gas, and Nimesh says probably we could be in for some disclosures later this evening. Any view on either of these names?
No, in fact, aluminum is where I'm slightly bullish on. So that's one I would continue to buy, possibly. I mean, if I see a correction again at levels of closer to about 435, 440, that's the stock which I'll buy from this group.
That's right. The street has quite a bit of appetite actually at those particular levels. The last time it went down there, it rebounded very, very quickly. Got that, Amrish? Amrish, from the cement pack, Ramco Cement used to be a darling, right? I remember us discussing it a few years ago as well. And suddenly Ultratech went and bought India Cements. And India Cement started growing after not growing at all for many years. And that's what created a bit of an issue for Ramco Cement. That's why there's no returns whatsoever for the last few years. But now volume growth has come back. Hopefully, there'll be some kind of concession for them on the royalty aspect, which will help profitability. And they are gradually, coming out with other businesses, like the chemicals business. They're scaling out. They're trying to diversify a little bit. At around 900, 950 rupees, are you interested?
See, I mean, Ramco has been a steady sort of a performer. Yes, I think India Cements, takeover by Ultratech clearly had that effect, no doubt. But then I think if you're talking of longer term, I think Ramco should deliver. So at levels of about the current levels, which is about 950, 955, I think could be looked to buy. I think upside should be again levels of about 1150, 1200.
The cash session has ended. That is a closing auction session, and the market is also shut. F&O will go on till 340. But if you can have the Nifty and the indicative rate at the end of the cash session, so that will give us a sense of where we have ended. So that change, okay, that is a change since cash. Okay, that is great. That's 24 points on the Nifty and 64 points on the Sensex. Actually, maybe that change since cash, we should put it up right on top as the bigger headline. But that's what we are getting. So maybe, I mean, just in terms of absolute point, move slightly more than what we had on Friday. Nothing like what we had in the first few days when closing auction session was really introduced. Those are changes which are coming up on the screen. Same, I mean, the Nifty and the Sensex, the Nifty Bank also maybe we can just quickly put up before we move any further. That's the Nifty Bank. I think we have the rate there. We'll update it on that particular graphic. But it's a pretty quiet session all told. Not very much really going on. Actually, if you look at it from 9:15 in the morning till 3:15, the market moved about 15 points. And then from 3:15 to 3:30, the Nifty moved 23, 24 points. So actually the last 15 minutes, at least the Nifty moved more than it did for the first, for the first many hours of trades. The last 15 minutes perhaps getting in more of a move. But lots and lots of individual moves, especially in the broader markets, mid caps, small caps, which really kept everyone busy. That MDR story was a big one. But so much else in terms of individual, the Vedanta Group companies, etc., etc. Nigel.
Well, that's right. Let's, I think, wrap on this edition of Closing Bell. We thank Amrish as well for joining in and giving us his view on a lot of stocks. The team of Markets Forward comes up next. Stay tuned.
Indian equities end the day on a cautious note with the benchmarks moving in a narrow range as investors weigh global cues. Nifty closes above 24,550.
Shares of Paytm rise 10% after Bernstein raises its price target to 2,200 rupees, indicating a potential upside of 52%. Cites MDR could lift payment margins and drive a 30% increase in its EPS by FY30.
Bharat Forge shares fall as much as 9% after both standalone and consolidated results missed expectations. CMD Baba Kalyani expects margins to improve in the second quarter itself. The board also approves an enabling resolution to raise up to 2,500 crore rupees via both equity as well as debt.
You're with us here on Markets Forward, your go-to show where we get you all the key data points to gear up for the next trading day. I'm Hormas Fatakia, with me Vivek Iyer. Vivek, good afternoon. Yet another day where it was pretty dull on the index front, but of course there was plenty of stock-specific action.
Plenty of stock-specific action, so much that we chewed on from over the weekend, especially the kind of rise that you saw in Brent crude. But it was largely dominated by earnings-related moves that we saw, and that kept the market kicking and alive, especially towards the later half of the session. You saw shares of InfoEdge as well as Bharat Forge move quite sharply in the trading session. But here's a lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with RIA. From Bernstein's Paytm call to Bharat Forge weak Q1 and Hitachi Energy sharp rally, we'll decode all that's driving these stocks moves. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But now on to our first segment of the day. Riya Bhatia joins us from the big wall with all the top movers and shakers.
Well, a lot of movers in today's trading session. Let's start off with the gainers. First, we have Hitachi Energy moving on the back of its Q4 numbers, up nearly 11% today. There's also Paytm, which hit its 52-week high after Bernstein raised its target on the stock above its IPO price for the first time. Syrma SGS also performing well today, hitting its 52-week high as well as its all-time high. BEML also saw strong performance. We saw nearly 8 times the 30-day average shares traded in today's trading session, and the stock has continued its gains after posting its numbers on Q1 on Friday, and the management commentary today also remained quite optimistic in their interview to us, wherein they said that the FY27 order inflow target is expected at 20,000 crores, and MCX also performing well today, up over 5%. On the flip side, looking at some of the losers in today's trading session, we have PFC as well as NLC, both reacting to their Q1 numbers. Bharat Forge as well reacting to its Q1 numbers. Strong volume seen here as well, nearly 7 times the 30-day average volumes traded in today's session. Inox Wind again reacting to its Q1 numbers and also hitting its 52-week low today. And Astra Micro also tanked in today's trading session after reporting a weak set of numbers in Q1.
Lots of earnings reactions in today's session. Ria, thank you for that update. One such name, of course, Bharat Forge. It was, a forgettable quarter, to say the least. Numbers were a miss on expectations, both on the standalone and on the consolidated front as well. On a standalone basis, of course, the profits were down. The EBITDA growth, which was expected to be around 9% on a year-on-year basis, ended up being just 2.5% compared to last year. Margins also narrowed on a year-on-year basis, where they were expected to be slightly stable compared to last year. They were expected to decline, yes, but not as much as they did at the end of the quarter. On a consolidated basis, the highlight was the fact that they reported a net loss this time around worth of 90 crore rupees, but that is because of a one-time exceptional item that they had to undertake, a 358 crore exceptional item, predominantly related to the restructuring of its German subsidiary. That accounted for a majority of that one-time exceptional loss. And of course, the fact that for the order front, of course, they said that they won orders worth close to 1350 crore, half of which came from the defense business. Their defense order book now stands well over 11,000 crore rupees. They have maintained their growth outlook, though, 20 to 25% going forward for the year. They believe that the growth will be more pronounced in the second half of this fiscal. They are setting up capacities across various businesses for which they are going to invest around about 1,800 crore rupees. And they also said that these will generate incremental revenues going forward as well. But for this, they have taken an enabling resolution to raise around 2,500 crore rupees through equity and debt, of course. Now, the stock, though, ended 7% lower, unsurprisingly so, because the stock, before going into today's trading session, was up well over 50% on a year-to-date basis, ended close to around 8% lower, did Bharat Forge. We did speak to its CMD, Baba Kalyani, on the road ahead and whether there will be further restructuring plans after the one that you have seen for its German unit. Here's what he had to say.
Right now, no. I think right now we are quite busy with getting the CDP restructuring done. We have now signed an agreement with the Works Council, so that is pretty much finalized. And I think we will complete that. It will take probably middle of next year to complete it. No, I think, we've taken an enabling resolution from the board to raise funds because to make the growth happen in the next 3-4 years, we need to put in a lot of capacity in addition to our normal capacities because our growth is happening in a lot of new areas. And those new areas require new things to be put in, and they are far more technologically sophisticated and also good margin businesses.
Well, that was Mr. Baba Kalyani himself talking about how it's expected to see a sharp recovery Q2 onwards, and SU is expected to be significantly stronger. But to take the discussion forward, we are now joined by market expert Ambrish Baliga. Good afternoon, Ambrish, and thank you so much for joining us. Well, Ambrish, you heard Hormuz, you heard Mr. Baba Kalyani himself. Within the auto ancillary space, what is your top pick? And are you a little worried about the constant business that we're seeing as far as Bharat Forge is concerned?
No, among the auto ancillaries, my top pick is what I just talked a bit, sometime back, is Endurance Technologies, where I still see an upside of about 15 to 18% levels of about 3,500 or so. And earnings are on August 13th, so hopefully should be surprised. Now it should surprise the markets on the positive. Well, coming to Bharat Forge, the stock had done decently well in the recent past. So, with the sort of numbers which have come, clearly disappointing, no doubt. Although there was an exceptional item in that, so I think the stock can correct further from here, possibly to levels of about 1900, 1950 or so. I think at those levels one could look to buy. Basically because the order flows have been good, no doubt, and the management is talking of taking some price hikes. Quite soon. So I think that should reflect either in the current quarter or the next quarter. So I think at levels of about 1900, 1950, one should look to buy Bharat Forge.
8% lower today was Bharat Forge. But on the flip side, it was a memorable day for Paytm. It received a boost from Bernstein today, raised its price target to 2,200 rupees, implying a 52% upside. Well, and this was also the first ever time it has received a price target that is above its IPO price of 2,150. Ananya is joining in with more details on this. Ananya.
Well, yes, the stock was surging in trade today. It hit a new 52-week high following the key trigger being a bullish Bernstein note. The Bernstein has raised its target price to 2,200 from 1,500 earlier. Like you mentioned, 52% upside potential. This is reported the highest target on the street, and importantly, the first brokerage target above Paytm's 2,150 IPO price. Now, the big change is that Bernstein is now building MDR on UPI into its base case from FY28, saying the debate has shifted from if MDR returns to when and in what form. Now, the brokerage assumes a headline MDR of around 35 basis points on a subset of merchant UPI transactions. Now, for Paytm, this could translate into an incremental 3 to 4 basis points of net payment margin, potentially adding around 2,200 crore to EBITDA by FY30 year. Now, as a result, Bernstein has raised its FY30 EPS estimate by nearly 30% to 106 rupees, while retaining a 30 times earning multiple to arrive at the new 2,200 target. Now, the key risk is how much of that MDR Paytm can actually retain amid competitive pressure here.
Well, thank you so much, Ananya, for joining us, giving us what Bernstein is talking about as far as Paytm is concerned. But do stay on with us. Remember, earlier today, we spoke to the co-founder of MobiKwik on the UPI MDR issue. Let's listen to a slice of that conversation.
Subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. According to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players, is important.
Well, that was the MDR subject today. That has been the reason why Paytm, Pine Labs and all of these names have surged very sharply over the last few sessions. Besides Bharat Forge, the other earnings accident of the day was PFC. Profits rose despite a drop in its core income. Asset quality, though, remained stable. Ananya is still with us to tell us more on the results and, of course, why CLSA cut its price target on both REC and PFC. Ananya.
Well, yes, PFC, they delivered a mixed quarter, I would say, softer on the operating front. If you look at the NII, it was down 4%. PAT was up only 5% here, reflecting softer lending yields and margin pressures coming in. Now, the main concern was the growth. Disbursements were down 44% year-on-year basis, while the loan book grew only 4% year-on-year and declined nearly 2% quarter-on-quarter, impacted by the rundown of the RBPF book, elevated repayments and seasonal weak Q1 disbursements here. Now, management mentioned that Q2 will be better than Q1. Now, margins were also under pressure, like I mentioned, with NIM down 28 bips quarter-on-quarter and 38 bips year-on-year basis. Now, asset quality, however, remained clear positive, with stage 3 being benign and PCR above 86% here. Now, coming to the brokerage CLSA, they also called the quarter mix for both PFC and REC. PFC delivered a 4% YOY loan growth, like I mentioned, versus just 1% for REC here. Now, the good news is that the RBPF rundown is now largely behind them. They mentioned with the RBPF book down to around 3% of REC's loan. Now, REC, however, saw a sharper forex hit due to rupee depreciation here. Now, PFC had earlier indicated that it's targeting completion of the PFC REC merger by April 2025. So, investors will watch out for that key event. Now, CLSA has trimmed FY27 PAT estimates for both companies by 2 to 3%, while maintaining outperform with target prices of 500 for PFC and 420 for REC. So, a lot of key metrics to watch out going forward for both the companies.
Well, thank you so much, Ananya, for joining us, giving us all of the details as far as the financials to the power sector are concerned. Well, we are now also joined by Jay Thakkar of ICICI Securities. Well, Jay, good afternoon. Jay, it's been a week since CAS has been implemented. What is the current market setup looking like, and where do you see Nifty headed from here on? And are most of the worries or the glitches related to CAS largely behind us?
Hi, good afternoon to you, Vivek and Hormaz. I would say yes, absolutely, Vivek. I think that overall, I would say the spot levels, which was actually acting as a concern at the start of this implementation of the CA, seems now to be okay. Slowly and gradually, if you see that on the day when we had seen almost 200 points kind of a gap, and wherein Nifty and Bank Nifty were trading in discounts for a couple of trading sessions. Now that's not happening. So that is something positive, I would say. The implied volatility, which had actually increased at the start of the implementation of CAS, that is, which happened, in fact, started on Monday, and then on Tuesday we saw on the weekly expiry day the IVs have gone up quite much. Thereafter Wednesday also it happened. So, but slowly and gradually, if you see the IV impact, I'm not about India VIX, but the IV impact has come down, Vivek. And I think that things are moving towards normalcy very much. I'm pretty sure the probability of the concerns or the market closure returning to normalcy, at least until the monthly expiry, would be higher, wherein you would be having those kind of stocks specific monthly expiries as well. And right now it is just index specific weekly expiries which we are looking at, mainly Nifty and Sensex. But I think slowly and gradually things are moving towards normalcy. So, and that is what is reflected in the IVs. If you see today's IVs as compared to the last Tuesday or Wednesday's IVs, is relatively lesser, Vivek.
Jay, stay on. I'll get you more on stocks as well. But Hitachi Energy was the outperformer of the day. Very strong performance in Q1, a slew of upgrades as well. Vinny is here to take us through all of that. Vinny.
So Hitachi Energy today managed to close with very strong gains on the back of a good set of numbers that was reported by the company of the weekend. All-round beat, revenue, PAT, EBITDA margin, everything was a beat. Revenue growth obviously came in at around 69% on a year-on-year basis, which is at around 2,493 crores, which is mainly led by good execution that came in from the company. Now, apart from that, the margins of the company, that's seen in around 400 basis point expansion as well. So overall margins also is something that led to good performance that was beat versus what the street was expecting. Highest ever order backlog, 32,222 crores is the order backlog, coming in at a growth of around 11% on a year-on-year basis. They've secured their first BESS order as well during this quarter. And order inflow, just that number also, 5,900 crores approximately is the order inflow. This was excluding the HVDC projects as well. The outlook of the company continues to be positive as well. And on the back of all of this, brokerages have upgraded the stock. Access Capital upgraded the stock to an add from a previous reduced rating. Target price increased to 35,159 rupees versus 32,470. So 35,159 is the new target price for Access Capital. Jefferies, they've retained the buy, increased the target price here as well. 45,790 is the new target price. Prabhudas Leeladhar has upgraded the stock to a from a reduced to a hold rating. Target price is 34,026 rupees per share, while ICICI Securities also has upgraded the stock, revised the target price to 40,000 as well. Most of the brokerages on the street have upgraded the stock, and this is despite the run-up that we've already seen in the stock coming in, higher valuations. They still see a runway for growth coming in for the stock, and that is why the stock ended with strong gains.
Vinny, thank you for that. Take a moment to thank both Jay and Amrish for joining in, running out of time on the show. So thank you for joining us on the show. Take a short break, back with some of the top corporate voices and the key market events to watch on the other side.
Welcome back to Markets Forward. Well, let's listen to some top corporate voices of the day. Titan says demand remains strong with Q2 off to a good start. The company sees no reason for demand to slow unless there is a sharp move in gold prices. Speaking to CNBC TV 18, MD Ajay Chawla said he expects the festive demand and a favorable base effect to support demand in the second half of this fiscal.
Godrej Consumer Products expects high single-digit volume growth and double-digit revenue and profit growth in FY27. Speaking to CNBC TV 18, the company's management said it expects lower commodity costs to kick in from the second half, while supply conditions should normalize from the month of August.
And before we wrap, we bring you some key market events to watch out for in tomorrow's trading session. Ananya Singh is standing by with all the events to watch out for.
Now, let me first start with the global events. Now, in the UK, BRC retail sales data will be in focus for a read on consumer demand here. Now, in the US, existing home sales data is due later in the evening, while markets will also keep an eye on the congressional primary elections across several states. Now, back home, the key event will be the RBI governor's address at FEBAC 2026 at 10:40 a.m. with the focus on the role of AI in Indian banking. Now, AMFI's July mutual fund data call is scheduled at 12:30 p.m. Now, in the primary market, the 1,500 crore Milky Mist IPO opens for subscription. Now, coming to on the results front, the key companies to watch are Siemens, Zydus Life Sciences, InfoEdge, RVNL, PI Industries, followed by Manappuram Finance and NBCC. So watch out for these events tomorrow.
Ananya, thank you for all of that. Take your leave on this edition of Markets Forward from Vivek and me. Thank you for watching. More news and updates follow on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices hover around the $85 mark as uncertainty over a potential Iran-US deal continues. President Trump says Washington is only semi-negotiating and hints at more economic pressure. Iran says there are no direct talks with the US and the Strait of Hormuz will not open till Washington meets Tehran's demands. U.S. Senate votes overwhelmingly in favor of a bill proposing 100% tariffs on Russia's top trading partners. These include India and China. The House of Representatives is likely to take up the bill within weeks. The legislation was championed by the late Senator Lindsey Graham. Sensex and the Nifty end with marginal gains after minor adjustments during the closing auction session. Mid-caps rally with the index gaining nearly 400 points. The rupee weakens by 9 paise against the dollar. 5 main board IPOs worth close to 7,500 crores expected to hit the Dalal Street this week. Bain Capital-backed auto component manufacturer Dhoot Transmission takes the lion's share. An estimated 54% of the funds raised will be infused into the companies. The government says there is no policy barring airport operators from holding substantial equity in commercial airlines. The Minister of State for Aviation confirms Airport Authority of India has received a letter from Adani seeking a waiver of contractual restrictions that would allow entry into the airline business. The government is yet to examine the matter. French investigators will join India's Aircraft Accident Investigation Bureau to probe the Air India Phuket Delhi flight incident. 17 passengers were injured after the flight suddenly lost altitude of about 300 feet mid-air. Pilots Association blames hydraulic failure. Final result of the pilot's drug test is still awaited. The government tables an amendment bill to rein in states' mining revenue powers, also allows leaseholders to apply to the state government for adding other minerals to an existing lease. The bill will impose limitations on the state's powers. It comes 2 years after a Supreme Court judgment upheld the state's ability to levy royalty. Ola Electric Mobility shares tumbled 6% after the auditor raises the red flag over a 57 crore rupee battery scheme penalty provision being reversed, as the penalty was reversed before a formal waiver was granted by the government, and it helped Ola Electric shrink its first quarter losses. The auditor does not clarify whether reversing the without an approval was justified. Police fire tear gas, use water cannons and lathi charge protesters agitating against the alleged civil service exam irregularities as they attempted to reach the Jharkhand State Assembly in Ranchi. BJP leaders, including 21 MLAs, detained while protesting outside Chief Minister Hemant Soren's official residence, demanding his resignation. China evacuates more than 1 million people as a powerful typhoon makes landfall. Heavy rains batter Shanghai as the city receives its highest 24-hour rainfall in more than 150 years. Microsoft issues a warning to travelers as hotel Wi-Fi networks could be compromised and hackers could potentially access mobile phones remotely and steal passwords. Well, let's go straight to the top story this evening. Uncertainty over a potential Iran-US deal continues as President Trump says that Washington is only, and I quote, semi-negotiating. Let's bring you up to speed on the latest developments. Now, Trump has told Axios, and I quote, that Washington is just watching Tehran, its huge inflation and the fact that they have no money, end of quote. Now, Trump added that the U.S. naval blockade in the Strait of Hormuz has accelerated the Iranian regime's economic crisis. On the other hand, Iran says negotiations with Oman and a new maritime route in the Strait are in the final stages. The country's foreign minister, Syed Abbas Araghchi, also said that the existing routes will be replaced. Tehran has warned that the Strait will open only once the U.S. stops its threats and withdraws air and naval forces involved in the blockade. Iran has also asked for compensation for damages, lifting of U.S. sanctions and unfreezing of Iran's assets. The situation remains tense in the Red Sea, where Yemen's Houthi militants launched missile and drone attacks near the Al-Maka port over the weekend. The militant group claimed to have targeted Saudi targets in the region. They also said they attacked an oil facility in Saudi Arabia. All of this impacting the oil markets. Brent crude prices hovering around the $85 mark amidst the tensions and uncertainty. UAE has condemned a hostile Iranian attack on the state-owned oil company ADNOC's vessels in the Strait. Here's Iran's Foreign Minister Araghchi on Tehran's demands and negotiations with Oman.
Our negotiations with Oman concern the establishment of new maritime routes through the Strait of Hormuz. These talks have progressed well, and I can say that we are in the final stages. The old routes will be replaced with new ones. Experts are currently working on the maps. This, however, does not mean that the Strait of Hormuz will be reopened. An agreement on the routes may be reached, but reopening the Strait of Hormuz depends on a separate set of conditions being met, and those conditions are being conveyed through intermediaries.
Well, that's Iran's foreign minister. And in Israel, Prime Minister Netanyahu has reiterated his rejection of Donald Trump's latest 15-point plan for Gaza in what were televised remarks. Netanyahu said that Israel's forces will not withdraw from the enclave until Hamas is genuinely disarmed. Trump's Board of Peace last month had said it reached an agreement for the complete disarmament of Hamas, but Hamas said handing over its heavy weapons was contingent on Israel withdrawing its forces from Gaza.
Israel rejects the 15-point plan. I heard that there were those who said you didn't say it, but we did say it. And here, I am saying it again. Israel rejects 15-point plan. The IDF will not carry out any withdrawal until the dismantling of Hamas and its weapons. And when I say dismantling Hamas and its weapons, that means heavy weaponry, less heavy weaponry, and smaller arms, all weaponry. We're talking about a true dismantling, not a fictitious dismantling. We're now speaking with the Americans about this subject. They have ideas. Some of them are acceptable to us, and some are unacceptable to us.
Well, that's Netanyahu. There at least 12 people have been killed and 39 injured in a Ukrainian drone strike on a region in central Russia. The attack has targeted an industrial area near a major oil facility, making it one of the deadliest Ukrainian strikes on Russia. Meanwhile, a Russian strike in the northeastern Ukraine killed 5 people. The UN has warned that long-range strikes by both sides have intensified this year, resulting in a rise in civilian casualties. The U.S. Senate has passed a bill that would authorize tariffs of up to 100% on countries that continue to import Russian oil and gas. Now, the measure was approved by an overwhelming 86-11 vote, and it will now have to clear the House of Representatives before it can become law. Now, if enacted in its current form, the bill could have implications for major buyers of Russian oil, and this includes India, as well as countries like China and Hungary. Now, India is vulnerable because it is the second largest buyer of Russian crude after China. Russian crude met roughly 30% of India's import requirements last financial year and cost nearly $41 billion. So that is going to be an important development to keep track of. Let's talk about the day's market action. The Lal Street ending largely in the green today after closing auction session. The Nifty finished just below the 24,600 mark, with the CAS resulting in a 24-point adjustment. The Nifty Bank, however, slipped 60 points, ending in the red, while the mid-cap index outperformed the benchmarks, closing over 0.5% higher. A quick check on the currency market action. The rupee trading in a narrow range as likely central bank intervention blunted the impact of the uptick in oil prices. Traders said state-run banks were spotted offering dollars, most likely on behalf of the Reserve Bank. Forex traders say FII inflows and a rise in forex reserves prevented a sharper fall. 95.30 is the dollar rupee for you. On to action in Parliament. The government has tabled an amendment bill that allows the centre to impose restrictions on the state's ability to impose cess on mining rights and mineral-bearing lands. Now, this bill will also allow leaseholders to apply to the state government for adding other minerals to an existing lease. Ashmit joins us now with more details. Ashmit, take us through the contours of the amendment and what this now means, given the fact that there was a 9-judge bench Supreme Court order that authorized states had the power to levy taxes, cesses, etc. on minerals.
Well, what we're picking up is that the bill, the MMDRA amendment bill, has already been introduced in the Lok Sabha. Now, this will be important not just for the centre, but also for the states as well as for various mining companies. Why is that? Well, essentially, what the amendment seeks to do, amongst various other things, is to impose conditions on the power of the states to levy a tax, a levy, or as far as royalty is concerned, on mining rights as well as mineral-bearing lands. Now, this is important because the centre will now have the power under this bill, if it's passed subsequently by the Parliament. The centre will have the power to prescribe these additional conditionalities. Why is that significant? Because bear in mind, circle back to 2024, that is when the Supreme Court in fact had held, by way of a 9-judge bench judgment,
in favor of the states, that states can levy royalty as far as mining is concerned. That came in as a big win for the exchequer as far as state governments are concerned. However, that did spark concern as far as the mining companies are concerned. They were batting against such a levy of royalty, saying that this royalty is tantamount to additional taxes being levied. However, in 2024, the Supreme Court had held in favor of the state governments, but there were two important caveats. Number one, the Supreme Court had said that there is no existing restriction as far as the state's power to levy such a royalty is concerned, a tax, a levy, a fee. There's no restriction as such. Number two, the second caveat that the Supreme Court had given is that the centre is at liberty to come out with fresh restrictions if it thinks it necessary through additional legislation, through a new law, which appears to be happening as far as this particular amendment is concerned. The MMDRA amendment bill, it's currently been introduced in the Lok Sabha. We have to see whether or not it gets passed by the Parliament, but importantly, will have big implications on one, the royalty output as far as mining companies are concerned, and of course the state governments themselves in terms of how much money they can look to garner from such mining operations in their respective states. Back to you.
Ashwat, many thanks for joining us. In a bid to break the deadlock in Parliament, the government says Home Minister Amit Shah is ready to make a statement on the crackdown on student protests in Delhi's Jantar Mantar. With only 3 days left in the monsoon session, the opposition has been protesting inside and outside the House, demanding a statement from the Home Minister. Parliamentary Affairs Minister Kiran Rijiju said Home Minister Amit Shah will respond to the opposition's debate on the students' agitation, but the opposition must listen to the government's response peacefully. Meanwhile, the Congress party maintains the deadlock is likely to continue until the Home Minister makes a statement in the House.
मैं बहुत साफ शब्दों से सरकार के ओर से कहना चाहता हूं, सरकार पूरा छात्र का मामले को लेकर के चर्चा के लिए तैयार है और स्टेटमेंट ही नहीं, छात्र का मामला को लेकर के पूरा चर्चा के लिए तैयार है और पूरा जवाब देने के लिए तैयार है। गृह मंत्री जी विस्तार से जवाब देने के लिए तैयार है। मैं अनुरोध करता हूं कांग्रेस पार्टी और इनको कि गृह मंत्री जी का जवाब के समय डरना नहीं है।
लोकसभा में और राज्यसभा में एक ही डिमांड है कि अमित शाह जी सदन में आना चाहिए और अपनी बात रखना चाहिए। हम 17 दिन से ये पूरी कोशिश कर रहे हैं कि वो सदन में आके जो बच्चों के ऊपर अन्याय अत्याचार हुआ और जो उनको मारा गया, पीटा गया, अब सबको मालूम है और इस विषय में उनका एक स्टेटमेंट चाहते हैं।
Well, the action in Parliament there. We'll head into a break, but up next, 5 main board IPOs close 7,500 crores expected to hit Dalal Street this week. That and more when we get back. The government has said that there is no policy barring airport operators from holding substantial equity in commercial airlines. The Minister of State for Aviation has confirmed that the Airports Authority of India has received a letter from Adani seeking a waiver of quote-unquote contractual restrictions that would allow Adani's entry into the airline business. Madhiha joins us now with the details. Madhiha, this is a reply in Parliament by the Civil Aviation Ministry. Where does this now leave the matter of giving the Adani Group a waiver to get into the airline business?
Well, we have been reporting on the possibility of airport operators starting an airline ever since the reports surfaced. Now, the government has for the first time officially confirmed that Airports Authority of India has received a request seeking a waiver that could allow an airport operator to own an airline. That's the first official confirmation from the government. We have been writing to the Adani Group seeking their confirmation whether they wrote to the government or not. But now the government is clarifying in the parliament that it did receive such letter. However, the Civil Aviation Ministry has clarified that the proposal is yet to be examined, and in a written reply to Parliament, the ministry said that the AAI has received the waiver request, but no decision has been taken so far. The government has also clarified that there is no policy preventing airport operators from owning airlines. Instead, the restriction comes from concession agreements signed with some PPP airports, and the proposal first came into focus after Bloomberg had reported on the 22nd of July that the government was considering allowing airport operators to own airlines. A June 4 letter that was written by the Adani Group later surfaced, showing that Adani Airports had sought a waiver from the AAI, and 2 days later, Adani Enterprises told the stock exchanges that reports of it planning to launch an airline were entirely baseless and that it was not evaluating any such proposal. But yesterday, TMC MP Mahua Moita shared the June 4 letter on X, and today the government confirmed in the parliament that AAI had indeed received a waiver request from the Adani Group. The letter that was shared by Mahua Moitra seeks permission for Adani Defence and Aerospace or its affiliates to invest in, establish, acquire, own, promote or control a scheduled airline, and it also argues that such a move would help create additional airline capacity and improve regional connectivity. The letter also attempts to address concerns over conflict of interest. It says that airport neutrality can be maintained through safeguards such as IATA compliant slot allocation, regulatory oversight by the DGCA, Ministry of Civil Aviation and AERA, independent governance structures, information barriers and non-discriminatory access to airport infrastructure. So while the government has now confirmed that a waiver request has been received, it has also made it clear that the proposal is yet to be examined.
Yes, of course, there is no fresh statement now from Adani. Remember, they issued a denial to that story. Now it has been confirmed by the government itself in Parliament that the Adanis have in fact sought a waiver wanting to get into the airline business. Madhiya, let's also talk about the Air India Phuket Delhi flight incident. We are given to understand that French investigators are now going to be joining India's Aircraft Accident Investigation Bureau in the probe. 17 passengers were injured after the flight suddenly lost altitude of about 300 feet mid-air. So, Madhiya, will technical experts from Airbus be involved in the probe now?
Quite possible, Shireen, and this is also something that tells us the scale of the probe now. It is entering a new phase altogether. The Aircraft Accident Investigation Bureau, or AAIB, has formally taken over the probe under ICAO's Annex 13 norms. And France's Air Accident Investigation Agency, the BEA, will also participate, is what we understand, in the investigation, as the aircraft involved is an Airbus A320 by the French manufacturer Airbus. BEA's participation could also bring Airbus technical expertise into investigation. That is what Annex 13 means. Meanwhile, the Civil Aviation Ministry has officially classified the occurrence as a serious incident, and the ministry has also confirmed that the pilot in command's post-flight psychoactive substance screening indicated a result that required confirmatory testing. The sample has now been sent to a designated laboratory with the final report still awaited. The DGC has taken both pilots off roster pending completion of the investigation and the prescribed process. Now, even as the AAIB investigates the cause and goes through the flight data recordings, the Airline Pilots Association of India, or ALPA India, has claimed that the aircraft suffered a triple hydraulic failure that led to the sudden altitude loss. Now, ALPA has also urged against speculation over the pilot's screening results, stressing that a preliminary screening is not proof of drug use and that conclusions should only be drawn after confirmatory laboratory testing. With the technical investigation now underway, the focus will be on two questions: what caused the aircraft to suddenly lose altitude, and whether there is any link whatsoever between the substance screening of the pilot and the incident in itself.
Yes, important questions there, Madhi. I appreciate you joining us with the details. Now, 5 main board IPOs worth over 7,400 crore rupees expected to hit Dalal Street this week, and estimated 54% of the funds raised will be infused into the companies. Rachna is here to unpack the IPO action for us. A busy week, Rachna.
Absolutely. 5 IPOs open this week, and together these companies are looking to raise 7,479 crore rupees. Dhoot Transmission leads the pack at 3,067 crore rupees. It's a Bain Capital backed auto components maker, the market leader in 2- and 3-wheeler wiring harnesses with a 41% share and nearly 70% in the electric segment. Mole Bio Diagnostics is raising 940 crore rupees. It's the Goa-based diagnostics firm behind the TrueNat platform, a portable PCR testing device backed by Temasek and Motilal Oswal. Then there's Milky Mist Dairy Food that opens tomorrow with a 1,553 crore rupee issue, the largest ever by an Indian dairy company. And on Wednesday, 2 more: Shiprocket with Temasek backed which is the Temasek backed e-commerce logistics platform, raising about 1,600 crore rupees, and Biharilal Engineering, a Punjab-based alloy steel and castings maker, raising about 300 crore rupees. Now, of that 7,500 crore rupee number, 4,006 crore rupees is fresh issue. That means money that goes directly onto the balance sheet of these companies. The remaining 3,472 crore rupees is OFS, existing shareholders selling out. That's 46% of the week. And that number may sound high, but in the first half of this year, offer for sale made up 56% of every rupee raised through Indian IPOs. Fresh capital was shrinking. This week, it's pretty much back in front, and the 5 look nothing alike of these IPOs. Milky Mist is 92% fresh issue, a company that clearly needs the money. Mole Bio is just 21%, with Temasek and Motilal Oswal private equity selling down. So after 6 quiet months where sellers led, fresh capital is back on top this week. Whether that holds or not, we'll know next week.
All right. Many thanks, Rachna, for joining us. Now, the government has once again clarified that customers will not have to bear the transaction costs while using UPI. The Finance Ministry said that person-to-person transactions will continue to remain free. If the fee is introduced, it will be levied only on select merchant transactions above a certain threshold. They have not clarified what that threshold will be or when this fee will come into effect. Ritu joins us now to explain why this debate has taken centre stage now and what is the cost of running the UPI ecosystem. Ritu.
Well, a lot has been said about this MDR fee on UPI transactions, so let's look at both the sides. The argument in favour is fairly straightforward. UPI has become massive, but running this costs a lot of money. MDR can create a revenue stream. It can reduce the dependence on government incentives, help pay for the infrastructure, cyber security, and even fraud prevention. And if MDR is kept nominal, UPI can still remain cheaper than credit and debit cards. But there are also concerns on the other side. For instance, MDR raises the cost for merchants, and there is always a possibility that some of that cost gets passed on to consumers. Smaller merchants can also be impacted if the threshold for MDR is set too low. And if UPI does become more expensive, it can eventually impact digital payment adoption. And that brings us to why we're having this debate now, 6 years after the government set zero MDR for UPI. Well, that's because UPI transactions have exploded. I mean, look at the pace from 46 billion in FY22 to 241.6 billion in FY26 and counting. And while the scale is massive, no doubt, the growth rate has slowed down sharply, and you need money to keep growing this infrastructure. According to Payments Council of India, the cost of running this ecosystem is estimated at upwards of 20,000 crore rupees every year, while the government budgeted only 2,000 crore rupees for UPI incentives in this budget, and even RBI's PIDF scheme to support payment infrastructure has now ended. So the bigger question is, who pays for UPI in the long run? The government, the banks and the payment companies, or some of these larger merchants? And that's really what the MDR debate right now is about. Let's hear out what the industry has to say.
Subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. According to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players, is important.
Well, that is the MDR debate. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
देखो कभी एंजल कैपिटल नहीं थी, कभी डेविल कैपिटल नहीं थी, कभी सीरीज ए नहीं था तो कभी आईपीओ नहीं थी.
Venture debt was not a thing 7 years ago. What's been the biggest learning for you?
When we went out and said, can we speak about venture debt? And people said, oh, we don't publish our data. So I think it's about getting the statistics and facts out sometimes. We feel we can build Indian companies to be global champions. It's our core skill set. That we can build businesses over 5-10 years.
Earlier we were building either an opportunity of a geography India, but now we are the world-class building for the world from India.
My own view is the world will get divided up into two spheres, the Sinosphere and then the Western sphere. And we will therefore get more opportunities to export as well.
Here was the gorilla in the market that was already sort of getting investor love, it was getting customer love, and you decided to actually get into that space.
How often are we going to sit at a cusp where a technological shift is happening and did not do anything about it? We did not want to regret. So we went completely all in.
The way the US has gone all in with AI, we need $1 trillion investment in manufacturing in the next decade.
Come on, 2026, you are talking manufacturing. Ain't it done yet already?
Look at the earnings being delivered by a Samsung, by a SK Hynix.
Everybody knows these are one-time profits. They're not going to sustain forever.
What would you tell Adit and team at Zepto today?
I simply told him that do not stop. When you start the journey, just complete it.
तो लाइन वहीं से शुरू होगी जहाँ पे आप खड़े रहेंगे.
देखो मैं आपको
Good evening, ladies and gentlemen. What an absolute pleasure it is to join these gentlemen here on stage to talk about how leaders make decisions in an age of infinite noise. A quick backstory. I've known most of them for a good part of about 20 plus years now. So I've seen many of them pivot. I've seen many of them evolve as business leaders themselves. So this is going to be an interesting conversation to have. But you know, the world that we live in today, and I think if there's one thing that defines the times and the era that we're in, it is that it is volatile, it's uncertain, and that's just the story, and that's just how we are going to have to learn to live with things. And what separates the men from the boys or the girls from the women is really going to be the courage of conviction, people who are willing to make big bets. As a CEO once told me, and someone that I respect deeply, it's cheaper to be wrong than be late. So I think it is important that people continue making the decisions that are important for their organizations, for the future of their companies, even through volatile times. But how do you do that? What's the matrix? What's the framework for that decision making? I think that's the big question that we hope to unravel with each of them today. Let me start with the biggest noisemaker on the panel, Vijay Shekhar Sharma. To start with, how are you feeling about business and life today in general?
I have a situation on me, so I must say that I feel free.
You feel free because?
Well, I'll say that the business in general in India, there is no other brighter place than this. And even though we go through Strait of Hormuz or everything else, there is no secret about it that as an Indian, there is no bigger respect you ever got outside India, and there is no bigger opportunity than India that you got outside India. So, including India. So
the opportunity is outside India, the opportunity is in India.
No, I'm saying that obviously opportunity is India, and when you see outside in, then it is the biggest opportunity. When you see inside out, then the rest of the world looks up to India. So I think India is the opportunity. Earlier, we used to be thinking, let's say 5 year, 10 year, or 15 years back. I mean, in the era when the capital was not available in India, and very few of us could take a bet that somebody wants to invest in India. I mean, and then look at this, that Jasprit is able to even, as an Indian, build a fund that can go international and invest. So I think we've come around to this understanding that as an Indian, we are absolute world class, and now we are building the world level companies. Earlier, we were building either an opportunity of a geography India or somewhere that we are exporting. But now we are the world class building for the world from India.
So building for the world from India. That is the aspiration. Going global is the aspiration.
Absolutely.
What does that mean as far as Paytm is concerned? You've taken a license in Luxembourg.
Yeah.
How global can we expect Paytm to be in the next 5 years?
I have a simple understanding that what we built in India, the cost level, the technology level, the depth, and the business level competition that you have in India, the rest of the world seems like a cakewalk. It is rather being stupid of spreading too thin or being over-aggressive that you did not know what the real risk is. But at the same point in time, just because you've done India, you know nearly every playbook that could go through, or you could go through a wrong playbook, in other words. So I would say, as an Indian, the amount of experience that you get in India is super valuable. And there is a time, Naveen is building global company. Naveen has eventually done international revenues. We are now, we did it with Masa in PayPay in Japan, but now I do believe that we as an Indian would like to operate international operations. The dream is that when you land in London, San Francisco, Tokyo, and when you see a flag of a company, then you can tell them, you know what, this is an Indian company. That I think is a company young companies can aim for.
And hopefully Paytm is going to be hoisting its flag in some of those international markets soon.
Yes, absolutely.
Okay, I'll come back to you in just a second. Yes, Aditya.
I just want to second what Vijay is saying, right? I recently moved to Dubai. Been working in Bombay now for the last 23 years. But once you actually move to Dubai, you cut out the noise. And then you
really? I mean, we were hearing sirens constantly being...
Now it's very calm.
That's not the story any longer.
Now it's very calm. And you realize, you know, Sare jahan se acha hai, India is doing really, really well. So,
and which is why you moved to Dubai.
I moved to Dubai, but India looks very attractive.
I mean, that does seem a bit contradictory, don't you think?
No, actually, look, I think the whole region that I cover in Asia, each market is looking very, very attractive for global capital. Each market has its unique facts and factors. India, as Vijay said, we feel that we're business builders at heart. We feel we can build Indian companies to be global champions. And that's a huge, huge thesis for us. We love doing industrial deals. We do complex transactions. We have boots on the ground. We have operations teams. And we don't get afraid of complex. In fact, we make complex simple. That's kind of our mantra. And so India is a very interesting investment thesis. Similarly, Middle East, similarly Australia. So each market is very, very interesting. Right?
Naveen, let's start with you because currently you're not dealing with the quarterly pressures, but you may soon have to deal with the quarterly pressures as and when the time arises. But do you feel that that will put some changes in place on how you deploy capital, on how you allocate capital, how aggressively you choose to allocate capital?
Well, I think it may do that, but my challenge is if in the world that we are living in, where you have to, every business is getting disrupted in a much shorter cycle, you actually have to think about two vectors, which was not true less than 5 years ago. The two vectors are, you have to worry about the quarter, but actually if you worry too much about the quarter, 8th quarter onwards, you're not there. So the cycle of disruption is so rapid that you have to think about the 8 to 12 quarter view and invest with that. By the way, anything beyond that, you have no clue anyway.
Yeah.
Because the disruption is so rapid. So the long term has shifted from a 10-year view to best case.
A 10-month view?
Yeah, best case 2 years, right? If you're like really, really good, it's a 2-year view, but maybe 10 months, right? So you have to think about investing, and if you don't invest. So the issue is, okay, so then can I wait?
Yeah.
And I don't think companies can wait anymore to see what's going to happen. Because if you wait, you are also assured of not getting there. So therefore, the key question arises is to say, okay, how do you then, so then you're making long-term investments in quarterly cycles. And I think that's the world we are in now.
Ashish, let me come to you now. And through your experience of investing in companies and, of course, starting companies, starting funds, and now getting into the education sector yourself, the price that one pays for inaction, if you could describe to me some pivotal moments, and we've also, of course, heard the iconic stories of how the Amazons of the world were built through very, very difficult times. But, from your own examples of investing in companies, the price of inaction and what that has cost.
Yeah, look, I think in the rest of the world, we're in a different situation where there's very low growth and demographic issues, debt issues, etc. I think in the Indian context, when you have of course, AI is different because it's a new technology and so provides lots of opportunities globally. I think in the Indian context where there's a lot of growth, the cost of inaction is much higher because even if unless you do something stupid, you'll earn your capital back maybe a little bit later, even if you make a mistake, and you can course correct as you go along. So take, for instance, manufacturing, which I think India has a huge potential in, but we have failed so far. Only 25 million formal sector jobs. Our exports are 450 billion. Vietnam beats us, I think that now there's PLI, but it was done wrong for most sectors. Hopefully it'll get course corrected. I think we have to go all in. The way the US has gone all in with AI, we need $1 trillion investment in manufacturing in the next decade. That's the only way we'll create the next 40, 50 million jobs. That's the only way our exports will go from 450 billion to 2 trillion.
Where's this trillion going to come from?
Money?
Yeah.
Over a decade, I think India can, we have enough domestic savings. Forget about FII money. And two is we do need to increase FDI. See, FDI, I know you guys all report FDI of 90 billion and then net FDI is 0. See, nobody focuses on the right number. FDI, half of it is private equity, which is not FDI. It's long-term FPI.
Yeah.
That money has to go back.
Yeah.
Manufacturing FDI is only $20 billion, $22 billion in India. It's abysmal. That's the number to focus on. Because that number is what creates jobs, brings new technology, puts factories. वो उखाड़ के ले नहीं जा सकते. It's here permanently. And that's an abysmally low number. So we need greater FDI. We have to mobilize domestic savings. We need incentive from government. All of the above to make it happen.
Well, Ishpreet, speaking about opportunities and speaking about aggression, you've seen a pivot here at Strides as well. But from your own lens and from your own journey of what you're hoping to undertake at Strides, run me through what you're seeing in the ecosystem as well. What are the numbers telling us on the scale, size of ambition and the risk-taking ability of the Indian entrepreneur today?
So first of all, welcoming everyone to Stride Forward. It happens to be our annual day, so very happy to have all of you together with us. To your point, Shireen, I think overall, when we started, we were very clear that it was an education of credit into the startup ecosystem. Because traditionally, when we went to venture capital firms to say, okay, can we do credit to your portfolio companies coming from a bank? And they said, look, you'll take a credit call on our money and you'll give money to our portfolio companies, right? So you used to be a very sideline activity of saying, what is venture debt? And what it took us over a period of time, the past 7 years, is to go and be with various kind of founders, right? You have early stage ecosystem, which requires different kind of capital. The risk appetite is different. There's a mid stage ecosystem, which is like anywhere from Series A to Series C, which requires a different form of capital. And then you have companies like Naveen who are like preparing to go at late stage global companies who have different kind of requirements.
Yes.
So I think what we understood over a period of time that how do we get this playbook right? Because it has to be horses for courses. You can't give one standard set of structures. So we started coming in between equity rocks. Okay, can we be a flexible capital provider depending on various business needs? It was as basic as educating working capital is different than capital expenditure. Yeah. International finance is different than domestic finance. And what it resulted into this 200 odd portfolio companies, which has given us a certain set of playbook. It has also made us see in various kind of scenarios. We've seen stress in our portfolio companies. We've funded a lot of businesses in climate. So it was a natural progression to first start believing these companies to go global. So we had to go global in order to educate what India is, which I'm sure all of these people are doing. Naveen has done it as being a global company. Vijay has been doing that for a while. And how to make sure that, first of all, we believe as entrepreneurs that we have global capital access if you're able to sell India. Yeah. Sell India well, but you have to be out there. And that's why our international expansion happened 2-3 years back. And now we are into multi-strategy. We started a climate fund. We've got into special situations. Yeah. And that's the evolution of the requirements of the startup ecosystem. And that's the evolution of Strike.
So what has been the biggest learning for you in the last 7 years of the many changes that you've been able to bring about, but also educating the market? As you said, venture debt was not a thing 7 years ago. What's been the biggest learning for you?
I don't know. Sometimes people don't speak about data. When we went out and said, can we speak about venture debt? And people said, oh, we don't publish our data. Right? So we had to release the first report and say, okay, these are the companies. This is what VC ecosystem believes about credit. This is what founders believes about credit.
Yeah.
And this is the actual truth. There are use cases for every business.
Yeah.
And we can structure that. So I think it's about getting the statistics and facts out sometimes and meeting a lot of people to educate them about what it can be and what over a period of time, how an evolution of the capital structure can be.
You know, and that's an important point, which let me talk to you about. What we've just heard there from Ishpreet is also the dilemma, the challenges, but also the opportunity of being the first mover, of being the category creator, of being the category definer. Many of you on this panel have done exactly that. What is the burden, but also the opportunity of being a category creator in India?
It's interesting to believe that category creators always had to face the resistance of the market in a different way. We don't always have category creator as a winner in the end because of that you have to burn so much of capital. I remember in the board meeting, there was a time when we had invested about 20,000 crore already, and I was in the market to raise another 6,000-7,000 crore. And the one question one of the board members asked was that, are there not other companies in the market that you continue to invest? And can we not figure out somebody else to support so that the market grows? So sometimes category creators get a burnt of market situation. Even if you own large market, now there is nobody else left in the market. So I would say that category creator is an innovator who has discovered the market, but economic success is something that eventually happens to the best executor. You've seen it on Android, that iOS discovered, let's say iPhone discovered, let's say category of smartphones. It has not lost the battle, but it has won consistently, but another player could solve for it. By the way, AI, I want to talk about exactly this in conversation. Remember, Sireen, one point of time, you used to ask a question, if India's Google is Google, India's Dash is Dash.
No, I never asked that question. I always had a problem with that question. I said, if there is Facebook, then why are we talking about India's Facebook?
Yeah, that's right. I remember this, and that is what I'm trying to call it out today in this room, that let's remember it, that the market of India offers enough unique opportunities to create something in India that becomes a need of a certain segment of the world. It is inevitable. It is not to be challenged and thought about it. We can talk about different AI models. We can talk about different AI use cases. And India will inevitably generate models. I can tell you this. I mean, a lot of people have an opinion that you should make use cases of it instead of, let's say, model of it. We're talking about foundation of manufacturing to be looked out. Come on, 2026, you are talking manufacturing. Ain't it done yet already? Why are we even thinking about it? And that is the mistake.
No, it's not done yet already.
No. I'm saying that is the mistake India will do if somebody thought about it. Because people thought like that. That, oh, manufacturing is done. Some country has taken. I'm not naming the country, guess what? Some country has taken it. But at the same point of time, some other country like Vietnam just won it over. So the point is, I'm trying to say, every economy offers entrepreneurs opportunity to create, even if that they believe is a first mover, probably in that context, but at the same point of time, maybe a late bloomer.
Yeah.
But the fact is, somebody has to draw the line. Entrepreneurs are the one who draw the line that this will happen, and they believe so fundamentally in it that they polarize everybody around it.
So Naveen, come in on what we just heard there from Vijay, and I'll frame that in the context of the conversations that are going on, that are we too far back in the race? Are we going to take too long to catch up? As a nation, what is the way that we should look at entering or being part of this AI race?
You know, the horizontal foundational model race is hard to participate in because that requires a very different level of capital. But if you try to fight that battle, you are actually going to lose it. So therefore, we should not try to fight that. That's at least my view. What we should try to do is to figure out the hybrid vertical models. And the hybrid vertical models are areas where we can do really well at. When you have a technology shift that we have in the moment that we have right now, there is no reason to actually go back and build only for India. You actually have an opportunity to build from India for the globe. The big change, in my view, that you require both in terms of the capital access and in terms of the entrepreneurs is to actually be able to build a global business.
And that's an important point that you make. And Aditya and Ishpreet, I want you, Ashish, and Ishpreet to come in on this. The capital needs. We've finally seen domestic capital being unlocked. But to be able to really build for the world, which is what all these entrepreneurs on this stage are saying, is the aspiration, is the opportunity, is what they want to do. Where is the capital? Where does the capital come from?
It's interesting. When we went global, Shireen, the thought was that while domestic capital is available, we raise domestically. The intent was, do you have, first of all, an audacity to think that Indian companies in intangibles, there is a tangible society we carry where the manufacturing comes in, they're saying there's a great story in India, there's a China opportunity, China plus one opportunity. And then intangibles is what Naveen is doing in terms of saying AI company built in India for the world. So can we do it something on the fund management side? And can, first of all, we go and educate about the fact that we know fund management, we have done a bit, and raise it for certain geographies. We entered Middle East, we entered Europe, and what we realized is that that trust of starting working is important. And now we have been able to transport that capital from, say, Saudi to India. Now that's a loop of cycle we have to go through. So moment as of now, he's built an Indian company, he's gone to US, and he's got US investors.
Aditya, you want to come in on the capital issue?
Yeah, look, I think for us, India has been one of the most successful markets globally. We have now $35 billion of AUM in India. Across the board, all our sectors are performing at or better than global returns, which is phenomenal. Our global CEO was here in town a year ago. He said many things. One of the things that he said just stuck with me. He said, there is no dearth of money that Brookfield can put in India. That's a very powerful statement. And that statement can only be made on the back of strong returns, strong DPI, and strong pipeline of opportunities. And again, we're not investing for 2 years, we're not investing for 3 years, we're investing for 10 years. And so there are very few countries out there who can provide large quantums of capital required and produce global returns. India is honestly, top of that list for us.
Ashish, I also want to talk about mindset, and I want to talk a little bit about culture as well. And I want to understand from your vantage point of companies that you've invested in, the benefits of focusing on niches, because niches do often provide the path to profitability as well.
Just coming back to the capital bit, I think India is very well positioned because, the last 15 years post the GFC, America absorbed a lot of capital and delivered excellent returns. I mean, there was just a lot going on in the US. Leverage worked out beautifully when rates were coming down, etc. Now I think it's very different in the US. I think private equity in the US has become much harder. A lot of stranded assets like SaaS and other sectors. And the returns aren't going to be as good. Right now there's an AI trade, but there's nothing else. Beyond that, the economy is not even growing in the US, to be honest. And at some point, this will slow down. So I think the opportunity for India is that a lot of capital, the way it shifted to emerging markets in that early 2000s period, the world works in cycles. The cycle will come back again. And India is one of the large sort of places outside the developed world where you can put capital to work. So I think India can be a huge absorber of capital, much, much greater than what we have.
But if we just look at what's happening as far as earnings are concerned, I mean, look at the earnings being delivered by a Samsung, by a SK Hynix on their basis versus Indian IT, which is still sort of stuck in the 3 to 5% single-digit kind of growth range. From an investor point of view, when you look at where you allocate capital, won't those things be considerations as well?
They have been, which is why Korea skyrocketed now it's sort of trading off.
Yeah.
But everybody knows these are one-time profits. They're not going to sustain forever because, supply can't be crunched forever. It maybe this lasts 2 years, 3 years for the excess profits because the profits are obnoxious at this point in time.
Vijay, since we're talking about timing and we're talking about perspective and we're talking about cycles, I also want to talk about what's happening in the Indian startup ecosystem today as far as the IPO market is concerned. And we've had a very, very good run in the IPO market in the last 2 years. Of course, it comes down to timing. It also comes down to bankers. And of course, you've gone on record to say choose your bankers well. So what would you tell Adit and team at Zepto today, as they look at what they should do now in terms of timing?
I think they should stay put and they should come back to the market with the plan that they have. And there is no doubt about it. India is the best market to public list. And the reason is logical that Indian capital cannot go out. So Indian, which is the economy growth, is going back in Indian market. So it's logically the best market. I mean, all of us, if we were to list elsewhere, we would have been differently valued. There is no doubt about it. I mean, any one of us who is sensible enough will understand that math, that it is a scarcity premium that we are getting, not necessarily the business premium we are getting.
What would you tell Naveen as he gets ready to head to Dalal Street?
I simply told him that do not stop. When you start the journey, just complete it.
Well, gentlemen, it's been an absolute pleasure speaking with each one of you about what it means to be in India today and build for the world, but more importantly, what it takes to be a dreamer, but more importantly, also a doer. Thank you very much for your time. Ladies and gentlemen, a big round of applause for Vijay Shekhar Sharma, Ashish Dhawan, Aditya Joshi, Naveen Tiwari, and Ishpreet Singh. Thank you very, very much for joining us today.
Hello and welcome. You're watching Aviation Centimeter. I'm Ashmit Kumar. Now, France's Air Accident Investigation Agency, the BEA, will be joining India's Aircraft Accident Investigation Bureau to probe the incident involving an Air India flight from Phuket to Delhi. Now, 17 passengers were injured on that flight. After that flight suddenly lost altitude of about 300 feet mid-air on August 4th. Now, the aircraft carrying 137 passengers and 8 crew members subsequently stabilized and landed in New Delhi. The Civil Aviation Ministry officially classified it as a serious incident. Both flight crew members underwent the prescribed psychoactive substance screening test. The ministry said that the drug test of the pilot in command indicated a result requiring confirmatory testing. The samples have been sent to a designated lab and the final report is awaited. The DGCA has taken both pilots off the roster pending completion of this investigation and the prescribed process. The Airline Pilots Association of India has attributed the flight's sudden altitude to a triple hydraulic failure. ALPA has also urged against speculation over the pilot screening result, stressing that a preliminary screening is not proof of drug use and that conclusions should only be drawn after a confirmatory lab result is available. Now, with the technical investigation now underway, the focus will be on two key questions: what caused the aircraft to suddenly lose altitude and whether there is any link whatsoever between substance screening result and the incident in question. Joining us now to help us understand and unpack this developing story is with us Captain Sam Thomas, President of the Airline Pilots Association of India. Also with me, Sanjay Lazar, an aviation expert, and of course my colleague Madhya Mujawar, who's joining us live from the Mumbai studio. Madhya was the one who broke that story, that exclusive story right here on CNBC TV 18, that the French investigation agency, the BEA, will be investigating this with the AAIB. Captain Thomas, let me come to you first. The very fact that the French investigation agency is joining India as far as this investigation is concerned, the fact that potentially we could also have some engagement, some involvement of Airbus, what does that tell you as to that fall of 300 feet, if it is attributable to turbulence or to certain mechanical, technical issues?
Good evening. First of all, that turbulence part was just created by somebody, I don't know who that is, and it was never in question. And the whole media went to town with that for 3 days. And now it has been established from the report that was filed and Air India Department to DGCA that there was a hydraulic issue, multiple hydraulic issue. In fact, the readings clearly indicate that all 3 hydraulic systems have failed. Now, this is unprecedented. Nobody has ever even heard of it. Now, the issue that is happening is a lot of people are being asked, have you flown the A320? Can a triple hydraulic system failure happen? The resounding answer is no. But that's exactly like in 1912, you built a ship called Titanic and said it's unsinkable. And see where that ended up. When the A320 was made, it was clearly called the uncrashable plane. See where that ended up. So we are telling the media and the public at large that please wait before things and give us some time to react before we can gather all our information. And we've got this information directly from the source. So therefore, we say that the confirmatory fact for that is that the Airbus is joining. Unless it was a major issue, Airbus won't come down and join this particular investigation.
Right. Captain Thomas, absolutely. The fact that the French aircraft investigating agency is joining and they will also bring experts from Airbus also tells us a lot about the scale of this incident. But have you spoken to the pilots on that flight? Did you speak to the pilot in command? What makes you claim that this was a triple hydraulic failure? Because the AAIB is still investigating the flight data recording. So what is the basis of your claim?
Firstly, I'm not claiming, I'm asserting from the fact that, yes, I have spoken to the pilot in command and the details furnished from the post-flight report to DGCA, which clearly indicates that at 0402 for a span of 6 seconds approximately, there has been complete hydraulic failure along with some associated failures. So based on the post-flight report that is printed from the aircraft, it clearly indicates there has been a triple hydraulic failure, momentarily at least.
All right. We also heard what the passengers said about what happened inside the aircraft for roughly 30 seconds. Does that match with what could have happened if there was a hydraulic failure? Passengers were hit, like some passengers got badly injured. Crew was badly injured. People came out on stretchers from the aircraft. So what happens during an hydraulic failure, and how can the pilot then recover from that type of a failure?
Okay, triple hydraulic failure is really difficult to recover from. And what has happened in this particular case is a stall warning has come, autopilot has disconnected, and the pilot flying has pressed the nose down, which is the correct procedure. That has an issue with negative G. People who are not wearing their seat belts will be thrown to the roof. But depending on the severity of the pitch down attitude of the airplane. Now, the systems themselves have recovered. That's what people are not understanding. The system themselves have recovered, and only investigation will tell us whether it was a spurious warning, or because the pilot is not allowed to speculate whether it's spurious or not. Every warning that has come has to be taken seriously, and the relevant checklists have to be followed. That's exactly what they've done. Now, as far as the passengers are concerned, it's a traumatic experience. You even had a passenger saying that the aircraft was flying inverted for a while, which is far from the truth, but we don't blame them. When you are in a traumatic situation, things like this will go through your mind, and particularly with concussion injuries to the head.
Exactly what I wanted to ask Captain Thomas, that some passengers did complain that they felt that the aircraft flipped. Is that possible on a passenger plane?
If you want to flip an airplane on a passenger type aircraft, yes, it's possible, but it didn't happen in this particular case.
What I wanted to ask is, if a plane had to flip, is it possible for the cockpit crew to recover from that situation and land the plane safely?
It's a very speculative this one. Sometimes, if the structure does not fail, we do that sometimes in the simulator. We invert the airplane and do things when you have free time. But if the structure doesn't, more often than not, the structure fails. If it doesn't fail, there will be significant damage to the aircraft, but maybe it's a very speculative thing. And in real life, I don't know of many cases. I mean, there have been a few cases of a private jet recently, a year back, that went through a complete inverted flight from a wake turbulence incident. So beyond that, this particular aircraft, no, I don't think it's possible.
Sure. Captain Thomas, the other big issue, of course, you're asserting, you're not claiming is what you say, you're asserting that this was a technical failure. The other issue that, of course, we have been speaking of and have been talking about has been the psychoactive substance test. Now, tell us, what is the difference between a positive result, a non-negative result, and can there be other reasons for a non-negative result other than perhaps recreational use of certain drugs?
I can't authoritatively say on what the non-negative clearly indicates that they have not got a conclusive proof on if there is a banned substance or not, and a recheck is required. Now, that's the report as far as this particular pilot is concerned. And contrary to popular belief, every pilot has to undergo the psychoactive substances check. In addition, there are random checks being conducted on pilots, 10% of them, and so as to cover the entire population of pilots. We welcome that move. It's just that in India, the use of over-the-counter drugs is very prevalent. We all have done it. When you have a cold, you take an antihistamine. When you have fever, you take a Dolo 650. Now, in certain cases, even these drugs do come out as banned substances in the dope test. So it does not mean that he's a junkie who was flying your airplane. So we need to wait for the conclusive test to come back. And there is a civil aviation requirement which takes care of pilots grounded due psychoactive substances, and that would be followed.
Sure. Also coming to you, Mr. Lazar. Mr. Lazar, on that same issue of psychoactive substance tests, what is the frequency of that? Are pilots required to undergo that before and after each and every flight? Also importantly, if it can be induced by medically prescribed drugs, is there a requirement that falls on the shoulders to actually declare that to the airline and to the proper authorities?
Thank you, Ashmit. Just one point before Madhya asked Captain Sam Thomas about aircraft flipping. I know this aircraft didn't, but I just want to point out to you in 1955, Captain Tex has done a barrel roll on a 707. So it's technically possible. Number two, yes, this triple engine hydraulic has been a triple hydraulic failure was spoken about over the last 2 days, and it was quite prevalent. So one wonders why this theory of cat was being circulated when on the 4th itself a DGCA report was sent calling it a suspected transient technical fault. I'm quoting from the report. Now, coming to your point about psychoactive and psychotropic substances, Ashmit, yes, it is possible there are certain bodybuilding drugs or steroids or tablets that you take for building muscle mass and things like that, that do give you a false positive in such a test. There are also some medical prescriptive drugs for, depression, antidepressants, or, moods, what's it called, antihistamines and things like that, which will indicate in such a test. Now, it is incumbent on the pilot or the crew member to indicate to the medical professional at the airline that they have been prescribed this drug A, drug B, or drug C, and it's recorded. Of course, we do also know that a lot of people self-prescribe themselves. Everybody's a Google doctor today, unfortunately, and sometimes we end up taking stuff that may not be in line with what is prescribed by the law as far as operation of these tests are concerned. But let's also remember, we've had a number of false positives when we had the breathalyzer. People who sprayed perfume were actually punished for being under the influence of alcohol. I know of some people who FIRs were filed against them. So I think we need to go slow. Let's wait for the second test. And also after the second test, I'm, stressing precaution to everybody that let us have an analysis of what that test says. Whether it is, talking about a pilot who's, who doped himself or took cocaine, or whether it was a couple of, bodybuilding drugs or antidepressants that caused this positive thing.
Absolutely.
And I'm very sorry. I'm very happy to note that BEA is joining. It shows the seriousness of the situation. I also want to point out this is not a serious incident. It must be treated as an accident. There are still 4 cabin crew members in the hospital as of today. And as per ICAO Annexure 13, this should have been treated as an accident. There is a difference in the definition.
Right. Mr. Lazar, I think the fact that the AAIB got involved since day one, we understand that it was the AAIB that told the airport authorities at the airport to collect the samples of the cockpit crew. And that is how it is suggested that the AAIB was involved in the investigation right from the beginning, and that is why it also becomes an accident since the AAIB is probing it. But coming to the psychoactive substance...
Sorry. Please read the PIB statement. It calls it a serious incident.
I know.
That's the distinction I'm trying to make in law.
Yeah. The Civil Aviation Ministry did call it a serious incident. It did classify the occurrence as a serious incident. But the fact that AAIB got involved and now the French investigators are involved, and we understand that Airbus and other stakeholders could also join the probe. So that also suggests that it is a serious accident that AAIB will now probe. But coming to your comments on the psychoactive substance test, does it indicate, or how long, if it was a medicine or a drug, how long does it stay in the urine? Because the urine sample is what came positive. So how long does it stay generally in the blood sample or the urine sample?
Madhya, frankly, I'm not a doctor, but I will tell you that I know because I was involved when the car was being issued. And I do believe that in the blood, it stays the least. In the urine, it stays up to, from 7 days to up to 30 days. In the hair, it's, and body cells, it stays much longer. Now, in the case of a medical tablet or something like that, or the impact of a medical, a dolo or a antihistamine would probably go away in 7 to 10 days. Whereas if you are, a regular drug user, it's going to stay in your system for much longer. I also want to tell you, through my cursory inquiries with doctors in the last 48 hours, I found out that At this point, when they do the test, they can then break it down and identify from which chemical formulation the positive came from. So I'm certain at some point they will do that.
Indeed, I'd like to thank both of our panelists, Captain Thomas, Mr. Lazar, for joining us. Again, both our panelists, they're insisting on the need for patience at this point and to await, of course, the final results of that confirmatory test, which is, of course, awaited. The labs undergoing that test. And, of course, Madia's exclusive news break as well, that the French Investigation Authority, BEA, will also be partnering in this investigation. On that note, let's slip into a very short break. But coming up on the other side, the government, in a parliamentary reply, has said that there is no general policy barring airport operators from owning stakes in scheduled airlines. The clarification comes days after reports suggested that the Adani Group was seeking a waiver to enter the airline business. We discuss that and more on the other side. Welcome back to News Center. Now, the government has said that there is no general policy that bars airport operators from owning stakes in scheduled airlines. In a written reply to a question from the Member of Parliament, John Brittas, the Civil Aviation Ministry has said that there is no government policy that generally restricts operators of major airports from holding substantial equity or operating scheduled airlines. Now, this comes days after reports suggested that the Adani Group was seeking a waiver to enter the airline business. However, the ministry noted that certain airport concession agreements do contain restrictions on such cross-ownership. Meanwhile, the Minister of State for Civil Aviation confirmed that the Airports Authority of India has received a letter from the Adani Group seeking a waiver from contractual restrictions that could clear the way for its entry into the airline business. The government, however, is yet to examine this request. The development is significant for the Adani Group. Meanwhile, Bengal MP Mahua Moitra had alleged on X that the group was lying to stock exchanges, referring to what she described as a June 4th letter from Adani to the AAI seeking a waiver from restrictions under the 2006 airport privatization agreement. However, in July 24th communication to the BSC and the NSE, Adani Enterprises denied reports that it was planning to launch an airline. Well, joining us now to help us understand this story as it unfolds is with us aviation expert Sanjay Lazar. Also with us, Rajani Associates, Prem Rajani joining us, live as well. Mr. Rajani, let me come to you before I head to Mr. Lazar. Just give us a perspective. The government clarifying that as far as this cross-holding framework is concerned, it is reviewing. The Airports Authority is reviewing these requests for waivers that have come its way. Tell us, from the law of the land, the way it exists, is there any mechanism, is there any procedure that empowers the Airports Authority to grant such waivers, or will it be ad hoc, case-by-case decision?
I personally believe this would be more of a general waiver, not on a case-by-case basis, because it just cannot be tailor-made for one or two bidders. It should be done across board for the benefit of all the players in the market. So I believe the government will make a general waiver or amend the law if need be, because though they say there is no restriction, but if there is one, they can give a clarification and make suitable amendment to the particular policy.
Mr. Rajani, do you see, is there a possibility of any conflict of interest here if airport operators who control effectively everything at the airport from slots and gates, and if they had to start an airline, the fear that we've been hearing for the last 1 month is about conflict of interest. Do you see any possibility of conflict of interest here?
It's a very interesting point because keep aside for a moment aviation. Many of the sectors like power generation and many of the road, everybody has a conflict of interest to a certain extent. But truly speaking, the law is well legislated. I think as a person, I would say, what are the three important factors when it comes to a same owner of the airport and the same promoters owning the aviation? So long as you're able to have a policy in place which ensures that there is a systematic and no priority landing rights or takeoff rights, and there's no priority of gate allocation to the owner of the airlines who also owns the airport, and there's a proper arm's length relationship. I believe there should be no harm, because that is exactly what we do for banks giving loans to their group companies at times, and so long, likewise for the power generation and infrastructure company. So why create a blockage for one sector, which is the need of the hour also?
Sure. Let me take that question across to Mr. Lazar. Mr. Lazar, historically, though not by way of a government policy, but through these individual agreements, there has been historically a 10% equity cap from airlines enjoying a stake in the airport operators. That's, of course, to ensure that the airlines don't have some kind of conflict in terms of getting beneficial treatment at a specific airport. Have we reached that stage? Has the aviation market evolved to a point, matured to a point where those safeguards are no longer needed, perhaps?
Well, Ashwin, thank you. I mean, I have very strong views on this because of my historicity with the subject. Allow me to take you back a few years. I do not know if you recollect, in the same government, 2019, the Tata Group had signed a note sheet with the GMR Group to buy 49% of that company through various holding companies and the Singapore government. And they went ahead, and then there were objections. They were forced to scale back, and they came back to 15%. And then there were more objections. They were asked to come under 10%. Otherwise, the Tatas would have literally owned half of GMR today. Delhi Airport, Hyderabad Airport, Go. And they were asked to stay out of it because they owned a stake in Vistara and AirAsia at that time. Now, the Tatas, of course, walked away from the airport business completely. Now we have a case where airport operator, subsidiary of the Adani Group, has written to the government, to the AAI, asking for a waiver on the OMDA. Now, this is very specific. The OMDA is for Mumbai Airport, there is a separate OMDA. For Delhi Airport, there is a separate OMDA. For Bangalore, each airport has a different one. The government's larger policy says 10%. In each of these OMDAs, there is a restriction on that airline operator or airport operator from taking a larger opening an airline. Now, they sought a waiver for future. If you read the letter, it clearly states that for future, they would like a waiver, and if possible for this. That is because there is a rumor that, they're constructing aircraft, they may want to get into an airline business. Now, let's evaluate this from a larger perspective. Step back a little bit. Today, out of all of India's airports, 50% is run and managed by two companies, GMR and Adani Group. That means there's a duopoly in the airport operations. 90% of our aviation market is also run by two companies. which is Air India literally and Indigo. There is a duopoly there. Now, are we moving towards, now this has got nothing to do with, A operator or B operator. The entire ecosystem is owned by one company, from airports, aircraft manufacturing, training, pilot airports, you name the entire thing. Now, is this something that's going to benefit the market? And is it going to benefit the passenger? I'm looking at it purely from a passenger point of view. If one airport operator operates an airline, is he going to give us cheaper fares? You're intending to break a duopoly. Are you breaking the duopoly? Now, please listen to what Mr. Mohol said in Parliament today. I read through. He's made a distinction, and very cleverly, and I must compliment the government for this. They've actually not spoken about the Omdas. They have actually said they've carved out a differentiation, that we do not refer to those agreements. We refer to others. There is no bar on an airport company starting an airline, period. But Omdas will apply. Now, that will have to be looked at very closely. I'm sure there are some airlines that oppose, some airlines that support it.
Mr. Lazar. Right, Mr. Lazar, clearly a developing issue. We'll, of course, keep coming back to you, to the experts, to get the latest insights on how this journey is progressing. I'd like to thank my colleague Madhya, as well as both of our panelists, Mr. Lazar, Mr. Rajani, for joining us with their insight. But that, unfortunately, is all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
Now, amid all of that talk about a merchant discount rate or an MDR fee on UPI transactions, the government has come out and clarified, saying consumers will not have to pay transaction charges for using UPI, while the vast majority of merchant transactions will also remain free. The government has clarified that any future MDR rate, if introduced, is going to apply only to a limited set of merchant transactions, and that too above a specified threshold and at a nominal rate, perhaps even lower than the credit or debit card MDR. Dinesh Khara, former SBI chairman, and Upasana Thakur, co-founder of One MobiKwik, join us now to discuss this MDR rate on UPI after the government's clarification and what it could mean for the ecosystem. Upasana, Mr. Khara, thanks very much for joining us here. Mr. Khara, just from your experience to begin with, the wider concern, and legitimately so, has been if you impose any kind of MDR on the merchant today, what is to stop him from passing that on to consumers? Even if you're not directly charging the consumers for any transactions, what stops him from passing it on? How would you answer that?
Well, I think when it comes to merchant, they have to actually weigh their cost if at all it's MDR is being paid or not. So actually, it's a convenience which is being made available to the merchant, and for that he is required to pay. In fact, before 2016, when the demonetization happened and when MDR was waived, that before that, actually all debit card, even credit card, all these transactions were entitled for MDR discount. So we were seeing the adoption of it. And also, if at all we will look at the global experience, wherein, when it comes to even Brazil and China, these are the two economies where we have seen the adoption of the digital, and also there is MDR. And in fact, in case of Brazil, it will be as high as about 0.33%. And even in China, it's ranging from 0.33 to 0.40%. But nevertheless, we have seen that the adoption of the digital transaction is as high as about 90% in these two countries. Whereas in case of Brazil, it actually started even almost 2 years later than when we started our NPCI or the UPI transaction. So I think it's more of a habit, and merchant, of course, they have to weigh when it comes to their competitiveness. If at all they have to maintain their competitiveness, they will probably absorb these costs. And I would say that if at all you will weigh the cost of handling cash or cost of handling checks as compared to that, this would be almost negligible. So I don't see that it should be a major challenge when it comes to the adoption by the merchants.
Okay, that's an important comment. Do you think it'll, be economically more viable for the merchant to absorb the cost and pass it on, compared with the cost of handling checks or cash? But Upasana, let me bring you into the conversation because, as a fintech that's very much a part of this UPI ecosystem, what does it actually cost to offer UPI at scale today? And what, to your mind, is an ideal MDR fee that will make this business sustainable?
So firstly, thanks for having me here, Ritu. First thing I wanted to say, which Mr. Khara already mentioned, that even today, by the way, if I spend, let's say, 5,000 rupees from my bank account using my debit card, my Visa, Master, or any debit card, about 2,000 rupees, the merchant pays 0.9%. And below 2,000 rupees, the merchant pays 0.5%. This is the government RBI mandated MDR that is currently running on debit cards. So you see, my perspective is very simply, and to answer your question, and we all hear about, there is fraud happening, the scale of UPI is increasing. My perspective is that the cost of supporting the UPI transactions is something, that the banks and fintechs like mine are paying. And it is in the form of, the server cost, to the reliability required, the uptime required to manage this huge scale of UPI transactions, the investments that go into fraud prevention and cybersecurity and innovation to make daily life UPI very easy for everyone. And, the subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. And, it's therefore to say that, UPI is free, it should serve the purpose of financial inclusion. It should always be free for consumers. But when it comes to the fact that zero MDR, as a framework that has been running, the cost has been borne, significantly by payment companies. And there are enough large merchants in India, who are doing revenues of multiples of thousands of crores. And they are paying today on credit card 1.8%. They are paying 0.9% on debit card. So why should they not pay anything on UPI? And why should the cost, be borne by players like us?
Well, Upasana, you're saying what the government is offering in terms of incentive, which as per the last budget is 2,000 crores, is only 10% of the cost. So 20,000 is the annual cost of maintaining the UPI ecosystem for the industry. And my question was, what is an ideal MDR, to your mind, that will make this sustainable?
See, according to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players is important. I mean, I can give you a very simple example which will make this realistic, for our, audience. See, we are a scaled payments company. We are not the largest UPI player. I believe we are ranked number 12 or 13th, but we are the second fastest growing UPI app for the last 1 year. And, the every quarter, including this quarter, when I'm announcing the results, investors are asking me that your GMV is growing by 50% year on year. Why is your revenue not growing? I don't have any answer to give other than the fact that a huge amount of this growth is coming from UPI, where I'm investing resources but have zero revenue. And I'm saying this on behalf of every player in my industry. I'm just using it as an example to tell you that this is a major issue of sustainability.
No, absolutely. And sustainability is the word that the government also uses when talking about a potential MDR on UPI. But Mr. Khara, if you could simplify for our viewers, let's say the MDR fee is 50 basis points. How exactly is it split between, a fintech or an app that is offering that UPI, the issuer, the acquirer, bank, NPCI, any other players that are involved? And is that fee going to be, you think, introduction of this fee going to make banks perhaps, be more innovative as far as UPI is concerned, because payments as a whole has been completely taken away from banks into, the fintech ecosystem. They're not at the forefront if you look at the largest transactions. So do you think an MDR is going to bring about more innovations? And how would the MDR fee be split across various players?
Actually, when this MDR was not there, and we were getting only the subsidy amount on an annual basis, banks had started looking at payment as one of the hygiene factors. It has made to be available. It has got to be made available to the customer. But, when it comes to investment for upgradation, investment for technology upgradation, investment for cyber security resilience, so all those things, not as much of amount got allocated for this kind of transactions. But eventually, banks have to ensure their cybersecurity resilience overall. So that's why they were spending it per se, out of compulsion. But when it comes to sustainability of this activity per se, there were challenges. In fact, the payment companies were actually facing the brunt of it to a greater extent. So I think what has happened is that when it comes to split between, the various participants in the ecosystem, much of it will actually go towards the technology service provider. And also, when it comes to, bank issuers may not have as much of earning, but yes, of course, when it comes to settlement bankers, yes, they will be actually handling with large volume of transactions. So naturally, some part of it will go there. But in terms of exact proportion, much of it will depend upon the bargaining power of each of the players in this whole ecosystem.
Okay, so let's not speculate on that. Then, Upasana, let me ask you this. If you look at the competitive landscape of UPI, I mean, just looking at the, apps, between Google Pay, Phone Pay, and Paytm, that's almost 90% of the market. Do you think the introduction of an MDR will make it a more level playing field, introduce more competition for players like you as well? Or do you think that'll continue to be the case, MDR or no MDR?
No, absolutely. I think the first thing you have to understand, and I also read some news articles where, there is political commentary that, the MDR is only going to help the card networks, the American-owned card networks. I actually think that it's completely contrary. I think that if there is no MDR, think about who is able to lead the pack. As you yourself said, the leaders are all people or companies with very deep pockets who can absorb without revenue going on for years and years of growth. How will, all the other fintechs who don't have as much deep pocket, the independent Indian companies, how will they be able to cope up? So bringing in MDR brings in competitiveness in the market. It gives a reason for other players to invest in growth. Without MDR, there will only be, the market will only be owned by people who are willing to burn, who have the pockets to burn.
All right, Mr. Khara, Upasana Thakur, both of you, thank you so much for joining us here on CNBC TV 18. It's a pleasure having you. And on that note, we're going to slip into a short break, but don't go anywhere. We're back to continue this discussion in just a bit. Welcome back. You're watching our special broadcast on the MDR debate, and we're now joined by Emin Srinivasu, the co-founder of BillDesk. Mr. Srinivasu, thank you very much for joining us here on the program. First, give us a lay of the land as you see it, both from the BillDesk point of view, of course, and of course as the chair of the Merchant Aggregator and Acquirer Committee of the Payment Council. What is an appropriate MDR fee to actually make this system sustainable?
Thanks, Ritu, for having me on your show. You asked a very deep question for which I think we are all even looking for answers to what is the level of MDR that needs to be charged. But let me just step back a bit to give the perspective that is sought. UPI has grown phenomenally over the last few years, as everyone knows. And it's been subsidized partly by the government and a lot by the payments in the fintech ecosystem. And it's at a stage now where growing it deeper, taking it to deeper into India needs sustainable investments. And it's in that context that I think the industry has been representing for a while now, both to the policymakers and regulators, to allow for an MDR to be introduced, keeping in mind the various objectives of the digital agenda of the country to protecting the consumer and the small merchants. So that's the background and the context. And I think we've all seen the press releases done by the government, which suggest that MDR, as and when introduced, would perhaps look at a small segment of the transactions, particularly with respect to large merchants. So it would really depend on what gets covered to figure out what's the right MDR value. But every bit helps the industry to grow this better. So.
But, Mr. Srinivasu, how much is that bit is the question? Because as we see, let's assume transactions above 2,000 are charged, nothing below that. In volume terms, that's barely 4 or 5%. I mean, is that viable to cover a 20,000 crore rupee annual cost for running the UPI ecosystem? That is the question. I mean, this selected move, is that going to make the system viable?
Every small step will matter. Having said that, I think we still need to wait to see whether the MDR as allowed is on basis of a merchant size or a transaction size or some combination of both. It's perhaps one can only speculate without knowing too well where it will come. But hopefully, I mean, even if they allowed it a reasonable amount of bits mirroring something like what we have on other debit transactions, it would be a big relief for the payment sector.
But, Mr. Srinivasu, we were just speaking to Upasana from MobiKwik, and she said anything below 30 to 50 basis points would not work out. Do you have a number in mind?
I would put it in reverse way. Every bips matters. Like boon boon se sagar banda, so every bips will matter here.
Okay. All right, you won't give us a number, but we'll see what this boon really is. But could a zero MDR for small merchants and a higher MDR for large merchants, as we're given to understand, is being discussed? Do you think something like that could create distortions, or could it encourage merchants to split transactions to stay below the threshold? I mean, what do you think the impact of this could be? And we know Indians are big jugadus. How do you think this will work out?
Two things. I think one, just to even addressing your earlier question, given it's a debit mechanism to bank account, it's not unreasonable to think an MDR could mirror the debit card kind of mechanism, which has a dual rate system going all the way, between a 40 bips to a 90 bips. You're right. I think we need to have guardrails to make sure that the intent of the mechanism plays out the way it is to be in the market. Having said that, I think if I would even think from the merchant's perspective, the transaction charge will be a minuscule part of their overall collection pool and the amounts they're collecting. That I hope they would not waste their energies and time trying to be jugadu about this. It's, I think, easier to think of it as a large merchant to a certain size of revenue and all transactions of theirs getting charged. That will perhaps be an easy way to think of implementation here.
But are you aware of the structure that is being discussed? I mean, not the number. Is it going to be a percentage of the transaction value? Will there be a flat fee, a tiered MDR based on the merchant size and transaction? What is under discussion?
So over the last many years and quarters, there's been a healthy debate around what could be the right mechanism. So I think all options have been considered. And I do recall reading in the government release that a steering committee set to decide this. As I said, I think one way to think of this is relatable benchmarks. And to me, the debit mechanisms in the country offer that, which is essentially that there are certain kind of, let's say, financial service industry transactions, which perhaps will have a different fee structure compared to, let's say, standard commerce transactions. I think it's fair to think of it in those terms. Though, as I said, we're all speculating. We'll just have to wait to see how the steering committee thinks on this.
Okay, we'll leave that decision to later. But since you're referring repeatedly to this government release, the headline of that is that it's going to remain free for customers. P2P, there's not going to be any charges, which we understand. But my question to you is, what is stopping the merchants from passing on the cost to customers? I mean, you can't really ensure that in a law, can you?
You can't. As I said, to be very honest, you can't. Therefore, it's important to have guardrails. And as I said, if the mechanism fairly and transparently address this concern, the incentive for the merchant to want to pass on also should be very limited. The cost is nominal. The merchants to whom this will apply will be very large merchants. The cost of wanting to pass on, raise invoice on customer, all to my mind, very honestly, is not going to be worth the exercise for merchants. And in any case, many of these merchants today absorb such costs or even much higher costs on other payment methods. So I don't think this is such as drastic an impact as I think some coverage makes out. This should actually pretty well work for the merchants, helps them deepen it, gives them a very known cost structure at this point, helps them also scale up on their collections with definitive knowledge now.
The other idea mooted about, the reason for bringing in MDR is to ensure that there is security, there's innovation, the ecosystem continues to grow. But look at the UPI market today. It's so heavily concentrated in the hands of a few players. Do you think MDR, risks making the biggest players even more dominant? Or do you think this will actually improve the economics for the broader ecosystem, level the playing field?
I think it does two things. Let's just assume irrespective of the MDR, and it follows, let's assume, a structure similar to what other payment methods have, which means there is a split of the fee between those who are acquiring merchants and those who are, issuing the handles, or those who kind of maintain the customer account. So at first pass, I think there is some degree of split that goes, and I think the Indian banks stand to benefit. It helps them defray some of the costs that they bear on infrastructure. On the merchant acquiring side, I think I think most people tend to look at the market from just the user angle of the TPAP angle, or which app they're using. Merchant acquiring is much more broader than that. Think of it as the pure online world and the physical face-to-face world. It's fairly divided merchant acquisition. I think it helps both segments of players. The smaller players now have the incentive to want to scale faster and bigger. And for the larger players, it starts helping them invest better into innovation, and therefore kind of, I think, lead the market there.
But, how is MDR typically split, if you could give us an idea? I mean, there are so many players involved in the ecosystem, the issuing bank, the acquiring bank, the app that you're using, NPCI and whatnot. Any sense of how the MDR itself could be split?
So I think one can look at alternative models that exist, which take the RuPay card, for example, and therefore know that there will be some proportion of split. It's always been a matter of debate as to which side of the table should get more. Is it the acquiring or the issuing side? And at various points, that argument, the balance of the argument shifts based on where the market stands. I think at this point, given where Digital India stands and the need to kind of penetrate deeper, let me say, as a payment aggregator, I'm hoping the balance will tilt a little bit in favor of the acquirer this time around.
Well, we'll wait to see these details. But finally, I wanted to ask you, changing behavior has also been a challenge. UPI today is zero price product for merchants. But once you introduce this element of a fee, how difficult to your mind is it going to be to change this merchant behavior and convince them that it's still worth using UPI and not moving towards cash?
Very honestly, my personal opinion, I don't think a nominal cost gets people to think along those lines at a very foundational level of should I switch from digital. Again, I think one perspective I want to reiterate, which I think most people miss. Merchants today are bearing costs of payments on other payment methods. So it's not like it's a bolt out of the blue, right? It's for a part of the transaction that were free. Now they will see a nominal cost. And I think they will want to expect more from the industry given these changes on costs. I think that expectation of theirs will get fulfilled. Behavior will change, but I think from a consumer perspective too, as I said, while no cost is getting passed on to it, whether you think of it as merchants or consumers, they have the ability, aptitude to take on nominal costs. I think people appreciate the convenience it gives them, the flexibility it gives, and it's a phenomenal tool in people's hand, right? So from a merchant perspective, I don't think a nominal cost is something they will mind much.
Well, no doubt. I mean, that's the reason we're seeing this wide adoption of UPI, and let's hope that continues, MDR or no MDR. Mr. Srinivasan, thank you so much for joining us here with those valuable inputs. It's a wrap on Newsmaker. Thank you so much for tuning in, but stay with CNBC TV 18. More news and updates continue after this break.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices hover around the $85 mark as uncertainty over a potential Iran-US deal continues. President Trump says Washington is only semi-negotiating and hints at more economic pressure. Iran says there are no direct talks with the US and the Strait of Hormuz will not open till Washington meets Tehran's demands. US Senate votes overwhelmingly in favor of a bill proposing 100% tariffs on Russia's top trading partners. These include India and China. The House of Representatives is likely to take up the bill within weeks. The legislation was championed by the late Senator Lindsey Graham. Sensex and the Nifty end with marginal gains after minor adjustments during the closing auction session. Mid-caps rally with the index gaining nearly 400 points. The rupee weakens by 9 paise against the dollar. 5 main board IPOs worth close to 7,500 crores expected to hit the large street this week. Bain Capital-backed auto component manufacturer Crude Transmission takes the lion's share. An estimated 54% of the funds raised will be infused into the companies. The government says there is no policy barring airport operators from holding substantial equity in commercial airlines. The Minister of State for Aviation confirms Airport Authority of India has received a letter from Adani seeking a waiver of contractual restrictions that would allow entry into the airline business. The government is yet to examine the matter. French investigators will join India's Aircraft Accident Investigation Bureau to probe the Air India Phuket-Delhi flight incident. 17 passengers were injured after the flight suddenly lost altitude of about 300 feet mid-air. Pilots Association blames hydraulic failure. Final result of the pilot's drug test is still awaited. The government tables an amendment bill to rein in states' mining revenue powers. Also allows leaseholders to apply to the state government for adding other minerals to an existing lease. The bill will impose limitations on the state's powers. It comes 2 years after a Supreme Court judgment upheld the state's ability to levy royalty. Ola Electric Mobility shares tumbled 6% after the auditor raises the red flag over a 57 crore rupee battery scheme penalty provision being reversed, as the penalty was reversed before a formal waiver was granted by the government, and it helped Ola Electric shrink its first quarter losses. The auditor does not clarify whether reversing the without an approval was justified. Police fired tear gas, used water cannons and lathi-charged protesters agitating against the alleged civil service exam irregularities as they attempted to reach the Jharkhand State Assembly in Ranchi. BJP leaders, including 21 MLAs, detained while protesting outside Chief Minister Hemant Soren's official residence, demanding his resignation. China evacuates more than 1 million people as a powerful typhoon makes landfall. Heavy rains batter Shanghai as the city receives its highest 24-hour rainfall in more than 150 years. Microsoft issues a warning to travelers as hotel Wi-Fi networks could be compromised and hackers could potentially access mobile phones remotely and steal passwords. Well, let's go straight to the top story this evening. Uncertainty over a potential Iran-US deal continues as President Trump says that Washington is only, and I quote, semi-negotiating. Let's bring you up to speed on the latest developments. Now, Trump has told Axios, and I quote, that Washington is just watching Tehran, its huge inflation and the fact that they have no money, end of quote. Now, Trump added that the U.S. naval blockade in the Strait of Hormuz has accelerated the Iranian regime's economic crisis. On the other hand, Iran says negotiations with Oman and a new maritime route in the strait are in the final stages. The country's foreign minister, Syed Abbas Araghchi, also said that the existing routes will be replaced. Tehran is warned that the strait will open only once the U.S. stops its threats and withdraws air and naval forces involved in the blockade. Iran has also asked for compensation for damages, lifting of U.S. sanctions and unfreezing of Iran's assets. The situation remains tense in the Red Sea, where Yemen's Houthi militants launched missile and drone attacks near the Al-Maka port over the weekend. The militant group claimed to have targeted Saudi targets in the region. They also said they attacked an oil facility in Saudi Arabia. All of this impacting the oil markets. Brent crude prices hovering around the $85 mark amidst the tensions and uncertainty. UAE has condemned a hostile Iranian attack on the state-owned oil company ADNOC's vessels in the strait. Here's Iran's Foreign Minister Araghchi on Tehran's demands and negotiations with Oman.
Our negotiations with Oman concern the establishment of new maritime routes through the Strait of Hormuz. These talks have progressed well, and I can say that we are in the final stages. The old routes will be replaced with new ones. Experts are currently working on the maps. This, however, does not mean that the Strait of Hormuz will be reopened. An agreement on the routes may be reached, but reopening the Strait of Hormuz depends on a separate set of conditions being met, and those conditions are being conveyed through intermediaries.
Well, that's Iran's foreign minister. And in Israel, Prime Minister Netanyahu has reiterated his rejection of Donald Trump's latest 15-point plan for Gaza in what were televised remarks. Netanyahu said that Israel's forces will not withdraw from the enclave until Hamas is genuinely disarmed. Trump's Board of Peace last month had said it reached an agreement for the complete disarmament of Hamas, but Hamas said handing over its heavy weapons was contingent on Israel withdrawing its forces from Gaza.
Israel rejects the 15-point plan. I heard that there were those who said you didn't say it, but we did say it. And here, I am saying it again. Israel rejects 15-point plan. The IDF will not carry out any withdrawal until the dismantling of Hamas and its weapons. And when I say dismantling Hamas and its weapons, that means heavy weaponry, less heavy weaponry, and smaller arms. All weaponry. We're talking about a true dismantling, not a fictitious dismantling. We're now speaking with the Americans about this subject. They have ideas. Some of them are acceptable to us, and some are unacceptable to us.
Well, that's Netanyahu. There at least 12 people have been killed and 39 injured in a Ukrainian drone strike on a region in central Russia. The attack has targeted an industrial area near a major oil facility, making it one of the deadliest Ukrainian strikes on Russia. Meanwhile, a Russian strike in the northeastern Ukraine killed 5 people. The UN has warned that long-range strikes by both sides have intensified this year, resulting in a rise in civilian casualties. The U.S. Senate has passed a bill that would authorize tariffs of up to 100% on countries that continue to import Russian oil and gas. Now, the measure was approved by an overwhelming 86-11 vote, and it will now have to clear the House of Representatives before it can become law. Now, if enacted in its current form, the bill could have implications for major buyers of Russian oil, and this includes India, as well as countries like China and Hungary. Now, India is vulnerable because it is the second largest buyer of Russian crude after China. Russian crude met roughly 30% of India's import requirements last financial year and cost nearly $41 billion. So that is going to be an important development to keep track of. Let's talk about the day's market action. The Lal Street ending largely in the green today after closing auction session. The Nifty finished just below the 24,600 mark, with the CAS resulting in a 24-point adjustment. The Nifty Bank, however, slipped 60 points, ending in the red, while the mid-cap index outperformed the benchmarks, closing over 0.5% higher. A quick check on the currency market action. The rupee trading in a narrow range as likely central bank intervention blunted the impact of the uptick in oil prices. Traders said state-run banks were spotted offering dollars, most likely on behalf of the Reserve Bank. Forex traders say FII inflows and a rise in forex reserves prevented a sharper fall. 95.30 is the dollar rupee for you. On to action in Parliament. The government has tabled an amendment bill that allows the centre to impose restrictions on the state's ability to impose cess on mining rights and mineral-bearing lands. Now, this bill will also allow leaseholders to apply to the state government for adding other minerals to an existing lease. Ashmit joins us now with more details. Ashmit, take us through the contours of the amendment and what this now means, given the fact that there was a 9-judge bench Supreme Court order that authorized states had the power to levy taxes, cesses, etc. on minerals.
Well, what we're picking up is that the bill, the MMDRA amendment bill, has already been introduced in the Lok Sabha. Now, this will be important not just for the centre, but also for the states as well as for various mining companies. Why is that? Well, essentially, what the amendment seeks to do, amongst various other things, is to impose conditions on the power of the states to levy a tax, a levy, or as far as royalty is concerned, on mining rights as well as mineral-bearing lands. Now, this is important because the centre will now have the power under this bill, if it's passed subsequently by the Parliament. The centre will have the power to prescribe these additional conditionalities. Why is that significant? Because bear in mind, circle back to 2024, that is when the Supreme Court in fact had held by way of a 9-judge bench judgment in favor of the states, that states can levy royalty as far as mining is concerned. That came in as a big win for the Exchequer as far as state governments are concerned. However, that did spark concern as far as the mining companies are concerned. They were batting against such a levy of royalty, saying that this royalty is tantamount to additional taxes being levied. However, in 2024, the Supreme Court had held in favor of the state governments, but there were two important caveats. Number one, the Supreme Court had said that there is no existing restriction as far as the state's power to levy such a royalty is concerned, a tax, a levy, a fee. There's no restriction as such. Number two, the second caveat that the Supreme Court had given is that the centre is at liberty to come out with fresh restrictions if it thinks it necessary through additional legislation, through a new law, which appears to be happening as far as this particular amendment is concerned. The MMDRA amendment bill, it's currently been introduced in the Lok Sabha. We have to see whether or not it gets passed by the parliament, but importantly will have big implications on one, the royalty output as far as mining companies are concerned, and of course the state governments themselves in terms of how much money they can look to garner from such mining operations in their respective states. Back to you.
Ashwit, many thanks for joining us. In a bid to break the deadlock in Parliament, the government says Home Minister Amit Shah is ready to make a statement on the crackdown on student protests in Delhi's Jantar Mantar. With only 3 days left in the monsoon session, the opposition has been protesting inside and outside the House, demanding a statement from the Home Minister. Parliamentary Affairs Minister Kiran Rijiju said Home Minister Amit Shah will respond to the opposition's debate on the students' agitation, but the opposition must listen to the government's response peacefully. Meanwhile, the Congress party maintains the deadlock is likely to continue until the Home Minister makes a statement in the House.
मैं बहुत साफ शब्दों से सरकार के ओर से कहना चाहता हूं, सरकार पूरा छात्र का मामले को लेकर के चर्चा के लिए तैयार है और स्टेटमेंट ही नहीं, छात्र का मामला को लेकर के पूरा चर्चा के लिए तैयार है और पूरा जवाब देने के लिए तैयार है। गृह मंत्री जी विस्तार से जवाब देने के लिए तैयार है। मैं अनुरोध करता हूं कांग्रेस पार्टी और इनको कि गृह मंत्री जी का जवाब के समय डरना नहीं है। लोकसभा में और राज्यसभा में एक ही डिमांड है कि अमित शाह जी सदन में आना चाहिए और अपनी बात रखना चाहिए। हम 17 दिन से ये पूरी कोशिश कर रहे हैं कि वो सदन में आके जो बच्चों के ऊपर अन्याय अत्याचार हुआ और जो उनको मारा गया, पीटा गया, अब सबको मालूम है और इस विषय में उनका एक स्टेटमेंट चाहते हैं।
Well, the action in Parliament there. We'll head into a break, but up next, 5 main board IPOs close 7,500 crores expected to hit Dalal Street this week. That and more when we get back. The government has said that there is no policy barring airport operators from holding substantial equity in commercial airlines. The Minister of State for Aviation has confirmed that the Airports Authority of India has received a letter from Adani seeking a waiver of quote-unquote contractual restrictions that would allow Adani's entry into the airline business. Madhiha joins us now with the details. Madhiha, this is a reply in Parliament by the Civil Aviation Ministry. Where does this now leave the matter of giving the Adani Group a waiver to get into the airline business?
Well, we have been reporting on the possibility of airport operators starting an airline ever since the reports surfaced. Now, the government has for the first time officially confirmed that Airports Authority of India has received a request seeking a waiver that could allow an airport operator to own an airline. That's the first official confirmation from the government. We have been writing to the Adani Group seeking their confirmation whether they wrote to the government or not. But now the government is clarifying in the parliament that it did receive such letter. However, the Civil Aviation Ministry has clarified that the proposal is yet to be examined, and in a written reply to Parliament, the ministry said that the AAI has received the waiver request, but no decision has been taken so far. The government has also clarified that there is no policy preventing airport operators from owning airlines. Instead, the restriction comes from concession agreements signed with some PPP airports, and the proposal first came into focus after Bloomberg had reported on the 22nd of July that the government was considering allowing airport operators to own airlines. A June 4 letter that was written by the Adani Group later surfaced, showing that Adani Airports had sought a waiver from the AAI, and 2 days later, Adani Enterprises told the stock exchanges that reports of it planning to launch an airline were entirely baseless and that it was not evaluating any such proposal. But yesterday, TMC MP Mahua Moita shared the June 4 letter on X, and today the government confirmed in the parliament that AAI had indeed received a waiver request from the Adani Group. The letter that was shared by Mahua Moitra seeks permission for Adani Defence and Aerospace or its affiliates to invest in, establish, acquire, own, promote or control a scheduled airline, and it also argues that such a move would help create additional airline capacity and improve regional connectivity. The letter also attempts to address concerns over conflict of interest. It says that airport neutrality can be maintained through safeguards such as IATA compliant slot allocation, regulatory oversight by the DGCA, Ministry of Civil Aviation and ERA, independent governance structures, information barriers and non-discriminatory access to airport infrastructure. So while the government has now confirmed that a waiver request has been received, it has also made it clear that the proposal is yet to be examined.
Yes, of course, there is no fresh statement now from Adani. Remember, they'd issued a denial to that story. Now it has been confirmed by the government itself in Parliament that the Adanis have in fact sought a waiver wanting to get into the airline business. Madhiya, let's also talk about the Air India Phuket Delhi flight incident. We are given to understand that French investigators are now going to be joining India's Aircraft Accident Investigation Bureau in the probe. 17 passengers were injured after the flight suddenly lost altitude of about 300 feet mid-air. So, Madhiha, will technical experts from Airbus be involved in the probe now?
Quite possible, Shireen, and this is also something that tells us the scale of the probe now. It is entering a new phase altogether. The Aircraft Accident Investigation Bureau, or AAIB, has formally taken over the probe under ICAO's Annex 13 norms. And France's Air Accident Investigation Agency, the BEA, will also participate, is what we understand, in the investigation, as the aircraft involved is an Airbus A320 by the French manufacturer Airbus. BEA's participation could also bring Airbus technical expertise into investigation. That is what Annex 13 means. Meanwhile, the Civil Aviation Ministry has officially classified the occurrence as a serious incident, and the ministry has also confirmed that the pilot in command's post-flight psychoactive substance screening indicated a result that required confirmatory testing. The sample has now been sent to a designated laboratory with the final report still awaited. The DGC has taken both pilots off roster pending completion of the investigation and the prescribed process. Now, even as the AAIB investigates the cause and goes through the flight data recordings, the Airline Pilots Association of India, or ALPA India, has claimed that the aircraft suffered a triple hydraulic failure that led to the sudden altitude loss. Now, ALPA has also urged against speculation over the pilot's screening results, stressing that a preliminary screening is not proof of drug use and that conclusions should only be drawn after confirmatory laboratory testing. With the technical investigation now underway, the focus will be on two questions: what caused the aircraft to suddenly lose altitude, and whether there is any link whatsoever between the substance screening of the pilot and the incident in itself.
Yes, important questions there, Madhi. I appreciate you joining us with the details. Now, 5 main board IPOs worth over 7,400 crore rupees expected to hit Dalal Street this week, and estimated 54% of the funds raised will be infused into the companies. Rachna is here to unpack the IPO action for us. A busy week, Rachna.
Absolutely. 5 IPOs opened this week, and together these companies are looking to raise 7,479 crore rupees. Crude Transmission leads the pack at 3,067 crore rupees. It's a Bain Capital backed auto components maker, the market leader in 2- and 3-wheeler wiring harnesses with a 41% share and nearly 70% in the electric segment. Mole Bio Diagnostics is raising 940 crore rupees. It's the Goa-based diagnostics firm behind the TrueNat platform, a portable PCR testing device backed by Temasek and Motilal Oswal. Then there's Milky Mist Dairy Food that opens tomorrow with a 1,553 crore rupee issue, the largest ever by an Indian dairy company. And on Wednesday, 2 more: Shiprocket with Temasek backed which is the Temasek backed e-commerce logistics platform, raising about 1,600 crore rupees, and Biharilaal Engineering, a Punjab-based alloy steel and castings maker, raising about 300 crore rupees. Now, of that 7,500 crore rupee number, 4,006 crore rupees is fresh issue. That means money that goes directly onto the balance sheet of these companies. The remaining 3,472 crore rupees is OFS, existing shareholders selling out. That's 46% of the week. And that number may sound high, but in the first half of this year, offer for sale made up 56% of every rupee raised through Indian IPOs. Fresh capital was shrinking. This week, it's pretty much back in front, and the 5 look nothing alike of these IPOs. Milky Mist is 92% fresh issue, a company that clearly needs the money. Mole Bio is just 21%, with Temasek and Motilal Oswal private equity selling down. So after 6 quiet months where sellers led, fresh capital is back on top this week. Whether that holds or not, we'll know next week.
All right. Many thanks, Rachna, for joining us. Now, the government has once again clarified that customers will not have to bear the transaction costs while using UPI. The Finance Ministry said that person-to-person transactions will continue to remain free. If the fee is introduced, it will be levied only on select merchant transactions above a certain threshold. They have not clarified what that threshold will be or when this fee will come into effect. Ritu joins us now to explain why this debate has taken centre stage now and what is the cost of running the UPI ecosystem. Ritu.
Well, a lot has been said about this MDR fee on UPI transactions, so let's look at both the sides. The argument in favor is fairly straightforward. UPI has become massive, but running this costs a lot of money. MDR can create a revenue stream. It can reduce the dependence on government incentives, help pay for the infrastructure, cybersecurity, and even fraud prevention. And if MDR is kept nominal, UPI can still remain cheaper than credit and debit cards. But there are also concerns on the other side. For instance, MDR raises the cost for merchants, and there is always a possibility that some of that cost gets passed on to consumers. Smaller merchants can also be impacted if the threshold for MDR is set too low. And if UPI does become more expensive, it can eventually impact digital payment adoption. And that brings us to why we're having this debate now, 6 years after the government set zero MDR for UPI. Well, that's because UPI transactions have exploded. I mean, look at the pace from 46 billion in FY22 to 241.6 billion in FY26 and counting. And while the scale is massive, no doubt, the growth rate has slowed down sharply, and you need money to keep growing this infrastructure. According to Payments Council of India, the cost of running this ecosystem is estimated at upwards of 20,000 crore rupees every year, while the government budgeted only 2,000 crore rupees for UPI incentives in this budget, and even RBI's PIDF scheme to support payment infrastructure has now ended. So the bigger question is, who pays for UPI in the long run? The government, the banks and the payment companies, or some of these larger merchants? And that's really what the MDR debate right now is about. Let's hear out what the industry has to say.
Subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. According to me, the ideal MDR is, aligned to, let's say, the debit card pricing. It has to be nominal, but it can't be, less than 0.3 or 0.5%. I believe the Payments Council of India, which is the authorized industry body for our sector, has given that proposal. And I do believe that something in that range, which is nominal at the same time, should offer value to the players, is important.
Well, that is the MDR debate. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. SpaceX startup Galaxy has acquired spacecraft engineering firm Staropes to strengthen its in-house satellite development capabilities. The deal comes after a setback to Galaxy's Drishti mission as the Infosys-backed startup looks to bolster its technical and engineering capabilities.
AUM Ventures has raised 225 crore rupees in the first close of its 750 crore rupee India Innovation Fund 2, with over 65% of commitments coming from international investors. The fund will back early-stage startups in space tech, AI, semiconductors, defense tech, robotics, and other frontier technology sectors.
Sagar Daryani's WA Foods is targeting 250 crore rupees in revenue by FY30 as it looks to scale its street food QSR business beyond Kolkata and Pune. The company is also eyeing packaged foods as it expands its portfolio.
Info Edge reported a 43% jump in consolidated Q1 profit to 490 crore rupees, with revenue rising 11% to 881 crore rupees. The growth was driven by a recovery in enterprise hiring at Naukri and stronger momentum at 99acres.
Microsoft issues a warning to travelers, says hotel Wi-Fi networks could be compromised and hackers could potentially access mobile phones remotely and steal passwords.
Well, those were the headlines we've been tracking for you this evening on What's Brewing. The legal battle between Zostel and Oyo's parent Prism has taken another turn. The Delhi High Court has dismissed Zostel's latest application, even as the company has moved SEBI over Prism's upcoming IPO. Aishwarya Anand is here with the details. Aishwarya.
Another setback for Zostel in its battle with Oyo's parent Prism. Now, the Delhi High Court has dismissed Zostel's latest application as withdrawn, with the court noting it lacked merit. This is the second application Zostel has withdrawn in barely a month. A quick recap on why this matters. This dispute goes back to 2015 over a proposed acquisition of Zostel by Oyo that never materialized. Now, Zostel took the matter to arbitration and won an award, but in May this year, the Delhi High Court set that award aside entirely, ruling there was no concluded deal. Zostel's appeal against that ruling is still pending. Prism, for its part, says it remains confident in its legal position and has called Zostel's applications frivolous. Now, here's the twist. This comes right as Prism has SEBI's go-ahead for its IPO at a valuation of $8 billion, and Zostel has now come to SEBI too, asking it to relook Prism's IPO disclosures on this very litigation. With the IPO process now underway, all eyes will be on whether SEBI acts on Zostel's plea.
All right, Aishwarya, many thanks for those details. Now, on What's Brewing today, consumers today are demanding healthier food, cleaner labels and functional nutrition. But the real innovation is happening long before products reach supermarket shelves. One startup is betting that the future of food lies in the ingredient themselves. Arboreal Innovations has raised 230 crore rupees in one of the largest Series A rounds for India's specialty ingredients sector. The company says it will use the capital to scale manufacturing, deepen R&D and build the next generation of proteins, sweeteners and nutraceutical ingredients, all designed and developed in India. Joining us now is Swati Pandey, the co-founder and CEO of Arboreal. Swati, thank you so much for taking time out and being here with us on Startup Street. You know, most consumers know the brands on supermarket shelves, right? Not the companies that are behind the ingredients. Why did you sort of choose to build a B2B ingredient technology company instead of sort of, you know, launching your own consumer brand? Take us through what you have on offer.
Right. So we are an ingredient technology platform, right? Especially focused on next generation nutraceutical and food ingredients. And what we've done is that we have developed a lot of IP around taking, you know, regular commoditized ingredients and using our technology stack to try to transform them into specialty ingredients that have superior performance. So when I say superior performance, I essentially mean, you know, better taste, better texture, better functionality. One of the you know, key products or rather flagship products that you would probably have heard of is our fermented yeast protein, which has really, you know, taken the market by storm. To answer your question, yes, you know, a lot of people ask us that question, that why not a consumer brand, why an ingredient, you know, technology platform. I think it really goes back to, you know, who we are, you know, as founders, me and my co-founder Manish. We get really excited by the science and the IP. And we would rather, you know, work with, you know, other brands who are our customers and are already doing a great job at marketing the ingredients that we make.
So the science and the IP is what's exciting you, but you've raised this $24 million. So what do you plan to do with this capital, and how, you know, what will it allow you to do that you couldn't do before?
Right. So the idea is to basically use this capital to first expand our manufacturing capacity, and second, strengthen our R&D capabilities. We've been doing this for the last 11 years, right? I mean, it has been, you know, a long journey for us. And in the last 11 years, I mean, we have done a lot of work on technology development, and we have really built that foundation, you know, on which now we want to build and use the same technology stack to, you know, commercialize products across other categories as well.
Sure, and a large part of the fresh capital is going to go into manufacturing, right? How challenging is it to scale deep science innovation into commercial production while also sort of, maintaining quality and margins?
Right, so it's been really difficult, and we are first generation entrepreneurs, right? I mean, so we really, started the business with first principles. We started, as a sweetener company. We tried doing manufacturing. Some things worked, some things didn't work. We learned a lot, and that's how we have evolved, as a company. But like I was saying that, now we believe that we have built a very strong foundation, and we are ready to scale and take the business to the next level.
Absolutely. And, India has traditionally sort of been this, has imported many high-value food and nutraceutical ingredients, right? Is this sort of the moment that India can become a global ingredient innovation hub rather than just a manufacturing base?
Yeah, that's the idea. And that's what really excites us. I think we are in a very different, time today with the advent of, better technologies, with fermentation technologies. I mean, we are betting big on fermentation and biomanufacturing. And we really believe that, India has the ability, we have the science to actually create those, global manufacturing companies also known for its, science and IP and not just, manufacturing and scale.
And you've doubled your growth year on year. Can you sort of share where your revenues stand today and what kind of growth trajectory are you targeting over the next 2 to 3 years, and what's profitability looking like?
Right. So we haven't really, shared those numbers publicly as of yet. But just to give you a sense, I mean, we had a growth of 2.5x in the last financial year. And in the current financial year as well, I mean, we are hoping to clock 2x growth. We are profitable. We are cash flow positive. But just to give you a sense of, our scale, currently India's, 15 to 20% of India's all protein is serviced by Arboreal. So that's the scale we have.
So that's the kind of scale you have. You are profitable at this point in time. And you've supported over 1,100 brands and more than 300 product launches, right? Which ingredient platform, protein, sweeteners, cocoa alternatives, or fibers is sort of seeing the most demand at this point in time?
Right. So the biggest growth is coming from protein. I think, as expected, protein is really, seeing its moment right now. And while sweeteners and fibers are also, I think, seeing some really good early traction, but it's really protein that has done the job for us, especially the fermented yeast protein, which you would now see pretty much on every single shelf.
All right, so protein is what's doing the job right now for you guys. Are you looking at any other product launches at this point in time?
Yes, absolutely. So even within proteins, I mean, we have multiple products. So we have, baker's yeast protein, fermented yeast protein derived from baker's yeast. Then we are also looking at launching a range of plant proteins as well. Again, applying our technology stack to further improve the taste, texture, and functionality. We are also looking at expanding, into collagen and other kinds of proteins.
All right, so big expansion plans there. All right, Swati, thank you so much for taking time out and being here with us on Startup Street.
Thank you so much for having me.
Moving on, also on what's brewing, AI is increasingly joining meetings so humans don't have to spend them taking notes. Fireflies.ai, which automatically records, transcribes, summarizes and analyzes workplace conversations, says it now serves over 20 million users and is used across 75% of the Fortune 500. The company has crossed $1 billion valuation, and its founder is now taking his next bet beyond AI into cricket as a founding investor in the Rotterdam Dockers. Joining me now is Krish Ramaneni, the founder and CEO of Fireflies.ai. Krish, welcome to CNBC studio. Now, as AI meeting assistants have gone from a nice to have to an increasingly common workplace tool, but Google, Microsoft, OpenAI, and several AI startups are now transcribing, summarizing notes. So where does Fireflies' moat lie?
Thanks for having me on, Shruti. And what you asked is the quintessential challenge for every startup. You need to reach distribution before the legacy players see that something is working and catch up. The good news is we've been preparing for this evolution for several years now. And the truth is, work doesn't stop in meetings. It doesn't stop with taking notes. a lot of the work that happens after a meeting, from creating presentations to reports to writing follow-up emails to scheduling new meetings, all of those stuff has to happen. So what we're doing is taking Fireflies from being a note taker into an action taker and doing all of that work for you.
All right. So picking up from what you just said, the first generation of Fireflies AI sort of took notes for you. With agentic AI, could that now put actions, be it assigning tasks, being follow-up tasks, with customers or with trigger workflows without sort of being asked? How far are you from that vision, or are you actually doing that?
We're actively doing this every day. One of the things Fireflies does is generates action items. We generate millions of action items for people. So we sat down and asked ourselves, what if we could do some of this work for people by the time that they end their meeting? So today, Fireflies can go generate reports for you. It can create scorecards for you. We've also been introducing this new product called an email assistant. So imagine waking up in the morning and having all of your emails drafted and organized.
Yeah.
So all the magic we brought to meetings, we want to bring to other platforms like emails and conversations that you have at work.
All right. So if AI can sort of listen, summarize, and distribute action points, do we really need sort of so many meetings? And wouldn't it be ironical that an AI meeting company will actually be helping companies have lesser meetings?
The reason I started Fireflies was so that I could have fewer meetings and I didn't have to repeat myself. A
Mm.
lot of times I would send the note taker to the meetings and then get recaps. In fact, we released a product called Voice Agents, which will have AI go on your behalf and take meetings for you, like screening interviews, interviewing customers, collecting customer surveys. And we've been able to do hundreds of thousands of those calls. And it's saved a lot of organizations and customers thousands and thousands of hours every day.
All right. Firefly says, like I earlier mentioned, you have over 20 million users and penetration across 75% of Fortune 500. Put some numbers into the scale, where do revenues and ARR currently stand, and are you profitable today?
We've been profitable for the last 3 years.
Okay.
And when we raised our Series A round, which was about $15 million, we raised $20 million total funding to date. And we did not touch any of our Series A money. We were fortunate to be profitable. We have crossed over 1 million business domains where people are using Fireflies. In fact, India specifically, we've tripled the number of paid teams over the last 2 years. And India is one of our fastest growing markets. It's in fact the second biggest in terms of users. So we're investing heavily in India and also bringing new products and more regional specific pricing so that we can make AI affordable for everyone in India.
Okay, all right. Krish, you're sitting on a valuable but highly sensitive layer of enterprise data. How do you deal with privacy? How do you deal with consent and data security? And how do you convince your customers that, all these conversations, this confidential conversations will sort of not lead to training AI models, so as to speak of?
One of the reasons we win so many deals with enterprises is we have a very clear stance that we do not train on customer data. Unfortunately, a lot of other meeting platforms do that to build their own models. The second thing is compliance is really important. So making sure people are aware when you are taking notes or using a note taker for recording. So when people see the Fireflies note taker on the bot, they're at least aware of it. And if they have sensitive meetings where they want the bot removed, they can have that. So we offer that flexibility. And we've spent the last 5 years building security features so that large organizations, including government agencies, could use Fireflies.
All right. Krish, you were an early investor into OpenAI, Anthropic, and Perplexity. Now, both as a founder and investor, in your journey, where do you think ultimately, the value lies? Would it be foundational models, infrastructure, or application layer, like something that Fireflies does?
I'm betting on all three. I've in fact made a lot of recent investments in infrastructure, one of which is a nuclear reactor company. Another one is a company trying to reduce the cost of data centers. On the model layer, you can't go far beside OpenAI and Anthropic. Yes. And then the application layer, where Fireflies participates, but also companies like Perplexity. I think that for companies, especially young entrepreneurs, the application layer, especially in India, is ripe for disruption. There's a lot of old legacy technology that can be replaced. And if you are trying to build a company where you're not raising a lot of capital, I'm very excited for the innovation that's going to happen. Infrastructure and models are like the electricity. Now you're building all of the appliances that people can use.
All right, very quickly, let's talk about India. You're an Indian origin founder. You've built this global AI company. Do you believe that the next Fireflies can be built out of India? And if yes, what does India lack so as to be there right now?
The good news is the internet doesn't need anyone to be in any particular location to succeed. The venture capital ecosystem in India is growing and booming. And I genuinely believe that anyone can build a global startup from India. And whenever I advise founders and other startups here in India, I say, you're not just trying to compete to be the best AI startup against other Indian startups. You should be aiming higher and have higher ambitions so that you can be one of the best in the world. And I think India for the longest time has exported incredible talent. You see all of these executives in Silicon Valley who are of Indian origin. So we have no shortage of talent. In fact, in the next couple of years, I expect us, instead of exporting just talent, we're going to be exporting products and technology that the rest of the world uses.
All right, before I let you go, let's talk about your newest investment, which has nothing to do with meetings and notes. You've become a founding investor in Rotterdam Dockers. Why cricket, why Europe, and why now?
Initially, the plan was to go just be a sponsor. And personally, for me, I've played cricket, watched cricket, followed cricket my entire life. And the opportunity to invest came along. And I was very fascinated about, I wonder what sort of technology they're using in cricket. And as I had conversations with cricket players like Faf du Plessis and John T. Rhodes, and I realized there's a lot of potential for AI in sports because every ball is immense amounts of data, and you have 120 balls in a T20 game.
You know, that brings me to my next question. You know, how do you bring the Firefly's mindset of moving fast and AI into this investment?
So one of the features we have in Fireflies is this meeting prep feature where before I go into a meeting, it preps me on everything I need to know about the person. And I think we can use similar AI to prep teams and help them prepare lineups and know their opposition very, very quickly. So we're building AI models, and we're hoping that we can help these teams get really smart before they even go into the game.
All right, with that, it's time for me to wrap up our conversation. But many thanks for joining us in our studio, and wish you the very best with Fireflies and your new investment. Thank you so much.
My pleasure. Thank you so much.
Well, with that, it's time for us to head into a short break. But coming up next, the UPI MDR debate. Can a fee on select merchant transactions make the payments ecosystem more sustainable? And will the cost ultimately be passed on to consumers? We speak to industry experts on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. The government has once again clarified that UPI transactions will remain free for customers, with any potential MDR limited to select merchant transactions above a certain threshold. But with the UPI ecosystem costing thousands of crores to run, the big question is whether a limited MDR can make the system sustainable. Ritu Singh interacted with BillDesk co-founder MN Srinivasu, former SBI chairman Dinesh Khara, and One MobiKwik Systems co-founder and CFO Upasana Thakur to discuss the MDR debate and the cost of running UPI. Take a look.
Every small step will matter. Having said that, I think we still need to wait to see whether the MDR as allowed is on basis of a merchant size or a transaction size or some combination of both. It's perhaps one can only speculate without knowing too well where it will come. But hopefully, even if they allowed it a reasonable amount of bits mirroring something like what we have on other debit transactions, it would be a big relief for the payment sector.
Could a zero MDR for small merchants and a higher MDR for large merchants, as we're given to understand, is being discussed? Do you think something like that could create distortions, or could it encourage merchants to split transactions to stay below the threshold? What do you think the impact of this could be? And we know Indians are big jugarus. How do you think this will work out?
Two things. I think one, just to even addressing your earlier question, given it's a debit mechanism of a bank account, it's not unreasonable to think an MDR could mirror the debit card kind of mechanism, which has a dual rate system going all the way, between a 40 bips to a 90 bips. You're right. I think we need to have guardrails to make sure that the intent of the mechanism plays out the way it is to be in the market. Having said that, I think if I would even think from the merchant's perspective, the transaction charge will be a minuscule part of their overall collection pool and the amounts they're collecting. That I hope they would not waste their energies and time trying to be jugadu about this. It's, I think, easier to think of it as a large merchant to a certain size of revenue and all transactions of theirs getting charged. That will perhaps be an easy way to think of implementation here.
Mr. Khara, just from your experience to begin with, the wider concern, and legitimately so, has been if you impose any kind of MDR on the merchant today, what is to stop him from passing that on to consumers? Even if you're not directly charging the consumers for any transactions, what stops him from passing it on? How would you answer that?
I think when it comes to merchant, they have to actually weigh their cost. If at all it's MDR is being paid or not. So actually, it's a convenience which is being made available to the merchant, and for that he is required to pay. In fact, before 2016, when the demonetization happened and when MDR was waived, before that, actually all debit card, even credit card, all these transactions were entitled for MDR discount. The merchant, of course, they have to weigh when it comes to their competitiveness. If at all they have to maintain their competitiveness, they will probably absorb these costs. And I would say that if at all you will weigh the cost of handling cash or cost of handling checks as compared to that, this would be almost negligible. So I don't see that it should be a major challenge when it comes to the adoption by the merchants.
Upasana, let me bring you into the conversation because, as a fintech that's very much a part of this UPI ecosystem, what does it actually cost to offer UPI at scale today? And what, to your mind, is an ideal MDR fee that will make this business sustainable?
So, you see, my perspective is very simply, and to answer your question, and we all hear about, there is fraud happening, the scale of UPI is increasing. My perspective is that the cost of supporting the UPI transactions is something, that the banks and fintechs like mine are paying. And it is in the form of, the server cost, to the reliability required, the uptime required to manage this huge scale of UPI transactions, the investments that go into fraud prevention and cybersecurity and innovation to make daily life UPI very easy for everyone. And, the subsidies that we have all been receiving, the banks and the fintechs so far, they barely cover 10 to 11% of these costs. And it's therefore to say that UPI is free, it should serve the purpose of financial inclusion, it should always be free for consumers. But when it comes to the fact that zero MDR, as a framework that has been running, the cost has been borne significantly by payment companies. And there are enough large merchants in India, who are doing revenues of multiples of thousands of crores. And they are paying today on credit card 1.8%. They are paying 0.9% on debit card. So why should they not pay anything on UPI? And why should the cost, be borne by players like us?
And with that, it is a wrap on this edition of Startup Street. More news and updates continue right here on CNBC TV 18.